It's Nicola Adams-Hendry. I'm the CEO at Climate Bonds. And I just want to take a minute, first of all, to extend a warm welcome to you all, but just to go through a couple of housekeeping items for this morning. First of all, phones, if I can ask you to have them on silent while you're in this room. Outside, you will find the facilities just beside the reception desk, along with the fire exits. And a QR code on the back of your lanyard will give you the agenda for today. There are a couple of coffee breaks and a lunch break, so there's plenty of time for networking. Please come and find us. We'd love to connect with you, new and old. And I don't think I have anything else to say today. It's a packed agenda, so without further ado, I will hand over to Mr. Sean Kearney, our CEO and founder. Thank you.
As you've heard, I'm Sean Kearney. Thank you so much for being here today, for joining us at our annual London Climate Bonds Conference. And this is the magic clicker. Yes, it works. First, a few housekeeping measures. This is a hybrid format. If you're online, use the chat function to ask questions, and our team will look at how we can relay questions and certainly find you answers online. For everyone in the audience, bear in mind, everyone on this panel I should say, bear in mind there are people online as well as people in the audience. Quite a few, I think it's about 200 or so who've registered online. I have to thank our sponsors because we couldn't do this without Asian Infrastructure Investment Bank, who we work closely with around the world, and Amundi, who are supporting us as sponsors, as well as Mizuho, Standard & Poor's, and Ashurst, our legal counsel, who've also been hosting our training session yesterday. There's a couple of exhibition booths at the back you'll probably see. That's the information side of it. So in terms of my talk, it's important that we think about how we frame what we have to do around opportunities, not compliance. This is one of the reasons I'm a supporter in principle of the EU's simplification agenda, because we got lost in a compliance jungle and we forgot that the real issue is driving opportunity and driving positive change. And in general, if we want to get the big beasts of finance moving, the Paul O'Connors of the world, he is here somewhere, I'm just joking, Paul. We need to make sure this is about creating opportunity for the finance sector, creating opportunity for our pension funds and insurance funds and institutional investors to get the returns that we need to pay our pensions, creating opportunity for corporates to be able to deliver returns for shareholders, creating opportunity for governments to be able to create wealth for their citizens, to build their health systems and build their social security systems and build their infrastructure and build their cities. If we don't frame the challenge as opportunity, we are unlikely, we will not get anywhere in reality. And I think the last 30 years of angst about climate has shown us that very clearly. As much as I wish it was different, that's not the way the human mind works. However, in this room, we still have to understand what's going on as we think about the opportunities arising for action. I mean, clearly, we have climate change cutting in. We have had severe heat, the hottest year on record yet again this year. In some places that means droughts, in other places that means floods. We're certainly seeing the impacts happening at the fastest possible trajectory of the Intergovernmental Panel on Climate Change some 30 years ago. We will see a lot of primary effects, that's heat, floods, typhoons. I was in the Philippines when the strongest typhoon in recorded history went through, and it's going to be stronger very soon, likely to be double the strength, if not triple, by 2050, which is unimaginable when you're caught in the centre of one of those typhoons, which will mean we'll have to change how we build our cities in typhoon zones so they can better withstand wind shear. It means we're going to have to build our flood control systems so we can better deal with the vast amounts of water that will start getting dropped in all our cities around the world, with droughts in between. And in fact, just in the past week, the Tokyo Metropolitan Government has issued a resilience bond, a climate bond certified resilience bond, specifically for investments to deal with climate change in terms of floods and typhoons. All the physical investments they're making, from huge caverns under Tokyo that can absorb floodwaters, to putting electricity poles underground because they're getting knocked over nowadays in typhoons, are resilience measures. We will and need to see a lot more of that. The secondary impacts need to be understood as well. What comes with climate change, we know from the historical record, are three things. It's famine, pandemics, and war. The three horsemen of the apocalypse is how humans experience climate change. You might have heard me talk before about how in the 1600s we had 2 degrees cooling, basically because we let measles and smallpox loose in the Americas in the 1500s, which killed about 95% of all indigenous inhabitants of the Americas in that 100 years. And we inadvertently created massive forest regrowth in the Amazon and in Central America, now confirmed by research at Stanford University from analysing tree rings. That forestry growth sucked carbon out of the atmosphere and helped cool the planet. So we've had some relatively recent human experience of directly affecting, of human impact, the planet. And there were feedback loops and so on. So how did we experience that in the 1600s globally? We experienced it as famine after famine, as in collapse of crops. We experienced it as a number of pandemics, and we experienced this as cycles of war in China, in India, and in Europe. 1/3 of the world's population died in the 1600s. Our grandparents don't tell us about that. It's not very well documented in recorded history. And we're looking at 6 to 7 degrees warming this century so far. So we do need to understand the risks involved. But we also need to understand, as we focus on what to do, that solutions are everywhere. I mean, one of the extraordinary things about the last 20 years in particular is the extent to which solutions are proliferated. We're going to hear a little bit later from Kingsmill Bond about renewable energy. But, just one statistic. Last year, according to the IEA, 93% of all investment in electricity generation on the planet was clean energy. 93%! It's extraordinary. Given when I started in this game, there wasn't a lot of it. It was tiny numbers. That's been driven by state action, by public policy priorities. In Germany and Europe first, with the introduction of feed-in tariffs, thank you Greens, because in 2001 they forced the Labour and the German coalition government to bring in a feed-in tariff, and that got copied around Europe. If they hadn't started that ball rolling, all these other things wouldn't have happened. China picked up the idea in 2006 for security reasons. Hello Europe, have you heard about security reasons around gas at the moment? Well, China did this 20 years ago, and other reasons like air pollution. And having created the largest offtake agreement for renewable energy in history, to the extent that last year there were 277 gigawatts of solar installed in China. This year, it's even been a larger figure. More than 50% of all renewable energy on the planet's been installed in China. When we hear Americans complaining about subsidies and overproduction to make life difficult in the rest of the world, we forget something. That what China has in fact done is build its own renewable energy capacity for reasons, and on the back of that, as a bonus feature, they've got overproduction. As a result, they've got cheap solar cells to sell the rest of the world. If you're in Ghana now, you can buy really cheap solar cells to whack on your roof and power your electric mopeds, as people are doing. Oh, electric mopeds. Massive sale now across Africa and South Asia because they're at price parity. Cars, electric vehicles. Okay, we all want trains, but electric vehicles are still better, much, much better than petrol cars. In Ethiopia last year, 60% of all cars sold were electric. In Nepal last year, 70% of all cars sold were electric. In Pakistan last year, 26% of all cars sold were electric, leaving Europe let alone the US, way behind. That's the result of Chinese state policy to grow industries, to nurture them, but to do it in an absolutely Western capitalist way. If you've ever read about the nature of vicious competition in the electric vehicle industry in China, you'll know what I mean. There were 40 companies 5 years ago. Now there are 20, still 20 companies doing electric vehicles in China, and the competition is fierce. Transport, though, does need to look towards denser cities. We do need more Hong Kongs, Parises and Barcelonas if we are to have sustainable cities than Atlantas or Los Angeles or Brisbane's and Sydney, for that matter. That's going to mean transport infrastructure. We need to triple rail kilometrage in the world by 2050 to achieve our climate goals. We need to do a lot of tripling by 2050. It's a bit crazy. We need to quadruple the level of electrification on the planet by 2050. Now, I'm saying this because that's very clear from a policy perspective. You have to do this. So governments are edging around this and doing it more and more, led by China. This is business opportunity stuff. Once we start realising the likely direction of travel, it opens up enormous business opportunities. We're seeing some of it already. The logical conclusion of the idea of electric vehicles, we've seen lithium booming, we've seen copper and nickel booming. But of course, the biggest bottleneck in the world right now are grids and transmission lines. In the US, there is a 7-year wait to get in new electrical transformers, which is a huge bottleneck to the incorporation of renewable energy, at least utility scale renewable energy in the US into the grid. But that's the same case pretty well everywhere. Companies that can quickly address grids and transmissions are investment options. I mean, some are booming already. Schneider shares are through the roof, partly because of AI data centres and partly because grids and transmission lines. Follow through the supply chain and you're going to find a lot of opportunities, that critical word, for growth. To kind of give people an idea of what the opportunities are, we've been working on this idea of taxonomies. In Europe, we got a bit caught up in the compliance idea of taxonomies, but a taxonomy of sustainable finance is a shopping list for the future. It's a clue to the policy priorities, the basket of investments that are likely to come about as we act on climate and are coming about. So this idea, which is science-based guidance, has gone viral globally. It's everywhere and continues to grow. Brazil will announce its taxonomy in the either next week or the week after, and more are coming through. We're also seeing further development of guidance, and this is relevant if you're in the sustainable finance market, because the market will grow through more issuers, through the expansion of programs for issuers, and through widening the understanding of what qualifies as a climate investment. So we've launched last year a climate bonds resilience taxonomy first stage, high-level guidance. There's an event later today, a session later today, and we're going to see a lot more guidance about what needs to be done. It's obviously physical. If you're doing flood protection measures in Tokyo, that qualifies. Bingo, we've got a bond out this week. But it also applies if you're doing social protection measures. Remember that in the 1600s, the secondary impacts are what killed people. It was famine, pandemics and war. Measures that mitigate the risk of societal collapse or just the risk of default on payments of debt are really important now to be addressing, because the 21st century is becoming a century of volatility. Climate change is not gently changing sea level rises, it's crazy volatility. We will have extreme floods in London, and then we will have drought for a year in London, let alone in pretty well every city in the world. The nature of the atmospheric changes means a lot more water and a lot more heat in the atmosphere, and that means a lot more big storms and then nothing happening in between. So just think crazy weather and then think of the consequences of that. Crazy weather means floods like in Valencia, which swept away whole suburbs. So it's not just gentle floods in Islington or Angel. And that's what we have to understand about this century, and understand, therefore, how we have to prepare our communities. one key indicator. The primary indicator of reduced deaths numbers in an incident is how strong the community is. If you have a strong community where people know each other and you have an incident like a typhoon or an earthquake, you will get on average about 40% fewer people dying. Simple as that. That means that building communities is a climate resilience measure. So much so that the city of San Francisco has been financing neighbourhood block parties as part of their government program to encourage people to know each other, on the condition that if you get funding for a neighbourhood block party, you have to invite every single person in the block, including the crotchety old man on the top floor who never comes down and always complains about people. Because it's important you know everyone in your community, so if there's a crisis, you can find them and people will find them. This is the social dimension. This is the Sustainable Development Goals. Every single aspect of the Sustainable Development Goals is critically important to climate resilience. I mean, we need some filters. We don't want a Sustainable Development Goal that boosts coal mining. Okay, there are a few things along those lines. And that's the work we're doing now, and you'll see much more of that coming through. It does mean water. It means coastal protection. The Netherlands, with their first sovereign green bond, applied the funds for coastal protection measures in the context of rising sea levels and increased storm surge. You're going to see a lot more of those. But it will mean also things like the Ganga Valley Authority doing investments to create reservoirs, because India is likely to suffer a loss of a monsoon 1 year in 5 in the future. How it stores water, manages water, treats dirty water are going to be critically important to the sustainability of the Indian economy going forward. There's a lot of investments, and that applies pretty well everywhere. It does mean cities. By 2050, 80% of our population is going to be living in cities. It's 56% now. It's 33% in India. We are seeing already the largest movement in history of people from country to cities, but we have not yet begun. Because as we start experiencing severe climate volatility in the agricultural sector, small landholders, year after year, will be forced off the land. They will go from the Nigerian provinces into Lagos. They will go from smaller farms still existing in Brazil into the bigger cities. Agriculture will be able to be managed by larger combines who are better placed to be able to deal with big swings in weather and volatility for the insurances. There is no doubt this is happening in India right now. It's happened already in China and will continue to happen, and is happening in Indonesia. So if you start thinking of a world, not half the population cities, but 80%, what does that mean? Well, one thing it means is those cities have got to be productive. They've got to be wealth generation. They've got to be able to create livelihoods that make people able to live. We do not need more favelas in Rio de Janeiro. We need to understand the work of great economists like Hernando de Soto about how we get rid of the favelas and create cities that are inclusive, that give people a chance to make a living and earn income, and build the infrastructure they need. The infrastructure is not just transport, it's the social infrastructure, it's the wealth infrastructure, it's health. These are climate resilience investments. In the universe of things you look at, if you're a portfolio manager over the next 5 years, you are going to be starting to see green and resilient bonds in all of these sectors. That's how we take this forward. And of course, it's nature. We have defenested, destroyed, collapsed nature on the planet. I grew up in Vanuatu. There, the coral is magnificent. The fish is magnificent. But when I go back, I'm now being told that the deep water fish have all gone. The tuna fisheries are gone because Vanuatu gave them over to Taiwanese and Chinese fishers, and they thought, Vanuatu, it's in the middle of nowhere. And that same story is being played out in every ocean around the world. Our fisheries are under crisis. Our bee populations are in crisis. Our tree populations, we have a vast number. Stuart Clenaghan is here, will tell you the number of trees that are currently at risk of disappearing entirely, tree species on the planet. What are we doing? We can't survive without biodiversity, with pollen, with bees and so on. And understand this, biodiversity is not always nice. It means a lot more bugs. When I was young, driving to my father's property in Western New South Wales in Australia, we used to have to clean the windscreen 3 times on the way. It was about a 500-kilometre drive because there were bugs. Now you can drive the whole way without cleaning your windscreen. Something is really wrong. And that means we've got to protect. It's simple. We know, and there are many UN studies, that if we allow nature to grow back untouched by humans, it recover remarkably quickly, as long as we haven't destroyed it entirely in the meantime. We've got to allocate large parts of the planet to nature, and it applies to oceans. The current target in Europe is 30% of our oceans around Europe allocated to marine reserves. Greece just announced 10% of the Aegean put aside to a marine reserve. Okay, 10%, third of the way there. If we can allow 30%, our fisheries will be able to recover. But of course, we have to do this in the open oceans as well. You get the idea. There's so much to be done. So much that we require capital for. Oh, lucky us, we have the capital. We have flooded with capital. We have more capital on the planet than ever before in history. We've got $140 trillion of institutional capital only sloshing around the planet, looking for places to go. Isn't that right, you investment managers? Just checking on that. There is no doubt we have the capital. Of course, it's in the wrong place. Well, for a start, it's in equities in the US. Jesus, that's a disaster waiting to happen. The reallocation of capital to productive enterprise that also delivers a future for our children is the job of our times, is our job in this room. We need to do it in a way that pays our pensions. We need to do it in a way that also creates a world that can pay our pensions. It's not a matter of picking the single stock that will survive, because if the society around the stock crumbles, our diversified portfolios crumble. So we've got an absolute conjoining of interests between our long-term capital holders, the 140 trillion of them, and the challenges we have to address. That's the opportunity we have. But remember, have a moment to think how good we've been as a society. Thank you, the economists, the leaders with this, to create these pools of capital. So at a time when suddenly we need about $15 trillion a year, we can say we've got the capital. Hey, of course, we've got to move it to the right place. We've been moving it to the right place. Green, social, sustainable bonds are currently at $6 trillion a year. They were $2 billion outstanding when we started climate bonds 15 years ago. Okay, it's an indicator of success. It's not the game. But it shows you, as you will hear in the next session, if we package things that meet institutional investor needs for your risk and yield, that also address the long-term risk they know exist, this works. The Tokyo Metropolitan Government Bond was issued in euros in the London market. It was 7 times oversubscribed. This is a common story. There are lots of different kinds of bonds as part of this. Sovereigns are a big part of the game. We now have some 40 countries around the world regularly issuing sovereign green bonds and pushing around their other ministries to say, give us more, give us more. I can't tell you the number of times I've spoken to someone in the Ministry of Climate Change who said to me, do you know what happened to me? What? Treasury, the Ministry of Finance, phoned me up. Do you know how hard it is for me to get a meeting at the Ministry of Finance? They never answer my calls. They phoned me saying, have you got some climate things we can fund with our bond? That's the dynamic we're setting up on the sovereign bond program. We still have time, but there are some challenges. While we've had some wins, $6 trillion, regulatory environment around the world, network for greening the financial system, the architecture of understanding what we need to do has gone from green, renewable energy, to transition investments. Every conference I'm in Asia now is about transition investments. Yes, yes, yes. To resilience investments I've been speaking about today, to enabling investments. We'll be bringing out certification criteria for critical resources in the near future based on work that's already been done in Australia and Brazil and in Europe and so on. We're making progress on all of those things. But we have some speed bumps we have to address at the same time. This is not an easy journey. And when people say, transition's really hard, I say, what do you expect? We're trying to shift the planet on a dime. We've got some immediate challenges. When we said we have to quadruple electrification, we also have to triple air conditioning by 2050. Huge energy use. How we deal with energy, air conditioning in emerging markets with energy efficiency is a critical path forward. Oh, and AI data centres, of course, which are soaking up so much energy. We hope to be launching a greening AI data centre coalition in the next 3 weeks. We have headwinds. You know what I mean. Despite the noise coming out of Washington, DC, though, I want to say what I've tried to make a case today is so much is changing anyway. While we have chop on the surface of the harbour from politicians blowing hard, the currents underwater are absolutely moving in the one direction. There's been no change. And that's what we have to bear in mind as we try and struggle through the noise. We will need to do a few things around the noise that's going on. We will need to be innovative about how we manage risk, not just from a portfolio management, but from an insurance sector management. How we pool risk in a time of volatility. Insurance is suddenly becoming way more important even than it has been for the last 200 years in driving our economy. We will need to look at trade, not just negative stuff like CBAM, but positive stuff. There is currently a green trade agreement being negotiated between China, ASEAN and Australia. That's got to happen all around the world and ring-fence the USA while we're at it. And will happen. We will need to be looking at the nature of urban development and how we share the expertise we have in places like Copenhagen with the cities that really need it, like Accra or Kuala Lumpur. It's pretty green, but you know what? It still needs work. Or Singapore, where I have to say, world-leading people, but still missing a trick. You know they still drive petrol cars in Singapore? Don't you think that's bizarre? This is a city perfectly placed for electric vehicles. The relevant minister said to me a couple of weeks ago, they're banning petrol cars by 2035. I mean, there is no range anxiety in Singapore. There is no reason at all to have a petrol car. It's bizarre. Plus the taxes on cars are like 150% or something like that. Just reduce the taxes, reduce the taxes on petrol cars by 30%. Oh, sorry, increase it by 30%, reduce on electric, you know, like so easy to do, right? That would be a win for tomorrow morning. And I want to stress that because the way we create the opportunity is find the easy wins. And I'll leave you with one last win, which I'd like to see employed anywhere. In London, we've been allowing higher density buildings over the last 15 years, more towers. Great. We need to densify our cities while retaining our parks. Hong Kong has the same density as Paris. Very hard to believe when you live in Hong Kong, but there's got a lot of green space between the towers in Hong Kong. We can choose how we balance green space and high rise. We can give net zero buildings an extra 3 stories in the City of London. No cost whatsoever to the taxpayer, and suddenly every developer in London will be saying, give me, I'm doing a net zero building. These are fiscally efficient measures we can pursue to make the change. It's our job to make sure the choice is made. It's our job to make sure that the capital is supporting the choice because it's going to create more investment opportunities that also improve the ability of all societies to pay back their debt. Lower default risk, increased return is our mantra in all of this. We have a chance of creating a world that is fit for our children. At the moment, we are not creating a world that is fit for our children. We are still on a trajectory to Mordor, a trajectory to disaster. But we still have a chance. And that's what this conference is about, making sure capital flows in the right direction, where it needs to go. Thank you for being here. Now I want to invite up to the stage, as a little double act, my friend Kingsmill, who's going to talk about the turnkey of everything. energy. Join me, Kingsmill.
Brilliant, thanks, Sean. Wow, hi folks. So how do I follow that? Well, the good news is that I have exactly the same presentation as Sean, but with far less pretty pictures and a lot more data. It's worthwhile acknowledging the elephant in the room. Read the front page of the FT this morning or any day for about the last 9 months. There's a lot of uncertainty out there in wake of the election of Trump, the rampant fossil fuel triumphalism, and the very clear weakening of the ESG narrative. But I'm here to tell you that that is noise. The fundamentals driving system change in the energy system actually are as powerful as they were 12 months ago. And as my new friend from India was explaining to me earlier, net zero may be over, but the electrification or the electrotech revolution is here. And that's what this presentation is going to be about. So let's talk about the electrotech revolution. What am I talking about? This is trying to put flesh on the bones of Sean's framing, that there is a force powerful enough to continue to drive change in spite of the current political pressures. It's called an electrotech revolution. So what is it? So as the name suggests, at heart, there are 3 parts to this revolution. There's generating electricity. It's mainly solar and wind on very clear exponentials. It's using electricity, so that's electric vehicles, the electrification of industry, and so on. And then it's all the stuff in the middle, linking of the supply and demand, so that's batteries and software. So there's a revolutions going in all three of these areas. So it's a technology shift. And what lies at the heart of this is where I promised you a few more numbers than Sean. But anyway, what lies at the heart of this thing is the continuous fall in the price of these technologies. They are small, they are modular, they're on learning curves. They fall by around 20% for every doubling of deployment. So you can see that since the 1980s, costs are down by 99%. And it's not, well, as a result of the very rapid fall in costs, you're getting this surge in capital allocation. I mean, I hardly need to tell this room, but let us not forget that there's now twice as much capital going into electrotech as there is into the fossil system. Because, I mean, at heart, what we're doing, the fossil system is being maintained before it goes into decline, whilst the electrotech system is being built to supply all of the energy of the future. And you can kind of see this if you compare and contrast solar and oil investment. We're now investing more in solar than we are in the oil sector. So what therefore at heart is going on is something you see very often actually in other technology shifts. You're seeing a convergence of different technologies into a river of change. So as solar gets cheaper, so it sustains the battery sector. As batteries get cheaper, so they sustain the solar sector. And you're getting, as we've seen before, actually, a kind of convergence into this decade of revolution. So let me substantiate this a little bit so that it's not just claims, bold claims that we're seeking to make. So let's talk a little bit about the growth. So solar's gone from nothing 15 years ago to be now the largest source of global capacity, as this chart is showing. But it's not just that. Deployment is doubling every 3 years. It's now about, in the summer, about 10% of the global system. As you can see, we're not very far away. We're not many doublings away from being very, very material. And in the first half of 2025, all of the growth in global electricity demand was supplied by solar and wind. This is one of the things we do in Ember. We look at these numbers very, very carefully. Second aspect of the revolution that's going on is the electrification. The electrification of everything has been happening since 1880 in Edison, but it happened very quickly, and then it kind of slowed down, and now it's picking up. And it's picking up because the third big sector of end demand, which is transport, is being electrified at extraordinary speed. So don't believe what you read in the Daily Mail. Not that I'm sure anyone here reads the Daily Mail, but nevertheless. The EV revolution, folks, is not over. It's on and on it goes. We're going to have another 25% growth this year. EV sales will be around 25% of the total market. They're about 50% in the world's largest car market of China. And they're selling electric cars in China today at $8,000. You can charge it up for $10. I mean, it's just obvious. And then there's this revolution that's going on in the third area where I think, I mean, again, this is possibly less for this group, but there's an extraordinary opportunity in all of the connections between supply and demand. So the most famous is battery storage. Battery storage, folks, is doubling every year. Again, that's just extraordinary. We didn't think that was possible 10 years ago. High voltage DC lines have increased in a decade tenfold. Internet connected devices, smart meters, everything is growing very, very rapidly. And where this has kind of brought us, we often hear, it's quite amusing, I hear from my dear friends in the fossil fuel industry, they're always telling me that you can't solve the last 20%, you can't solve flying, and you can't solve petchem, and you can't solve cement and steel, and I'm like, okay, fine, whatever, but that's just the last 20%. We can solve everything else. We can get solar and wind up to about 70 or 80% of electricity generation. The leader's already there. We can electrify around 3/4 of our end demand. So the ceiling of the possible is far above our heads, and every year it continues to rise. So there is this extraordinary opportunity. There's a technology shift going on. We are embracing it. But it ain't easy. And it's always worth saying that change is never easy. You've got inertia, you've got lobbying, you've got some governments very clearly run by and for fossil fuel interests. There's competition, there's technology evolution, there's as the European wind industry will attest, there's the challenge of China. There's regulation tooled up for the old system. So this kind of this unstoppable force of technology is meeting an apparently immovable object of incumbency and inertia. And at times it pays to look back a little bit. Another time that happened is that we're seeking to illustrate on the screen here is after 1900, when the horse, which had been the primary human technology for travel and many other things for thousands of years, got superseded by the car. It wasn't easy. Most of the first companies that plunged into that space went bust. But a few of them succeeded, and that was enough to drive an extraordinary technology revolution. So I want to talk in the sort of second part of this presentation about the great forces. What are the forces which will overcome these very powerful inertia effects? And at heart, they are physics, economics, and geopolitics, or in more prosaic terms, efficiency, cost, and energy security. Let me talk a little about those three, because it's really important to realize that there are many objections to change, many barriers, but actually we just keep on crossing them, and we have to think why. So if I start with physics, you've got a fossil fuel system that is spectacularly inefficient. It takes about 600 exajoules of primary energy and converts it into about 200 exajoules of useful energy, and pours about $4,000 or $5,000 billion of energy into waste. So there's an enormous kind of target on the back of the fossil fuel system that people like Gray Jackson or Octopus kind of can address and can target. The second driver of change is geopolitics, and this is extremely poignant at a moment where you've got Qatar and the US this morning telling Europe that we should not dare to prevent them from selling their disgustingly dirty LNG into our continent. This, folks, is a question of sovereignty. So 3/4 of the world lives in fossil fuel importers. In the UK, we import 40% of our primary energy as fossil fuels. In Europe, it's 60%. In Spain and Italy, it's about 75%. So in Japan, and Korea, it's about 85%. This is a desperate degree of dependency that a very large part of the world has. Now, That was kind of fine under the Pax Americana, but now we're squeezed between Putin's war machine and Trumpian fossil blackmail. And we are still in Europe sending these folks 1,000 billion euros a year of tribute money. We don't need to do that anymore. We don't need to pay the blackmailers anymore. It is a security imperative to get away from this stuff and to use our own wind, our own sunshine, and our own electric technology. So there's a very powerful security imperative. And then the third, again, to come to a slightly less emotive topic of just price, if you take S-curves, if you take exponential growth curves and you take learning curves, you can roughly forecast where price is going. And we at Ember, we've been, and in previous locations where I've worked, we've done this calculation, it's been roughly right for a long time. You get sort of bumps in the road like COVID, but actually you can pretty much see where costs are going. So we will be at around $25 solar by the end of the decade. Oh, sorry, within a decade. We'll be at $50 batteries within a decade. And very low costs are the ultimate, what's the word? The ultimate solution to overcome barriers. Okay, so we've got these three very powerful factors, security, cost, and physics, which will continue to drive change. So what then happens? So they unleash change in the emerging markets. So you've got this massive sunbelt. It's very interesting. Here we are in the UK. We're obsessed about the fact we don't have sunshine, sadly. But we do have a lot of wind, and right across the sunbelt, where 80% of the world lives, there's an extraordinary amount of capacity to harness the sunshine. So they've got the highest quality resources. There's also the fact that it is China, folks, that is leading this race to the top. So it is often put to us that we can't do this in the UK, therefore there will be no change. Actually, the change is driven by China, and it spreads out from China. So China is getting the patents, the manufacturing, the exporting, the renewables, and the electrification. So the fact that the West's primary strategic competitor is doing this stuff anyway means that if we want to compete, we have to do it too. So there's a kind of imperative from that. There is this tiny issue of Trump and the US and maybe all these data centers and these attempts to blackmail us into buying LNG. Maybe that's going to work. All I can say is good luck, folks, because they are actually, the US actually only about 10% of the global system. China's 50% of the global system. So Trump and his pals can maybe hold back the United States for a few years, and even that is slightly moot, because you've got lots of change going on at a regional level, state level, and there are lots of very clever people in America who are finding ways around this. So even that is a little bit moot, but he cannot hold back the global tide. And then the final aspect of this section is you do have an extraordinary emerging market leapfrog going on. And again, Sean alluded to it with some very, very powerful statistics earlier. You've got, if you look at electrification, Southeast Asia has leapfrogged Europe and the United States in electrification of its end use. So there are two aspects of the energy transition. There's producing electricity and there's electrifying stuff. So when you've got Southeast Asia, and actually a quarter of the emerging markets already leapfrogging what's going on in the West, that's telling you that something's going on. And if you then look at the deployment of solar, actually, well, very largely because of India and Pakistan and Brazil and South Africa and Mexico, 2/3 of the emerging markets have actually already leapfrogged the US in terms of solar as a share of electricity generation. So there's an extraordinary emerging market leapfrog story going on out there. I'm going to kind of wrap up by looking a little bit forward. So we have this extraordinary story, the lots of forces driving it forward. And I guess to try and conclude, the question is, where are we going? So I'm showing you here the IEA framing of the transition. This, to remember, folks, is the last IEA framing of the transition before they got hijacked by Trump and co. So in 2 weeks' time, there's going to be new IEA forecasts, which have got the carbon, they'll have a carbon profit scenario they call CPS in there. Anyway, I slightly digress. But there's a lot of growth still to come. And it depends kind of which one of these scenarios you take. We kind of favor analytically the middle one. It doesn't really matter. The point simply is that by the end of, in another 10 years, solar and wind will be about 50% of all generation globally, and we'll have about 1/3 of the system will be electrified. So there's a huge amount of growth yet to come. And then I think the point here is that it is to the victor that go the spoils. I mean, again, we're all finance people, but it was very, very important to recognize, surely, that all of the growth, all of the GDP growth, all of the new businesses and companies and opportunities and talent is going to come from these electrotech energy sectors. So to the victor go the spoils. I think we should always remember that. In terms of timing, which is, I guess, the point that we're always been asked about in finance, you know, okay, this is all great, but why now? And the point is, this is the decisive decade. This is the decade when we build all the manufacturing capacity. It's already built, folks. We have enough manufacturing capacity in solar and batteries to get to net zero today. This is the decade that the S-curves kind of hit their really steep part. Again, as you see in all these doublings. This is the decade that these costs get too cheap to resist. And this is also the decade that the markets, I suspect, will finally wake up and realize that the fossil fuel system is going to be in terminal decline. So, my final slide, Sean. I think I've more or less kept time. What does all this mean? It means we can harness the sun. The time is now. Change is pretty much unstoppable. It's going to happen faster than you think. So I think the question surely to this room is how to join the party. And then if I may venture one final observation, ESG, that little acronym, we need to rename it as Energy, Security and Growth. Thank you.
Thank you, Kingsmill. We've got a board member to go.
Sorry.
Thank you so much, Kingsmill, for joining us today. We need to now move to our investor panel to hear what they think about all this sort of stuff. If you've got any questions of Kingsmill online on the chat, or he may be back in a little while after his board meeting that he's going to now. But in the meantime, can I invite Karen Kearney to the stage, who's the moderator of our next panel. Karen's a very special person in our Climate Bonds life. She's a member of the Climate Bonds board, and she has another life also as the treasurer of Stanford University. And most importantly of all, her biggest milestone in life, she's arranged the issuance of a certified climate bond in the past, so she can talk from first-hand experience.
Thank you, Sean. So I'd like to invite the investor panelists up, please, to join me. And can I just confirm how long we can, as long as we like? All right. Fantastic. So thank you, Sean, for that warm welcome. Good morning, everybody. Thank you to those in the room for joining us, and also to those joining us out there in the ether remotely. So Sean said, my name's Karen Kearney. My day job is the treasurer of Stanford University. We are an issuer of muni and corporate bonds. And I also have the privilege of being a trustee of climate bonds. I am joined today by a very illustrious panel, so I really appreciate all of you joining us today. Thank you. What I'd like to do is turn it over to the panelists to each introduce themselves briefly and say a few words about your background. Ashwin, why don't we start with you?
Sure. Thank you very much. My name is Ashwin Joshi. I'm at BlackRock. I head up the sustainable investing team in the global fixed income division. Been doing this for about 10 years now. Our team is focused very heavily on green bonds, as Sean can attest, hopefully. But you know, we've been managing green bond mandates for over 10 years now. The first one when the green bond market was, I believe, under $20 billion as a whole. And it's incredible to see sort of, the growth over the years, and, couldn't be more excited with what's in store.
Thank you. Jake?
Yeah, hi everyone, Jake Goodman from Federated Hermes. Yeah, very similar to Ashwin, I look after ESG and responsible investment for the fixed income team in London. Full disclosure, we do not have a labelled bond fund, but we use labelled bonds across our range of sustainable strategies. So yeah, we don't buy something because of the label, we buy it because we believe in the sustainability story of the company. So that's where it comes in. Thanks.
Thank you. Malika?
Yes, good. Can you hear me? Yes. Good morning, everyone. So my name is Malika Takhtayeva. I work at BNP Paribas Management as a sustainable fixed income lead, and also our second hat, the main ESG analyst for the SSAs. So basically, BNP Paribas Asset Management is very passionate about the sustainable finance. We've launched our first green bond fund in 2015, and which is still a flagship fund, and it's global ag. And now we have 5 dedicated thematic bonds funds. We've got 4 green bond funds with the focus on Euro corporate, also sovereign, and then we have a dedicated social bond fund. Thanks.
Good morning, Christina, Bastin. I work for Man Group, and I'm a credit portfolio manager. I've been doing credit for ages, and then it's always been my dream to do something for the climate, and now I run climate impact strategies. We look at all labeled bonds, but also plain vanilla bonds of issuers that we think are really leading, either as an enabler or but very specifically for climate. So that's what I'm very excited about doing. And thank you for inviting.
Thank you. All right, so let's dive right in. How about hearing from each of you on the current state of the sustainable green finance market? Jake, you want to start?
Yeah, so Sean was speaking about speed bumps and headwinds. And I would say if you're in fixed income, which most of us probably are, things are actually not as bad as maybe they seem. Maybe it's those speed bumps, but the ones you can still drive over quite fast. Especially for European sustainable fixed income funds, we're on 12 consecutive quarters of inflows. And even for US sustainable fixed income funds, it's been 2 years of inflows, except a small blip in Q2 this year. We don't have the Q3 numbers yet. And I just think, anecdotally, we've still seen plenty of interest from clients across the world, US and Europe. I think that is, performance helps with that. It is, a slightly different story for sustainable equity funds, and I, take no pleasure in saying that. But yeah, I think, a lot of my job is engagement, and I still think that despite a lot of the noise this year, things are still reasonably positive. We have a bit less disclosure maybe, but I think companies are still very much engaged because they've spent decades investing and buying into the world of sustainability, and that doesn't get undone from one administration. The greenium is also down at 2 bips, which is good for us, and maybe not so good for issuers. So the social premium is up at 7 basis points, maybe not so, not so good. Yeah, so I think there are plenty of reasons to basically remain positive right now, and yeah, certainly for the foreseeable.
And what do you think about investor sentiment and appetite? Still there?
It's like, I would say undiminished. Undiminished, yeah. Especially maybe, I think in Europe, maybe increased, I would say, yeah.
Ashwin?
Yeah, if I may chime in here. I mean, if you take a step back and sort of think through, from an asset owner perspective, and we have many of you in the room as well, many of our clients have set net zero targets and net zero objectives, and for better or for worse, fixed income usually comes in as an afterthought, or used to at least in the past, and that might explain some of sort of the delay in deploying of sort of net zero aligned capital, to the label bond market. And one of the things we've consistently seen across the board, from regulators, from the asset owner community, from the investor community, is green bonds and label bonds in particular are one of the cleanest, best way to deploy capital to the transition. And we see that in the funds that they deploy. We see that in sort of regulatory sort of definitions of what qualifies as sustainable investment. And so that kind of explains a little bit, and obviously sort of the rates backdrop as well, the macro backdrop as well, kind of explains that inflow. So to Jake's point, I mean, the demand is certainly there from an investor perspective. But it also explains some of the technicals as well. I mean, issuers are still coming to market, still being oversubscribed. But you look at dollar IG issuance, and that's where some of these order books are getting filled much faster. And the greenium is a little bit stronger, partly because as a share of new issuance there in that market, it's always been a lot less than the European side, and continues to be so as well. But then on the flip side, to Jake's point as well, on the European IG space, I mean, I know there's a lot of headlines around total green issuances and whether it was up this year or down this year or what have you. I think a good number to also look at is share of new issuance. And when you look at that, a share of new issuance in the European IG market, it's been consistent, in the GSS space between 15 to 20% over the past few years. So nothing alarming, nothing to signal that issuers are coming back or cutting back on that. And on the contrary, so two last things I'll say here. One is the expansion of the sectors in terms of the types of issuers that are coming to market. Steel companies coming to market. You have others from the hard to abate sectors, shipping companies coming to market this year, and then you also see sort of from a investor perspective, sort of demand for those and the opportunities for those rising as well. So yeah, it's certainly not diminished by any means.
Yeah,
Christina, you want to talk about
Yes.
the current state of the market?
Yeah, so I wanted to chime in with Ashwin. I think the ecosystem's actually growing because as much as we sometimes lament, all these regulatory hurdles. I mean, I'm a portfolio manager and I'm always being told, well, this and that and the regulation and all this, but it's actually forced us to learn about the space. And as Ashwin was saying, there are new issuers coming from the hard to abate sectors. Even that's because various, like SBTI or other players in the system that set out the standards, they've come out with new guidance for all these new sectors. So as they come, then you can have issuance that's aligned, companies can align their targets. So the whole ecosystem's growing, and as portfolio managers or as analysts, we're all learning about all these different sectors and how we can transition and what makes an issuance credible or not credible. So definitely we're moving ahead with that, and I see no change in that. We'll continue to progress with new issuance and new sectors, and that's all very, very exciting. I think the other point about labeled issuance is that it is a communication tool also for the issuer. So we saw, for example, in Japan, and Sean mentioned it earlier, how the Tokyo Metropolitan Government had issued their first resilience bond. And it's a kind of subset of a green bond, but they wanted, it's actually the first large adaptation bond. And what the governor of Tokyo wanted to do was to signal to the rest of the world, all our hard currency issuance, we want to come under the resilience label because we want to communicate to the world that Tokyo is a resilient metropole. Yes, we have all these climate, we have earthquake and typhoon fears every day, but how is Tokyo dealing with it? And I think it's not just Tokyo government, but other issuers as well. They use labeled issuance very specifically as a communication tool. It's a pledge, it's a commitment. And that also is then honored by investors looking into it and understanding that commitment. So I think it's a very useful instrument. Yeah.
Malika?
Yes,
Current
I think
market?
it has already been said quite a lot, so I actually would like to support what was said by my fellow panelists. And then just to add that we would like to see more sectors to be introduced. And then hopefully we will see development from the guidance and principles from the institutions like ICMA, providing us with further guidance what those issues that include the hard-to-abate sectors into the issuances. So there will be hopefully a further guidance which is going to support the introduction of additional sectors to the sustainable finance market soon. But in terms of the appetite, yes, we are seeing a lot of appetite still from our clients. So it's really something that we're looking forward to continue and support. This year, it's the 10th anniversary of the Paris Agreement Accord. So it means that we've actually seen quite a lot of issuers refinancing the already issued green bonds. So this is something that we already expected. And then despite the headwinds, we knew that there will be still a flow of the green bond issuers. And hopefully we will see more coming not only from Europe, but from other regional areas such as APAC and then other emerging markets. So really happy to see those additional issues with the inaugural green and social sustainability bonds. So just to add that the support of additional institutions that provide guidance in terms of what should be included, how it should be standardized is very welcomed by investors, because we had to build our own green bond taxonomy on the basis that, yes, we do have an EU taxonomy, but because we see additional issuances of green bonds from, for example, emerging markets introducing additional use of proceeds and those that are not within the EU taxonomy scope. So that's why we have to work with our, for example, other ESG analysts that have a sectoral focus and then provide us with further guidance on how we should exclude or include and then see the alignment with our opinion and view internally. Thanks.
Thank you, Malika. So you touched on new developments. Ashwin, did you want to say something about emerging markets and nature-based outcomes?
No, absolutely. So before I say that, actually, I should mention, and I'd be remiss if I did, just partly because Sean invoked my home country, Nepal, and is having, what, 70% EVs this year. And I go home every year, and I went back home this summer as well. And that year-over-year change in sort of the number of EVs that you see on the road, it's just stunning. It's incredible to see in real life. You can see the numbers, but I mean, gosh, like if you can. I thought when I moved from New York to here, I thought I saw a lot of EVs out on the streets, but that was just something else. But no, absolutely. I mean, I think in the emerging market space, I mean, I don't need to say much in terms of, there is no transition without emerging markets. And we had the earlier presenter here also talk about how there's a leapfrogging happening in emerging markets, and that lends itself very well to labeled bond issuance because they have the projects to do it. They're out there in new funding that they're raising, new projects that they're financing. They're putting these projects out there. And what does that mean? Well, like on the flip side of that, we're saying issuances, as a share of sort of those respective markets that actually outstrips Europe in some cases. So you look at, dollar Asia credit space, it's like running up to 25-30% in some years over the past few years, and it's still going quite strong. Same thing in EM credit as well. And so we manage a bunch of EM impact strategies, and the amount of issuance that's coming out there is like it gives us that sort of that opportunity and room to play with. And Sean was alluding to the number of sovereign green bonds as well. Same thing there. Like more sovereigns issue, it makes us it makes our life easier in terms of managing these strategies, because that's what our clients are looking to invest in as well, right? Now within that, and I'd be remiss within sort of emerging markets if you don't also talk about the amount of nature-based projects that are available. Partly also because of where they're located, but partly as they're big issuers in general as well. And there, I think we're in this stage where in EM and in DM, there's enough labeled bond issuances that have enough allocation to nature-based outcomes and nature-based solutions, as well as sort of climate adaptation as well, that you can construct a investable universe out of it. And this is sort of something fairly in the public market space. And when you think about nature solutions, historically people have thought about it more in the private space. It's quite exciting to see that market develop. and be able to sort of construct portfolios with it. And so we recently published a paper on this as well, called Bonds and Boundaries, where we're sort of we highlight how best to deploy that capital there and how best we can construct solutions for our clients. So it's quite exciting. And then also, I haven't even mentioned the nature-based guidelines published by ICMA as well. So all of that's happening. COP in Brazil this year. So I expect sort of this trend to continue, and the opportunities there will be tremendous in coming days.
Jake, do you have any thoughts about that?
I just think how important that point is on the conversation shifted slightly towards the hard-to-abate sectors, transition. If you know about the histories of Federated Hermes and the Hermes part, it's all about engagement. If you do engagement, really, that's about transition, and not just climate transition, but basically the transition from unsustainable to sustainable. Saying earlier how we don't have a labeled bond fund, but what we need is not sustainable securities, but sustainable companies. The label is useful because, firstly, it gives us evidence and more conviction that a company is basically putting its money where its mouth is. Also, I have a particular focus on high yield, and often the green bond framework or the reporting and apparatus around that is sometimes the main or the only source of information we can get from some of those companies. And the third one is on the transition, and I think also very important for emerging markets, where maybe a company that you maybe wouldn't normally put into a kind of sustainable fund, but if you have that evidence in the green bond behind it, then this, especially with the new ESMA rules and the ability to potentially to look through, labelled issuance from brown-ish sectors is now incredibly important.
Malika, so we're sort of bleeding now into disclosure and regulation. Would you like to, I know you've done a lot of work on various working groups.
Yes, so I think the topic of transition and biodiversity is very well developing further, so we will probably see quite a few developments coming towards our way. So I work with ICMA. I'm part of BNP Paribas is part of the ex-Gazprom group, and I'm one of the coordinators of the climate transition work that we're currently doing with ICMA. So we are trying to introduce and welcome the companies that really focus and then work within the hard-to-abate sectors. So at the end of the day, what is a sustainable finance market? It's basically, we would like to see where the impact and the additionality is. So if we have issuers actually willing to report and that engage with investors and to provide this impact reporting and allocation reporting on a regular basis, I think we should welcome that. So this transparency is really needed to be supported, but hopefully this will be as a separate label. So the transition bond should be a separate label in our view, and then the sectors should only focus on fossil fuel. We shouldn't really mix green bonds with transition bonds. So this is something that will hopefully see a clearer guidance from ICMA. Also, this will be supported hopefully by the carbon accounting that PCAF has been working on for a few months now. So I was part of the working group on the standardization of the methodological approach for the avoided emission, also carbon footprint for green bonds, and also the issuer level carbon accounting for sub-sovereign issues. So hopefully PCAF will successfully publish the papers and the standards that they've had already gone through the consultation period. And then also we're actually, so very much looking forward to see what SFDR will bring, what changes will bring towards our way, given that we're all waiting for this November publication and that the Articles 8 and 9 will be changed. So, which means that we will probably see more impact sustainable than transition and ESG. So, which means that hopefully there will be some sort of a coherence on the market that if it's a transition fund, it could potentially include those transition bonds from the fixed income point of view, and then this will be a clearer situation in terms of it's not, and we really hope that SFDR will be different from SDR, because SDR is really quite difficult to implement. It's really principle-based. It's not it's difficult for the clients to understand the comparability between the asset managers, given that the principles are really very specific and individual towards the ambition of the investors. That's why we hope that SFDR will really be more similar towards the regional guidance, what we see in Europe, and it's not going to be principle-based. It might be stringent still, but it will be a clear guidance that will be really simplified, very clarified towards our way that how we can actually build our ambition and how can we define what is sustainable investment, what is the impact, and what is the additionality, and what it's really not. So hopefully this will really come towards the way of a lot of investors and will make our life easier, because at the moment the regulation is very challenging. It lacks a lot of clarification, and then hopefully this is something that will clarify not only the investors' opinions and then overall the structuring of our funds, but also how we can communicate this to our clients, and also how we can include this in our engagement with a lot of issues.
Karen, can I add something really quickly on the regulation piece? I think, and couldn't agree more on sort of the SFDR 2.0 and how important that will be. But I think something in terms of a clear signal from a regulator, or something that was a little bit underreported, I must say, I felt this year was the Hong Kong Insurance Authority and their haircut for green bonds as part of their risk-based capital assessment, and it's quite big. In the sense that it's a regulator coming out and saying, if you own green bonds in your book, you can take a haircut out of it, and as part of the collateral that you need to put up, and that's as clear a signal as you can get from a regulator. And I don't know what will happen with Solvency II and PRA, obviously, but something like that is as clear a signal as you can get in SFDR 2.0. Hopefully, I mean, it won't be the same thing, but clarity there will be super helpful.
And may I just add on the biodiversity, since it's a climate bond initiative conference, so I really, it's great to see CBI to actually providing a guidance in terms of the biodiversity, and then the criteria that should really be eligible or not eligible, aligned, not aligned, but that we would really like to see more guidance on the biodiversity, and please include more biodiversity related categories, because we've seen that regional regulators, and for example, we have one in France, set by the by the Ministry of Environment, and they really use CBI as a guidance. So we would really like to see more biodiversity-related categories included in CBI's guidance, and then hopefully this will translate into a wider scope of the regional regulators, because at the moment, having biodiversity just focused on the organic agriculture, water, and forestry, it's quite tough, really, because a lot of issues actually provide this something. They have a biodiversity-related category in their framework, and there's no clear breakdown of what they include in the biodiversity. So if there is either a clearer in terms of a reporting that's provided by issues, or I really hope CBI could actually work on it further. Thanks.
Christina, did you want to make a comment on regulation?
Yeah, just on regulation, there's that kind of a healthy tension between having some rules, but then also having principles-based, because in a way the principle-based, as ambiguous as it can feel, it also allows for innovation, it allows for growth of the sector and evolution. So there's always kind of a push and pull there. What I think, if we think about impact generally and transitioning the whole planet, I mean, this is really a complex, it's non-linear. So having, I think, principles is also a good anchor, and then having some room for interpretation, as long as you can back it up with scientific and approaches and data. I think it's important to not stifle innovation. I think it is, as much as comforting it is to just do it kind of tick box. It's not just tick box, but rules can feel that way. I think that's one thing. And if we think about some of the most sustainable companies in the world, they do say that the hurdle for issuing a green bond is very high. They need to make sure, if you're a global company with thousands of factories, you need to collect all the data at the factory level, then you have to then amalgamate it and then, have the reporting. It's not easy. That hurdle can be very high. And so, in a way, having a transition bond or SLBs, I think it's good to have a menu so that at least something is happening and we're moving in the right direction. If the hurdle is too high and too black and white, that can also be a problem. So I agree with Malika on several points there, but I also think that sometimes the healthy ambiguity is good. Jake, you were wanting to...
I agree with that
Yeah.
completely. I think that the aim of regulation should be to reduce greenwashing, but not eliminate it. Because in order to do that, you create such a stifling environment that you basically kill innovation. And we're better off having an imperfect market of trillions than a perfect market of millions.
Yeah.
So yeah, obviously everyone is waiting to see what happens with the SFDR, but it can hopefully really only be an improvement from where it is now.
Yeah. No, I agree.
So let's talk about the elephant in the room, well, at least for me, coming from the Republic of California, where we are doing climate disclosure, or about to. Let's talk about the US and, how do you see what's happening? It's been discussed already this morning. Is that going to just be a little bit of a slowdown and an anchor in the US for maybe, hopefully, a couple of years? What's your perspective? Ashwin, you want to?
Yeah, I think on the labeled bond space, I mean, it historically was always, a market where the issuance was it's a big market, and as a share of that market is always a little small, and now it's smaller still. I don't know if I foresee that to change necessarily, but I will say, I mean, going back to the earlier presentations as well, I mean, the secular trends, when it comes to power needs and what the cheapest sources of power that are out there and fastest sources of power out there to deploy is self-evident. And so, as with the data center built out in the U.S., there's a lot of opportunity to sort of, ensure that that's powered by green. And I know many investors are looking at that, and many of our clients are looking at that as well. And so it's certainly a big opportunity, and it'll play out over some time.
I wasn't at New York Climate Week, but maybe some of you were.
No.
But it seemed like the word that came out of it was like practicality.
Yeah.
That's what everything I read was with practicality. That's what everyone was saying on the panels. And I worry a bit that that's a code word for being less ambitious. Only set a target if you've basically worked out where every ton of carbon is going to come from. You'll achieve it. I just think there's nothing wrong with setting how many industries have no current pathway to get to net zero, but it's still okay to make that commitment. And I'm worried that that's the way it's given sort of authorization to companies to only set those targets where they know they'll get there, and then there's this massive chunk of carbon after that where they have no target and don't know what's going to happen, and they won't talk about it.
I think asset owners that have already committed to the space continue to be just as committed. So while some of the alliances in the asset management industry or in the banking side have come under pressure and are suspended or dissolved, asset owners are still totally with it. And companies that have committed to that journey have not changed their targets at all. And the rest is really, how is the asset management industry? We're still learning about the state. We're still committed to the space. But what's interesting, I find, is just to give an example. So in Japan, for example, as much as the government has committed to decarbonization and has embedded that in an industrial and economic policy, they have not got any labeled strategies, so they have stayed away from any SFDR, Article 8 or 9. They've kept this creative ambiguity, and that's all fine in terms of allowing the space for companies to interpret and investors. But it's almost too much space. So a lot of the asset managers and that industry has been a bit late to the table in terms of learning about the different data requirements, or how to analyze different bonds, how to analyze a company's stage of their journey, because they haven't had that pressure. So it works both ways. You can have sometimes too much ambiguity. It leaves too much space, and then there's less. Because some of this stuff, it's just complicated. I mean, you know, when we have a new issuance, I mean, sometimes it's just not clear cut, and you have to take a stand, and sometimes it's complex. And not for green bonds. Usually that's quite clear cut. But when it comes to SLBs or transition bonds, is this a real transition, or is it? You know, it's complex. So yeah. So. Sorry, I've talked too much.
I fully agree with Christina. So I fully agree with you that it's very, very complex. But at the end of the day, we should really welcome. So if there is a label bond issuance, it actually brings in an additional disclosure, additional transparency. And I think here the engagement is the key. So the engagement, what we actually have with issuers, is really important. And interesting that you used the Japanese government as an example, because I've met, thanks to Sean, I've actually met quite a few times this year, and then this continuous engagement is very important. And I've asked that, and I was really happy to see that the Japanese government decided not to issue a green bond, and then really include those hard to abate sectors, and then really something that shouldn't really be part of the green bond. But then I've asked them, in terms of the transition, where do you see yourself in a few years? So what's the goal? That, okay, so you're trying to transition, you've issued the transition bond, we appreciate the additional transparency and the disclosure. When you manage to progress with the transition, are you willing to issue a green bond? And I received the answer, no. So it is a complex. And in our opinion, it's really the ambition of the issuers. That's what we really would like to see. And then the coherence. So this coherence in terms of the ambition of the issuers, and then the selection of the projects, which projects that they include in their label bonds, whether that's transition or green or any other bond or use of proceeds. SLB for governments, I think this is the real issuance that should really be at the issuer level. We would like to see transition and improvement and the ambition at the issuer level. And unfortunately, the SLB instrument is not really something that is still a favorite instrument for sovereigns. As a sovereign ESG analyst, I communicate this to a lot of sovereign issuers, that we would really like you to issue an SLB and improve, and really would like to see this market to grow further, because that's where we would like. We have seen Sweden issuing a green bond in 2020. They haven't built the curve. What was the point? What was the point of that green bond? It was a marketing element. So that's what we don't want to see. We actually, it is complex, but it needs to be something that is going to tell us a very simple story.
Yeah. And consistent, yeah.
Thank you.
Thank you, everybody. So I see we're running out of time. Really appreciate all of your comments. Thank you. I think what we'll do now is we have a couple of runners in the audience. We'll take some questions and then have our panel address them. So please feel free to, we have one here. Chime in, and I'm not sure how we're doing online, folks.
So Aaron Kelschke from Invesco. So thanks very much for sharing your insights on the panel. If I think about the public fixed income market, it's about a market of about 140 trillion. If I think about the private credit market, it's a market of about 3 trillion, thereabouts. I think about the focus of where asset allocators are going. They are tending towards private markets, the sort of higher risk-adjusted returns with greater diversification. Given the fact that we've got that liquidity spectrum across fixed income, we've got private placements, we've got hybrids. How are the panel thinking about that as we're trying to meet the requirements of asset owners as they transition more across to private markets? Thanks.
Thank you.
Yeah.
have another question here.
Shall we? Yeah.
I'll take a few questions,
Oh,
and
okay.
then we'll...
Good morning, everyone. Good morning, everyone. I'm audible?
morning.
Yeah, so my question is to the panel. In fact, many thanks for helping us to understand that the global tailwinds are there in terms of attracting more capital for green and clean activities. But just a thought, is it maybe the reason because the many times momentum is already built, you know? Mr. Trump has come almost 2 years back, 1 year back, and maybe by the time he came, the tap is already open, there's water in the pipeline, you know? And now he's squeezing up, he's closing the tap. Do you think that after 1 year, the similar inflows of the fund may dry down? I mean, just thought, can anybody refurbish it or complement it? Thank you.
Seems all the questions are from this corner of the room. I'm Lucy Summerfield from S&P Dow Jones Indices. How much demand are you seeing for scrutiny of post-issuance reporting on the bond side? Obviously, the data is patchy at best, and there's not a unified way in which that reporting is done, but it is definitely a way to assess credibility of an issuance. So how much are you focusing on that, and especially on a portfolio attribution level? Do you do any reporting on what the impact has been of your investments?
Great question. Yeah. Let's take one more in the back, and then we'll start to address the questions. Do we have another one? Thank you.
Is it working? Yeah, hi. Hi, I'm Vibhav from Up Energy Group. We're a carbon project developer, and I'm currently working on issuance of an Article 6 linked climate bond with a multilateral bank as an issuer. And I think my question to you is, so like Christina mentioned, that it is complex. Actually, from a project developer's perspective, it is incredibly complex and time consuming. So as a team, we have worked on this for this bond issuance that I'm working on for over a year now. And in terms of the project life cycle and carbon issuance, the process, because of this process, the project has suffered. So from an investor perspective, do you see this complexity going away as climate bonds become more common? And also, are you seeing interim products? For example, in our situation, the ability to have a kind of bridge financing for this year would have been better for the project and better for investors who are going to come into this bond as well. So, thanks.
All right, let's start to tackle some of these. So Christina, you wanted to jump in on the S&P, the post-issuance?
Yeah, so we're a big data house. I mean, Man Group, we, because of the amount of systematic assets we trade, we buy a lot of data, we harmonize a lot of data, we process a lot of data. So data. And running an impact strategy, we look at a lot of data. We have, over 22 vendors just on the climate stuff, and look at all kinds of, we slice and dice it. And you are right that post-issuance, what's the reporting like? We are following that, and some of it is patchy. Then, of course, engagement comes in. We speak to the issuer. Sometimes we triangulate the data by using alternative data through other sources, and there's new. I don't know if you've heard of this avoided emissions platform. It's a new database that's being developed to look at emission factors across all kinds of technologies. And it's a very kind of modular database, so you can, as long as you know what the activity is, where it is, you can actually use that emission factor to make an estimate. Of course, with every estimate there's an issue, but as long as it's the same systematic emission factor across the whole portfolio, you can use it as a guide as well. So we're looking at all factors, and yes. So that's on that.
And may I just add, so we since we have those thematic bond funds, we have to report and produce impact reporting for our funds. So this is a regular annual reporting that we produce, and we actually work with S&P. So quite a lot in terms of how we receive this emission level data. So unfortunately, the emission level data, what we see for now, and why we like working with S&P in terms of the data that we, there's so many different methodologies in the calculation of void emissions. It was one of the reasons why I joined the BCAF's work, and we would like to see this standardized. But what we were using up until now, that S&P would provide us with the reported data that would collect it from the impact report, and also estimate this data based on the cycles and then all the different type of categories. So we would actually use it in our reporting, what we have collected from impact reports of all the issues at the exposed level. We have a bond-by-bond approach. We look at every single bond and analyze at the exposed, because this is really the strength of green bonds. So we show what is estimated and what is reported, and there is a big difference. So this is something that we have to show, and hopefully when PCAF publishes this guidance, we will see in terms of what sort of a standardization and the methodological approach, hopefully we will receive. Yes, I agree. So there is a platform that quite a few investors, Robeco and Mirova, they try to build with other data providers, but it's a paid platform, and it's not a widely available data. So the data that issuers report in impact reports, it's basically for free. So a lot of investors can use it. But also another metric that we really need to see, and we've published a paper on that, is the carbon footprint broken by scopes 1, 2, and 3 that can be reported by issuers as part of the impact and allocation report. ICMA provides these guidance, but it's not a core indicator of the impact reporting framework. We would like to see the carbon footprint being the core indicator so that issuers could start reporting this data in addition to the avoided emissions. The reason is that those investors that have taken a commitment, the net zero commitment, we need to show how we are decarbonizing our portfolios. Climate and then, green bonds is a very strong climate solution. If we incentivize our portfolio managers to invest into a green bond, it means they're trying to address this climate issue, but we also need the data, relevant data, to show how our funds are decarbonizing. So that's why we need this credible, as of now, metric, because avoided emission will always remain a positive but forward-looking estimation.
Let's take the capital allocation question. Would one of you two like to address capital allocation across asset classes?
So I work in the public markets, and obviously there's sort of a tremendous opportunity in the private credit space as well, particularly with the new build out in data centers as well that's happening. Can't speak much to that, but going back to sort of a couple of questions here on ex post sort of reporting for green bonds in particular, I'll say a couple of things there. One is it is an intensive process that my team spends months every year doing, and it's before the issuance, talking to the underwriter, talking to the issuer, after the issuance, and that's part of portfolio management, and that's part of sort of impact management, right? And so we're incredibly proud of the work that we do there, and the impact reporting that we provide to our clients. We're looking to use technology where we can and AI where we can, but we want to know and talk to the issuers and engage with them and sort of be sure of the impact that's associated with the green bond investments that we're making. On that same note, actually, in terms of sort of the gentleman in the back there asked the question around difficulties of issuing as a first-time issuer, and I think it's a feedback that we've heard a lot in the past, but I think after that first time, once you set up the framework, the second issuance is always a lot easier. You have the sort of you have the rails already, and then sort of it's much easier to build out the curve as well. And then with regards to whether the tap is on or not, the gentleman asked in the beginning. I don't believe so. I do think there's, talking to issuers, talking to sort of underwriters, the pipeline is quite strong heading into next year as well. And I don't think it's just remnants, because going back to sort of that secular transformation that's happening, there are projects that need to be financed in the public markets, and that need to, that can be funded with green bonds, and there's investor appetite, there's sort of issuer appetite, and there's everyone's sort of interests are aligned there, so to speak, in doing so.
Thank you.
I wanted to, just on the asset allocation point on private versus public, just one stat I want to leave you with. So when you look at just Scope 1 emissions of the largest tradable issuers in the world, okay? And by tradable, they have some tradable bonds or they have some listed equity that's tradable. We have a huge database, and 83% of the tradable universe, so these will be large issuers. Some of them might be state-owned. They might be not have a listed equity, but they have a lot of bonds out there. So that's for a lot of, for example, emerging market issuers. So they issue bonds. And 83% of Scope 1 emissions of the world by these tradable, so these tradable issuers account for 83% of the whole planet's Scope 1 emissions. So we have that data point. What I'm trying to say here is that, yes, there are a lot of asset owners and asset allocators that want to look at the private space because of the risk-return angle being attractive and use that for impact. And yes, I agree with reforestation projects in the illiquid space. I think that's all wonderful. But to really move the needle on emissions in the world, we have to tackle the largest issuers, the largest tradable companies, because even just moving one tiny, even just 10 basis points of issuance of those big entities towards green makes an enormous impact. So as much as, yes, I get the private stuff, it's really important. That's where climate bonds come in, and they're doing a great job. Sorry.
Thank you.
And refinancings are allowed, by the way. So like, you could fund a project with private capital initially, refinance that with green bonds, and within a year or two, and then that's allowed as well.
But I think the private is really important because it's really, and it's very important to actually understand where the ESG risk lies, and then whether it's not the actual, for example, issue level, but it's the underlying asset that needs to be assessed.
Yeah. Thank you, everybody. We're between your break, and I really like to thank our panelists, all of you, for participating.
We'll have a short coffee break now. Please.
Thank you, everybody.
Thanks
very much.
Join us for a fireside chat in a few minutes. Oh my God, fantastic. There's nothing so bad as not being able to be heard. Luckily, on this panel, I'm going to introduce you to someone who needs to be heard. Doris Honold has a long and illustrious career in, well, first risk management as CROs of multiple banks. Formerly Chief Operating Officer of Standard Chartered. Now a board member of UniCredit, one of the world's largest banks. She's also a board member of SEFE, which is the German government's agency, or the German government-owned agency, which runs pipelines for gas in Europe, which is a takeover of the old Gazprom as a result of the conflict with Russia. And also serves at the Integrity Council of Voluntary Carbon Markets, if I've got that acronym wrong, to help design a voluntary carbon system that has greater integrity, more robust, that will do what it needs to do to go forward and gets beyond some of the scandals we've seen in the last few years with lax rules, if you like, tightening all that sort of stuff. And helps by also being a board member of the Saudi Carbon Market Exchange. And I'm going to ask her about that. Saudi Carbon Market Exchange? We're going to find out about that. But she has, of course, the most important role she has, the critical role, is she's the chair of Climate Bonds Initiative Board. However, I'm not coming to get her to talk about climate bonds because I'm nervous what she'll say. I wanted to talk about banking and various other things. We're just going to talk for a few minutes before we then move on to the session on national climate plans. Thanks for joining me.
Thank you, Sean.
Is that audio for Doris okay at the back, Lily? Can you hear Doris?
Hello, hello, hello.
Oh, thank goodness me.
Hello, everyone.
So, Doris, one of the reasons I thought we should get you here is because of your experience in the banking sector and your live experience. I mean, constant UniCredit board meetings I appreciate now, let alone the other banking roles you've had recently. There are more board positions. I won't go into details. I'm curious to see what you're seeing. I do realise UniCredit's a bit of an unusual institution. They won an award from Newsweek as the world's greenest financial institution. I don't know what the details are, but clearly something's going on at UniCredit on the positive side of our agenda. But of course, no bank is perfect. And that's the challenge of changing institutions. What do you see happening, especially for all this talk about the US and Net Zero Banking Alliance and so on? What's your perception in the banking sector generally of where we are, where we're going, and the role of banks?
Thank you, thank you. What's going on in banks? You know, banks are here to finance the economy. You know, with the ultimate purpose is to, you know, help countries, companies, and individuals grow. And they have also a stake in the climate transition. Of course, the thing is, banks are financing the real economy. So if the real economy is a mix, they cannot totally focus on green. So what banks' role is ultimately to work with their clients. And you have kind of a whole range of spectrum. You have the green ones, the darlings. Everybody loves them. Everybody likes to finance them. We heard Kingsmill. They are now the first defaults, so that's going to be a little bit of a green bubble that's bursting. Then there are the let's call them the ones not aware, don't care, don't talk to me about transition plans. Banks have been working on disengaging with them, but that's only a small percentage. I think we have small percentage on the really good and on the really bad side. And the real work for banks is to work with the big blob in the middle and engage with them and say, how do you transition? And I think the big blob is also very interested. I think they want to transition, but they need help with how to do it and how to finance it. So I think this is where banks come in. Now, to your point, what happened with the Net Zero Banking Alliance and banks disengaging, it's difficult if you use banks as kind of a policy instrument, especially if you look at global banks. There are different stakeholders. There are the shareholders, the NGOs, governments, and different regulators. And if you look, for example, at JP Morgan, I had a coffee with a good friend with JP Morgan 12, 18 months ago, and he said, you know, Doris, we've just been excluded from a state bond auction because we are perceived to be too woke, too green, too ESG, whereas here in London, we have everyday activists in front of the door for our fossil financing. So I think banks are in a very difficult position to navigate this, I'd say, globally fragmented policy framework. And maybe my last point on banks, banks have their business of financing the economy. Yes, they want to help banks transition, but of course they also have a self-interest with respect to a disorderly transition, too many defaults, real economic chaos isn't helpful for them. And there is this symbiotic relationship, in my view. Christine Lagarde a few years said, climate risk is an existential threat to financial stability. When then the other side said, you must be kidding. I mean, banks have been bankrolling fossil industry for decades, and now we are the problem. So, but that just shows, they need each other. The climate transition needs banks to help engage with finance and pushing then, and banks need an orderly climate transition. So there's a natural self-interest to some extent.
So the engagement side of then becomes the role of banks. I mean, I'm going to say, my first thought when you say orderly transition, it's not all parts of banks. I do remember in 2009, one of my friends is a senior banker in one of the world's largest banks, said to me, isn't it terrible the way stock exchanges have collapsed? Isn't it terrible the way the market's doing? He says, but you know what? It's been our best quarter ever. So there's that challenge of a bank's role, which is part of the extent of the role they have.
Yeah. No, but of course, some volatility, some disorder creates opportunity, but too much creates chaos.
Yes.
So that's the whole thing about what the balance.
So the engagement side, I think, is the most interesting side. When we think of, when we work in places like Japan, everyone talks transition because with the banks, the three banks in particular are the bankers for the whole of Japan, Mizuho, MUFG and SMBC. And they don't believe they can say no to clients in the way they have their relationships. They want to work with every client. And I think this is a bit of a case in Europe too, isn't it? That people have a long, deep relationship with clients. So it's a question of how to do it. So how do you navigate that engagement? Let's forget about the deep green and the dark brown. All the people who are interested but trying to figure out how to go forward. What does a bank do? How does a bank help?
I mean, it's, for example, Standard Chartered, of course, which I know very well, who made that announcement, I think 2-3 years ago, saying they will only be lending to companies who have a transition plan.
Yep.
So, that's, for example, and that's how you start the dialogue. And I challenged a few and said, how realistic is that? And then he said, of course, the bigger and the more global companies are, the more robust the transition plan is. But our clients really appreciate the dialogue. And of course, then they start to develop a transition plan. They think about it. And then I think that's the starting point for banks, of course, to transition with their clients. Because, if you expect banks to have a net zero portfolio by 2050, it's either two-way. Either you have you transition your clients to net zero, or you transition your portfolio to pretty small, as it's going at the moment. So the emphasis is to work with your clients, to challenge them, to improve the transition plan in every conversation. But also, of course, banks have an outside view. They can add, sector comparisons, saying we're dealing with another clients who are doing that, and we are financing that, for example. So I think they can help a lot with stimulating ideas.
And at UniCredit, I'm not going to ask you to say anything which is not public, but I'm aware that UniCredit's made a lot of public announcements about targets to help the team, the bank, think about that, lending targets and so on.
Yeah, they have several targets with respect to, I'm not sure about the exact label, should be like 15% of the overall portfolio, and they regularly meet that, and I really like that it's a percentage portfolio and not an absolute portfolio. But again, targets, we all know, we all have, arbitraged our performance targets in our individual review. There's always some arbitraging around it. But the important is really the belief in what you're doing and the substance behind it. But yeah, like other banks, they have targets.
But still, they've got a range of targets, and it's a quite good because you're involved in this emission trading scheme. I want to ask you about it in a minute. But first, transition. You talked about the surprise of what's happening, what you planned about transition in Saudi.
Sure. I mean, through my engagement with the regional voluntary carbon market company, I don't know why they all have to have such long names. Of course, I have exposure to Saudis. I talk to Saudis to get a little bit of insight. And I think what's interesting is the Saudis I talk to agree actually with what Kingsmill Bond said.
Right.
Which is
Kingsmill, you heard that here?
not everything, but I thought it was very interesting when he made the point about Trump. Yes. And you know, when I talk about them, what do you think is the impact of what's happening in the U.S.? And I got quite a lot of views with, you know, the U.S. is doing what the U.S. is doing, and you know. It might delay the transition by a few years, it might not. But as Kingsmill said, you cannot stop the trend. And these companies, you know, they're definitely not, I don't want to portray Saudi as climate leaders, but they have their transition plans, they have their strategic investment plans. And they said, we're not going to amend that now because Trump creates noise, et cetera, et cetera. The other thing is, I think, you know, fossil fuel countries, fossil fuel companies, you know, either they die faster than we expect, according to Kingsmill, or they manage to transition, which of course is incredibly difficult, takes a lot of investment, et cetera, et cetera. But I think my observation is that they're very much aware of the trend, and they're thinking about it. I mean, the other example we chatted about is that with Saudi Aramco, of course, they would love to sell oil as long as possible if they are buyers. You know, the demand might drop gradually, then suddenly, or not. But what they're thinking about is, for example, if there's ever going to be a market for low carbon oil or net zero oil, meaning oil combined with carbon offsets, they want to dominate the market. And they say, you know, it might be happening or it might not be happening, but we are preparing for that. And 2 points, they already have the lowest carbon intensity on oil. Again, also is often criticized, but it's something they're very proud of because they achieved that through real investment in their production company, so they have the lowest carbon intensity on oil, and they're investing now already in carbon projects. So they have a pipeline for if this market is ever going to take off, given where the world is going, they're going to dominate it. So, and I think these are just interesting thoughts, observations to have.
In terms of the Kingsmill's comments earlier, I think that's part of understanding how the world is changing in every single corner, no matter the rantings of some infantile, capricious ruler in Washington, D.C. That's the truth of the matter. And I think the talk I've heard speaking to officials in Saudi is that there's no doubt that vehicle use for oil will go down. That doesn't mean they're going to support it, but that's happening. But we'll still be using oil, especially for plastics and for other things by 2050. So they want to be the supplier, and they don't expect to have Petrobras or Alberto suppliers because they're high cost and they're not dealing with things like CCS and emissions reductions. And you know, they're right. We're going to be buying oil in 2040, alas, in some ways. But if we can buy oil that is net zero at least and is better than the others, then that's a damn good thing. So it's really good they're making these productions and these investments. And we do need to be looking generally about how in the fossil fuel sector, in a long period of sweating assets in critically important industries, how we manage that sweating of assets to the maximum ability. So it's a very interesting story. But you've also worked in the emissions trading scheme before. This is the regional organisation.
Yeah.
So they're bringing an emissions trading scheme in Saudi? Is that what's going on?
Yeah, no, there are two things going on. So I'm involved with this carbon market exchange, which is facilitating voluntary carbon market tradings. But Saudi is also planning to start with a compliance scheme and an emission trading scheme by 2027, covering all high emission sectors, oil, gas, cement, et cetera, et cetera. And of course, it's still in the design stage. I'll hope it will be something similar to Singapore, where you have your carbon tax, but part of it can be offset by carbon credits. But I don't have any details. It's just my personal.
No, but just the fact they're doing it is amazing.
Yeah.
As part of it. Of course, that takes us back to energy in general.
Yeah.
And you also serve on the board of SEFE.
Yeah.
You're vice chair, I think. Or
Yeah.
vice chair,
Yeah. Yeah.
which was really Gazprom's pipeline company in Germany was nationalised and put into this entity. What's happening there with transition?
Yeah. I think SEFE, like many other fossil companies, like I said in the beginning, I think they want to transition, but of course it's incredibly complex and not, in my view, not every company will survive or has to survive. What they're doing, because they're owned by German government, so they are part of this German, it's called the Hydrogen Core Network. So, creating a hydrogen pipeline in Germany. They've started to refurbish some of their gas pipelines to make them hydrogen ready. Mm-hmm. By the end of this year, they will have
Which, by the way, qualifies under the European taxonomy as a sustainable investment, just in case you have any doubts.
Okay. So it's actually, I was quite impressed. So by end of this year, they will have converted 400 kilometers.
Right.
It's the first, and by 2030, it's going to be 2,500. So
quite a big capex program.
It's a very, and they're very committed with this capex investment. And of course, this is their transition plan. But of course, hydrogen is extremely challenging. There are green hydrogen suppliers, Brazil and Saudi. Again, they are looking for, if you go into contracts with them for 20, 25 years off-take contracts. But of course, on the other side, it's very difficult to get corporates to say, okay, I buy hydrogen from you for 25 years and we can fix the price now. So there's still something, it's still chicken and egg. I think the pricing is still a bit too expensive. Corporates cannot afford it. Governments cannot fully subsidize it. But hydrogen is, of course, the big transition play for them. And then they're experimenting with different things. They're looking into biomethane. Is that something that can be scaled up? They're exploring, can they transform part of their storages into CO2 storages? Is there a market for CO2 transport? And like banks, they're having a lot of dialogue with their corporates and saying, don't look at us as your gas supplier. Look at us as your partner in the energy transition. These are the ideas we are having. What are you looking at? How do you think you will transition? What do you need? And we will look if we can help you, because we don't want to be your gas supplier. We want to be your energy transition partner. Wow. And so that's, for example, they're also looking into metals, like so many commodities traders, because it's just part, if you transition, you have different needs for metals, et cetera, et cetera. So it's this whole, I think, change of approach. We are your partner on this journey, and let's see how we do. But it's
energy as a service rather than managed as infrastructure is the way the business is going, which is, of course, the way most of the electricity industry is going to and starting to think. So that's it's really interesting. I did note that SEFE won an Energy Transition Organisation of the Year award from someone.
Yeah, they did. They did. Well done them. I don't know. I was very happy to see it. I was also very surprised because, of course, I'm pushing them very hard on their transition, but I also said they need to be honest what they are. And at the moment, they are a gas trading and supplier company with a lot of ambition. But I think they got that award because they're really genuine in their ambition, in their commitment, and in really being this partner for their clients. So they got recognition for that, and well done.
And what you just said about how you're pushing them hard, I think, is exactly why I was keen to have you on the stage today. Because, of course, the way change happens is in the circles we engage in, we push for change and bring ideas into them. Yeah. Truth is, the board's interested in transition, but that doesn't mean they necessarily know how to do it. Not everyone. This is really hard.
Yeah.
And I know you can't tell us about what goes on at the boardroom, but what's the biggest challenge you face in your general pushing around in these boards that you're on about how to drive more change? What's the biggest, the hardest thing?
I think in general, I think in every organization, it's generally it's finding it's always the balance between short term and long term, the balance between keeping your legacy business running because you need the income to invest in change. And that's part of every change and any transformation. And getting this balance of being fast enough to avoid Armageddon, but not killing your cash cow at the moment. And I think it's the same for every company and every corporation. And I think one thought I also had with Kingsmill was it's the short term versus the long term, the short term pain, the short term investment, and you have the long term gain, a livable planet in 50 years. And that's a very hard argument. And that's why I think a new articulation of the benefits of short-term gains will be very important for driving that forward. And I think we have a unique opportunity around this green energy and being clear that green energy means energy security. Energy security means national security, where we are in this world. And national security means economic security. And it means, a competitive economy, healthier population, global respect. So I think, but the key is this energy security, national security, and economic security. And maybe a last point of that, I see that already, but you probably saw that Jamie Dimon's announcement last week, 2 weeks ago, that JP Morgan will invest $1.5 trillion over the next years in industry that will bolster US economic security and resilience. And in essence, that's green energy. He just doesn't say it. He says because that's what we need now. And I just thought, yeah, he does it already, a reframing and highlighting. It's not an uncertain long-term gain. It's a short-term benefit now. So I think that's important.
Fantastic. That's a great spot to finish. Thank you, Doris. Okay. Fantastic. Please, a clap for Doris.
Thank you.
Thank you. I'd now like to invite Yolanda Chung, who's again a Climate Bonds board member and former long sustainability manager of DBS in Singapore, Standard Chartered before that, and so on. Over to you.
Thank you. So can I invite all our fellow panelists onto the stage? So perhaps we can line up according. No, but the two are on stage. So okay, maybe you're here, and then Rob here, me, and then you.
I go at the end. Over here. Very good.
Okay, thanks. Hello. How are you?
Very good. All right, we've got a fantastic lineup of panelists, both on stage and online. Can I just check if the two joining online are already on?
Get a thumbs up from back there.
Thumbs up? Okay, marvelous. Well, today we have about an hour to talk about sovereigns. I think when it comes to sovereigns fundraising for climate investment strategies, for a lot of the investors in the room, they might think, okay, sovereigns really, a big part of your portfolio, but when it comes to assessing sovereigns, it's a lot more complicated than assessing corporates, because with corporates, you can draw a very neat boundary around it. They might be in one or two sectors. You can look at their core competencies. They can look at their eligible economic activities that will be qualified as green, etc. So it's quite neat and tidy in assessing corporates. But when it comes to assessing sovereigns, there are many sectors involved. They have different emission pathways. They have different climate policies, some enabling, some prohibiting. So I think today's panel, we have, first of all, two online speakers who can tell us what their countries are doing. So with that, can I turn to Anders, who is representing the Danish Ministry of Green Transition, and tell us where Denmark is in their transition journey. If Anders is not ready yet, I can turn to Australia. So, Shell, are you on?
Yes, I'm online. Can you hear me? Yes, I'm online. Can you hear me?
Not yet? Okay. Okay. Great. Shell Lyons, can you hear us properly?
Yes, I can hear you. Can you hear me?
Testing again. Yes. Can you hear us? Can you speak and see we can't hear you.
You can't hear me. Okay.
Not yet. Try again. Is it from you or on our side? How about this? Let me be very adaptable. Can I go to our speakers on stage first and start with Claire? Claire, you are the investment director for ESCO, assessing sovereigns' climate-related opportunities and risks. It took me a little while to memorize the acronym, what it stands for. I read up a little bit about ESCO. It's investor-led and now adopted by investors. It's got quite a clear but straightforward way of assessing sovereigns to make it comparable for investors' use. Can you tell us what ESCO is?
Sure. Well, you got the acronym right, so that's half the battle. Assessing sovereign climate-related opportunities and risks. And like you said, it is a climate-led framework for assessing sovereigns in a comprehensive and comparable manner. How we start that, let's talk about the framework a bit. So it's on 3 pillars. It is emissions pathways, climate policies, and climate finance. And within those 3 pillars, we delve down into indicators and metrics. And those all lead to a binary yes or no that is supported by public data. And the research is done by the wonderful Transition Pathways Initiative Center at LSE. And they do this research and throughout the kind of assessment period and digging through the open source primary source information to confirm that yes or no results. And it's supported by kind of the structure of the framework. And that is using publicly available data, clear and accessible to investors, prioritizing easily interpretable answers, objectively evaluating using a transparent methodology, avoiding unnecessary reporting burdens on the sovereign entities, pitched at the national level, and focused on the sovereign management of climate risk and opportunities rather than physical risk exposure. And as what Yolanda was bringing up, we're looking at 85 countries. And so this is a very broad set of countries with very differing economic development levels. And so I think it is very important to note that ASCOR adheres to the principle of common but differentiated responsibilities and respective capabilities. And this is enshrined in the United Nations Framework Convention on Climate Change. And that helps us look at countries from very developed markets to emerging markets and understand what indicators and what levels of progress might be most important, most relevant for those countries based on those development levels. And as Yolanda had mentioned, this was very much driven by the asset manager, asset owner community. We had a group of asset managers and asset owners that were sitting around looking at all the scrutiny on the corporate sector and really seeking out a framework that would allow them to address their sovereign bond portfolios.
So I know that using the ASCOR framework, actually there is no one aggregated score for countries. And what you've explained now, the common but differentiated responsibilities, do you find that when investors use ASCOR, sometimes they just look at aspects of it? So for example, if you're comparing China versus Pakistan, you will be not looking at a score per se, you're looking at different criteria enshrined in the framework that is important to you as an investor. How do they use it?
Well, very much so. So asset managers, they were very, involved in the formation of this framework. And they are looking at it and specific countries, comparing across kind of maybe economic development or their regional exposure or such as that. But investors are using it as part of their portfolio decisions by analyzing, what they're looking for, bringing it into their maybe proprietary methodology in-house, but using it as they see fit. And that, I think, is what is important for the ASCOR framework, is you have all these indicators, you have this robust, academically based framework, but the asset managers still have the power to look at it and think about it in terms of how they want to have the climate tilt on their portfolios. Maybe they're just DM investors or they're EM investors, but it really empowers the investment manager to use it how they want to express their views and the views of their clients through the framework.
Yeah. So with that explanation, I think it would be a good time to hear from Shell to talk about Australia. Where is Australia in its transition journey? And then I'm going to ask Claire, how do you rate it?
Thanks, Yolanda, and I hope my audio is now working. I'm absolutely... Thanks, Yolanda.
We still can't hear you.
That's very frustrating.
Okay, rank up your volume. We can just about hear you.
Okay, great.
Lovely. We can hear you very well.
Excellent. I'm very pleased. I'm delighted to be here. I'm sorry that I'm joining you from Australia and not there in person. I'm especially delighted because I've just finished moving house, and listening to this forum has been a very welcome distraction from the ocean of boxes I have to unpack. But I'm very excited to have the opportunity to talk about the Australian government's transition. And we're taking very strong action on climate change to build a safe and prosperous future. So Australia has a target of 82% renewable energy by 2030. And we recently released a 2035 NDC, which targets 62 to 70% below 2005 levels by 2035. And we have a real variety of policy measures underpinning those targets. So chief among them is our capacity investment scheme, which is a revenue underwriting scheme, which supports $73 billion of investment in our electricity sector to unlock 40 gigawatts of wind, solar and storage. We are world leaders in rooftop solar and renewable expertise. 1 in 3 Australian homes now have rooftop solar. And Australians are installing home batteries at an unprecedented rate. Over 50,000 households have installed home batteries since the government's Cheaper Home Batteries program started on July 1 this year. So that's in less than 4 months. Australia is also unlocking new net zero industries through a $22.7 billion Future Made in Australia plan. And just recently in September, the Australian government outlined the next steps to act on climate change and seize the economic opportunity to attract investment and oversee an orderly net zero transition. And this includes the release of a number of critical documents to help provide investors with the certainty and information they need to allocate capital in Australia over the long term, including the first national climate risk assessment, which helps us to understand the biggest climate risks that we face domestically across a range of sectors, a national adaptation plan, which guides how Australia will respond to those risks, so that communities are safer in the new normal that we will see in future climate scenarios. And our net zero plan sets out how we'll achieve a fair, orderly and efficient transition. It provides a framework for action that builds on Australia's natural strengths to ensure that all Australians benefit. And as well, along with our 2035 emissions reduction target and our work with international partners, including our bid to secure COP31 in partnership with Pacific Island countries, there's a real range of measures that show that we are really ready for climate action and ready to partner with investors in this transition. Australia believes that, the Australian government believes that climate action makes economic sense at every level, from the household budget to the nation's economy. So I'll sort of leave that overview there, and very happy to be interrogated further about it.
Yeah, I think what you've described is really multi-sectoral, and it goes from corporates to households and adding up to what the nation is committing to tackle climate change. I want to understand a little bit, you represent the Australian Department of Climate Change, Energy, Environment and Water. How does that ministry or department work across ministries to ensure that the NDCs get delivered and that you can build a pipeline of investable projects? Because you're really touching many different departments.
Absolutely, Yolanda. That's a really great question. And the Department of Climate Change, Environment, Energy and Water that I'm housed in is responsible for leading domestic and international climate change policy, but we work very closely with a number of other departments across government. So we have the Department of Foreign Affairs and Trade that leads on the trade aspects and development and climate finance. We have the Treasury that leads work on sustainable finance and green bonds. We have Austrade that is focused on, that inbound investment to Australia. We have the Department of Industry, Science and Research that leads sort of industrial policy within Australia. So, it's really pivotal that that Q coordinates across all of those agencies and, ensures that, all of the policy and regulatory settings are aligned so that Australia's transition moves forward as quickly as it can. And that, does present a challenge for all governments. And it definitely presents a challenge domestically, but also internationally when we're looking to engage with partners who have very, different departmental structures. And the last point I'd add on that is that, Australia is, a Commonwealth has a series of governments. So we have Commonwealth governments, state governments, and local governments that all have various responsibilities around climate change. So that coordination aspect is incredibly important in aligning kind of capital flows and investment into Australia and around our region.
Great. It sounds like they score very high for Pillar 1 emissions pathway, and hopefully they're Pillar 3 for climate finance as well, because the projects that they are putting together representing what the nations need for mitigation and adaptation really amount to a very comprehensive transition plan for investors to invest in. Now, let me check if Anders, representing Denmark, is online.
I am.
Yes, you are, and we can see you. Now, let's see if we can hear you.
Can you hear me?
A little bit louder, maybe?
This better?
Yes, now, yeah, we can hear you now, very clear.
Right.
So, Anders, you represent the Ministry of Green Transition, and your area of expertise is agriculture. So I want to start by asking, where is Denmark in the emission reduction pathway? There are so many sectors that Denmark can be seen as a leader: offshore wind, green hydrogen, and also in your area of expertise, agriculture, the pork industry. How do they all add up to Denmark's very ambitious 70% reduction by 2030?
Right, thank you for that question, and thank you for having me. As you may know, I'm stepping in for a colleague who's fallen ill today, so I hope you'll bear with me should I be badly tuned into your discussions prior to this intervention. Let me give you a brief overview over where we stand in Denmark. And so, as you mentioned, we have this 70% target on carbon dioxide equivalent emissions. And over the last years, we have set up reduction targets on a number of sectors, on a number of industries. We've had a tax reform transforming taxation on the transportation sector. We have a carbon dioxide tax on manufacturing. We have new taxes on road, air transportation. Also, as you might have noticed, a few years back, we had a very ambitious meeting in the harbor city of Esbjerg, where we launched with the president of the commission an initiative on offshore wind. We have a very high ambition level on that in that domain. So all of these initiatives are going to contribute to our carbon dioxide equivalent emissions. Now, as you may know, when we look at the prognosis for carbon dioxide emissions in 2050 at the European level, agriculture will be one of the largest sectors. When we looked at our emission prognoses a few years back in Denmark, we were looking at Danish agriculture accounting for 45% of greenhouse gas emissions as early as 2030, because we're reducing in other sectors and we need to implement reductions in agriculture and food industry. And so last year, a number of parties came together and formed an agreement on green transition in Denmark. And these parties were agriculture, farmers, food industry, trade unions, Confederation of Industry, municipal government, and national government. And so they came together and agreed on targets for reduction of nitrogen, which is not so relevant in this discussion, but certainly greenhouse gas reduction of greenhouse gas emissions. And so if I could ask for the first of my slides to be shown on the screen, this might help to give you an overview. Is that possible?
Yes, we are
and
seeing
so
your slides.
if we take one step further down, next slide, please. There. So you see we have these challenges, but these are also the challenges that all the parties addressed in this agreement on a green transition. And I show you this slide just to tell you, to give you an impression of the scope of this agreement. It's a very broad agreement. It's not only on reduction of greenhouse gas emission, it's also on creating a better aquatic environment. It's also to work on the loss of nature and biological diversity. So in the agreement, you'll find goals for more nature, more natural and semi-natural habitat, and more forest. We have a goal for 1 billion trees, more than today in 2045. So we have a very ambitious plan, and also we are introducing the world's first carbon tax on livestock and peatlands, introducing by, roundly speaking, by 2030. And so the bottom line is we'll be taking out 15% of farmland, taking that out of production. That's the equivalent of 10% of Danish land area, which will be converted into nature, forest, and wetlands. I think on a European scale, the equivalent would be to take out farmland the size of Italy, and after that cover Germany and the Netherlands in forest and wetlands and natural and semi-natural habitats. And so one of the cornerstones in this initiative is, of course, to reduce greenhouse gas emissions. And to support all this, we've set up a green area fund of approximately 6 billion euros over 7 years, which will fund the land transition with subsidies to farmers, notably.
So what is really interesting that you've presented here is that you have made explicit the trade-offs. You know, you're talking about the potential loss of competitiveness, especially how rural families and farming could be negatively affected. When it comes to the debate around the trade-offs, how does Denmark try to strike this balance to ensure that you are meeting your 70% reduction ambitious target versus the degrowth for certain sectors?
Well, first of all, to achieve the 70% targets, let me talk about agriculture and food industry. We've set up a very detailed implementation plan. First of all, we have some digital instruments which allow us to measure the expected impact of re-wetting peatlands, for instance. We have set up 23 local bodies, decision-making bodies, where municipal governments, farmers, and NGOs meet to draft up plans for each local area. They have done this for the whole country by the end of this year. And so the parties are committed to this transition, which is the cornerstone of this model. Local commitment from all parties. And I think we are very happy to see that it actually works. Maybe we're even a little bit surprised, but it's actually working. And within 2 weeks, we will have plans for the whole country from all 23 local bodies. That's something.
So let me now turn to Rob Patalano. You head up the Center for Economic Transition Expertise. Can you tell us, in the course of conducting a lot of research in this area about sovereign transition, what are the challenges of building climate investment strategies and aligning it to NDCs?
Sure. So first of all, thank you. It's great to be here. And it's impressive to see how many people are here voluntarily to hear about climate and transition plans. I was in DC last week, and it was a very different vibe. So wonderful to see that you're all engaged in this, and it's very important you're all here. The other thing too, it's fascinating that you're all here in part. So NDCs and investment strategies are supposed to be in part for you. They're also for corporates, but it's supposed to be building investor interest and investor confidence. So it's great to see that you're here and you're eager to hear about that. So I'm going to talk a little bit about that. And also, for what it's worth, my perspective is from CTEX, but also reflecting a lot of literature out there, OECD, IMF, BIS, et cetera, et cetera. So I would say, first of all, this year, the 2025, the NDC updates is a great opportunity to look more closely at the NDCs and the level of ambition. And also, governments are supposed to then turn to national climate investment strategies, and those strategies are supposed to guide or go along with sectoral pathways that they are developing. So you all have much more confidence in understanding where there are investment opportunities, both in terms of investing in sovereign bonds, traditional or green or transition bonds and or projects with individual companies that have transition plans, so you understand, you have confidence, particularly where sectors have dependencies, that you have confidence that the government is going to step in the right place, particularly early stage, to provide different forms of financing, to bridge the gap where there are market failures, to help speed up the transition through clean energy and other innovations that give the companies the ability to do their pathway in an economically feasible approach, so that they get the required return on investment for your investments. That's the way it should work in concept. And then you could say that in practice, there are challenges. So the OECD, for instance, is saying, interesting, everyone seems to be on board, and yet it's really hard to find investment plans, investment strategies. Most countries don't have them clearly articulated, and that's a problem. And therefore, CBI here and also CTEX have written approaches to say, what should these investment strategies look like? And I would just touch base on a few of these. So you would think that a financing strategy has assessment of financing needs and the identification of the resource gaps, mapping the financial landscape, different types of products, mapping to different types of needs, early stage, scaling up, something that's commercially viable, and what type of financing should match that. And then the government says, we think we're going to step in here to give the private sector comfort that there will be that early stage investment. And then also developing the pipeline of investable or bankable projects. And I think you mentioned that. It's incredible how many conferences I have gone to over the past 6 to 7 years, where on one side you have public sector folks saying, we really need to create bankable projects. And we have the mechanisms to do that, just capacity building. And on the other side, investors are saying, it's simply not happening. We actually have money on the sidelines, and we want to invest, including in emerging markets, and we actually do not see these bankable projects. I find that really stunning. I think that's an area where so much progress needs to be made. I think the good news is COP30 and a lot of the work being done, including at London School of Economics, is really working. They've heard these issues and working on these issues to turn concepts and high-level principles into really good practice and implementation guidance. So I think that's a start. I'm happy to talk about country experiences and markets, but I'll leave it there.
Yeah, and I think since we're in the UK, how is the UK doing?
So I'm obviously not from the UK. So as an unbiased participant, I'm actually quite impressed that the UK actually, in how they're communicating progress and how they're making progress, you can always say the glass half empty, glass half full. But impressively, the UK, under different types of governments or with different political parties, I am really encouraged with the consistency in which they're trying to move forward. So the UK does have a modern industrial plan. I've actually read it. And the clean energy industries, part of it is clear about the sectors, the type of sectors. And I wouldn't say it's a clear investment strategy yet, but they're trying to create at least sectoral roadmaps. And the Transition Finance Council, that is led in part by our chair, Chris Skidmore, he's trying to build out playbooks. And playbooks are trying to get government, the investment community, and sectors together to really understand how I've mapped it out, where there is a need for financing and why, who's going to be providing the financing over periods of time, so that when you're reading either a sectoral pathway or even a corporate transition plan, you have confidence that that it's feasible, right? We've heard a lot about greenwashing, call it transition washing, but if you can see the big picture and all the components, you're better able to judge whether you think a corporate transition plan actually is real and makes sense and is economically feasible, meaning they can actually get a return on investment by doing it, and B, the dependencies, meaning there may be technologies that aren't commercially viable yet, but you have a sense from the government and other actors that that component will be there too. So everyone is making sense, and there's a level of truth and trust. And I think the UK is on the path to doing that, but with the Transition Finance Council and where they're going, if you read the documentation, it's not only good for the UK, but I really have it's just my personal view, but I have a sense that in particular for emerging markets, where the capital markets are not well developed, that it's even more important to have this playbook. So for those of you who are involved in emerging markets, getting that level of coordination, say through country platforms, is going to be even more critical, because you want to crowd in investment, and you can only do
change, and everyone answers, oh, it takes both and all that. But I think, judging by recent developments, we are now really sector is crucial in achieving the emissions reduction that we need. And that is setting the public arena to play, the sandbox that is set by the public arena to say that the regulatory support is going to be there. Then the corporate transition can also lean on that framework to give investors confidence. In my spare time, apart from helping CBI as their trustee, I also look at emerging markets, how they run their renewable energy auctions. And we originated from the work that we did in Argentina back in 2015, 2016. And, as a market that is very difficult to attract FDI, foreign direct investment, and also very difficult in attracting any investment at all, through a very well-designed renewable energy procurement mechanism, the auction has been able to mobilize 9 gigawatt of capex, installed capacity for renewables, and 11 billion of capital investment. So the example that I want to highlight here is if it can be done in Argentina, and it shows that when you have the alignment between national commitment, then onto the regulatory support, aligning that support with corporate action, then you get bankable projects. So it's all, you have to start from the beginning. Now, let me go to our own Magali, our head of policy at Climate Bonds. And you have an upcoming report, Unlocking Finance for Sovereign Transition. Can you give us a little bit of the key points, key findings from the report?
Yeah, thank you. Thanks. I'm delighted to be here as well, and also delighted that Rob just made my job very easy. Thank you, Rob. Describing actually what the challenges are for sovereigns in terms of getting the act together, and then also encouraging the private sector to invest where the private sector should invest. And you mentioned that it's been years that we're talking about this, and it's not really happening. And I think there's a couple of challenges why this is not happening. You've mentioned some. I mean, another one is that most of our economies worldwide are not centrally planned economies, right? It is not something we've been doing, and for many decades, we've actually actively avoided doing that, right? So we're changing from one tradition, one policy tradition to another due to the challenge and the existential challenge of climate change at hand. So that's the first thing. We don't really know how to do this anymore. And we also don't have economies that are reacting to that in the way that maybe some countries that do have centrally planned economies, notably China, react in that way. We don't have those mechanisms. So we've been looking at that from that perspective and thinking, we talk about sovereign transition plan, and I think very easily people have on their mind this one plan, this one sheet of paper where we're going to say how we're going to all manage to get to transition. One that's never going to happen, right? In most large developed economies, this is just way too complex to have this like one plan. So you have actually a series of different tools that all come together in sort of coordinated mechanisms, like playbooks, like sectoral plans, and so forth. So it's bringing like that sense of the whole, of all those different tools that you need to coordinate an economy that isn't centrally planned, right? So that's the first point that we were trying to sort of bring together. There is also a point of dynamic, right? It's an evolving target in a way, and also we are taking action every day. And so when you have those plans and you make those plans, and the day it's written and you put the final dot on the plan, it's already half out of date. And so it's like, how do you think about all of this planning exercise in a very dynamic way? And the way we've been trying to think about it is actually something that the OECD has also been doing a bit of work on. It is really thinking about how the core of government functions, right? And here you already have a parallel existing in most governments on how to address an issue that touches all aspects of government. You've mentioned earlier in the discussion, right? I mean, those policies, the policies that Australia and Denmark have been talking about are policies that cut across all activities of government. And actually, you already have a process dealing with that, which is the budgetary process that cuts across all activities of government. And the reason why I'm really insisting on the all is that when we're thinking about the transition, we often think about those priority sectors, right? The kind of energy sectors or like hard to abate industries, all of the sectors that we know need to change quickly and are the ones that most people have plans for and have sectoral plans, sectoral targets and so forth. And actually the budgetary process goes way beyond, right? Any last pen in government is somewhere in a budget of government. And this is what we've been trying to think about. How do you tag along? How do you free ride on that existing process that is already there, that people are already used to, and that already functions as a whole of government approach, but also at the core of government? And this is a question you asked to Australia, right? I mean, you have to coordinate those policies across everyone in government. Governments are huge, right? Especially in large developed economies, but also in emerging markets. They are very, very big countries, in emerging markets. Huge governments, central, local. Those budgetary processes are already there, already coordinating. Not all, and some countries have. There's some. I'm making it sound very simple and easy. It's not, right? But it's there. And so how do you free ride on that? And so we've been thinking about these ideas of green PFM, so green public financial management, which I know Sean hates when I say that because it's a very technical term and you think it's awful and it's really not sexy. I promise you I'm going to try and make it sexy, Sean. But so it's this idea of if you start greening your budgets and your budgetary process and you sort of have a de facto alignment of your activities across government. Now it all sounds great and easy and nice when you think about it this way. It's way more complex than that. And there's a key question in terms of how do you align? We think taxonomies can be very helpful because if you align your budgetary process to taxonomies and criteria, in that sense, you sort of have a de facto alignment in terms of the credibility of the pathways that you've chosen, which is already inscribed into your taxonomy. So we think that those things come together. So that's what we've been thinking about, and that's what this report looks at. And this is really the core of government. And then it's thinking about, okay, what do you do for real economy policies? And then, we sort of try and bring the whole together. We think about ASCOR, right? The idea here is that there's a lot of tools being developed at the moment. And so how do you bring those tools together? Which tool does what? And how do you think about the whole again? So we've been free riding on you, ASCOR, thinking that you can totally use this tool, which is great. So that's what we're thinking, yeah.
So we have touched on, what does a good climate investment strategy should look like, and it should be written in a way that is quite different from an NDC, although in alignment. Now, since we have a room full of investors, what do you think governments can do that would bring the investors into the equation, that would allow countries to leverage climate finance? Is it regulations? Is it any central bank changes? Maybe Rob and then Claire. Yeah.
So I would go for the long list. There's a massive amount that central banks are doing and can do. So you can actually embed climate into your monetary policy strategy, into your collateral policies, into your own use portfolios, and all of these elements are signaling for the markets, for all of you, that the central bank is embedding it. They can show you their methodologies and they can show you the pricing impact so that you have to think about that and how that ricochets. The finance ministry can also issue. So the UK has issued gilt bonds, and there is a greenium, so a number of countries are issuing green bonds or climate-oriented bonds. Not a lot, I have to say, and we can talk about that. It hasn't been that much, and it needs to be a lot more to hit the targets for the climate transition to actually be invested. But at the same time, the signaling of that, what I understand from a BIS research report, is that signaling from sovereign issuance actually helps liquidity and pricing in corporate green and transition issuance. So that actually is creating healthier markets that way. So I think that's fantastic. And then I'd say regulatory efforts in terms of creating the right fund, enabling environment for funds, taxonomies, et cetera, that also helps. And then I think fiscal as well, with budgeting, actually with expenditures, to show that you're actually changing the structure of infrastructure, of economies, et cetera, to try and actually enable the right environment for corporates to do what they need to do to make the transition successfully.
Yeah, so it makes me happy when we talk about looking for kind of putting these two parties together, the sovereigns and the investors, because there's sovereign bond investors, and we're usually the, kind of quiet, just getting on with it. but they are increasingly vocal. And we can use the ASCOR framework for engagement. So we start with that, those conversations between DM and EM sovereign investors and issuers. And issuers want to hear what investors want. And ASCOR provides a good common language for talking about where sovereigns can improve and what on their climate transition, as well as what investors look at and need to understand. And then we go to the issuance that Rob was talking about, and we've seen a whopping 3 sovereign SLBs over the years. I want to see more, and we've got the recipe for that issuance in the ASCOR framework. We saw Slovenia's issuance this past, I think it was September, maybe a little bit earlier in the year than that, but they referenced on one of their SPTs that, you know, that the SPT was ambitious and in line with their 1.5 degree fair share on their emissions that ASCOR has used as one of their indicators. So what I want the investors in this room to think about is, what do they want from their sovereign bond portfolio? You know, traditionally, it has not been the most sexiest asset class, but it can be an asset class that really contributes to the transition. If your sovereign bond portfolio managers in both the DM and the EM space articulate what they're looking for in issuance, because they have constant conversations with not only the issuers, but also with the banks that facilitate that issuance about what they want to see. And then they can use the ASCOR framework as that common language, that identifying, you know, SPTs and KPIs and such, and really get the issuance that sovereign bond investors are already buying. And then we can bring in the other asset classes that look at sustainability-linked bonds, and to really support that change. And so that is what I think everyone in this room can do, and bring the sovereigns along.
Yeah. Yeah, I'd like to do 3 things, adding on what Claire and Rob saying. So on the active engagement from investors, the interesting point here is that sovereign investors in emerging markets already have much more active engagement strategies, right? They can leapfrog the ones who invest in developed markets who don't really do a lot of active engagement. So there are already frameworks in place that you can sort of use what, you know, your colleagues across the building do, because they've already been doing this for a very long time. So I thought it was quite interesting. Those investors may have a bit of an edge. On the monetary financing, this is slightly controversial, but I'll go a little further than you. I think you can do much more on monetary financing, and what we're seeing is that some of the countries that are emerging as transition leaders are doing more on monetary financing, and are really sort of leveraging the central bank for green lending, either via other banks in the country, sort of green lending facilities, or via sort of specific projects financing. So there is more happening. I know in the EU we can't do it because, you know, Maastricht Treaty, but, you know, there are countries who are doing it, and it's clearly helping. And then a third point I wanted to mention is that we're always talking as if investors and policymakers were not already around the table, but they are. Right. What we're seeing in the macro trend in the economy is that this transition is already happening. Right. We're seeing the rise of electro-states. We're seeing the race to secure the supply chains for the green economy. So investors are already there. Right. It's just we need so much more. It's a scale problem, I think, rather than a sort of actually starting it, which is, I think, already underway.
Yeah. And I want to change tack a little bit and wrap up with this final segment of our discussion. We have talked a lot about decarbonization. A lot of that is in the NDCs is mitigation. But now, especially the work that we're doing at climate bonds on adaptation and resilience, we realize this is going to be the focus for investors and for countries in the coming decades. So I want to ask both Australia and maybe also Denmark, if it is still online, how do you feel about the ratio of climate investments towards mitigation versus adaptation and resilience? Are you trying to move more towards resilience and less on decarbonization?
I'm happy to go first with that, Yolanda. So definitely, I think Australia is moving towards more adaptation and resilient investments. We're a country that stands to have significant physical climate impacts, and so the release of our National Adaptation Plan, which I mentioned earlier, is sets out a clear pathway to try and map how investors and policymakers need to respond. I would also say that, our bid to host COP31 with Pacific Island countries is, another sort of initiative to try and increase the global focus on adaptation and resilient investments and investment pipelines. Pacific Island countries, the overwhelming majority of their finance needs are for adaptation and resilience. And so by, shining a spotlight on small island developing state needs, we really hope that the global attention will be sort of focused laser-like on the solutions in that space. Thanks.
Great. And anyone?
Could I just throw in, so we just held a conference in Mexico for Latin America looking at nature and climate, and I would say adaptation and nature for emerging markets in general, but particularly in Latin America and Asia, have been at the forefront. And I think there's a bit of surprise that in advanced economies, climate and nature have been a bit separate, and mitigation has been much more of a focus than adaptation. But in countries that are facing these risks, and it's not conceptual, but it's really happening today, they're really quite advanced in terms of assessing and coming up with frameworks and tools and financing to deal with adaptation and nature. And I think you'll see with COP30 as well, with the Brazilians and the TFFF, to deal with deforestation, for instance. And these issues are front and center for certain countries. And by addressing them, it deals with job creation and productivity, environmental impact, and just transition. So I think we have a lot to learn from emerging markets in that way.
I love to hear that, because I think that engagement in EM and the activities around nature in EM lead the way and give a lot to DM to learn about. And I think that is a perfect kind of teaser to encourage you all to look at the State of Sovereign Transition assessment that will be out next month. That I think will also, here's a little teaser, might support that statement as well, that DM has a bit to learn about from EM in climate transition.
Yeah, Climate has released their resilience taxonomy, so we are seeing more and more activity on this. There's just been a bond issued by the Tokyo Metropolitan Government based on the resilience taxonomy. So not just EM, some DMs as well, but I agree with you. There's a lot we can learn from EMs on the transition in general. I find this fascinating as well. But yeah, we're starting to really see some pickup, and I agree with you. The message, whether it's for mitigation or adaptation, it is about economic prosperity, right? And this is why it needs to be at the core of government. This is about how you prosper in the future, and this is why this is really central.
Right. So we have to future-proof, basically. We can now open up for questions from the audience. We've got 2 here and 1 over there. So I'll take 3 questions and then we'll open up for answers. 2 here.
Andrew Ross from Global Garden. The Chancellor here faces a black hole in her budget of between 20 and 30 billion pounds. What do you recommend she should do?
Okay, second question.
Aaron Kelschker, Invesco. So credit rating agencies, the correlation is 0.9. Just wondering to which extent on the policy making side are NDCs and NAPs factoring into those credit ratings when they're being issued?
Okay, and 1 more here. Yeah.
Hi, Max Gotzelus. On the topic of budgets and greening budgets, we see some countries ring-fencing revenues from policy instruments like carbon taxes, for example, and we see some countries that don't, and it all sort of goes into budget negotiation processes. So to what extent do you see the way that budgetary processes work in helping or hindering this idea of climate investment plans? Thank you.
Great. three wonderful questions. First on the, oh, one more? Okay, yeah, let's take that as well.
My name is Dr. Harish Ahuja from India. I have a very specific question to Rob. Thank you, Rob, for setting the context in around what kind of policy and regulatory measure government should take. From scale 1 to 10, how do you rate Indian policy and regulatory framework around climate finance? 1 to 10.
Okay.
Okay, let's start with the first question on the budget black hole that we're seeing in the UK.
Do we have to start with that one?
That's a great one.
We're all planning to ignore it, no?
No.
Rob is volunteering. You go, Rob.
Yeah.
Okay, you go ahead.
I should say too, so I was at the Bank of England until about 7 months ago, and I would have said no comment, but I want to comment. There's a very important point to make. Even where budgets are facing pressures, by green budgeting, even in a very difficult environment, embedding resilience, call it future-proofing, but it's climate resilience, nature resilience, in your infrastructure, in your defense, in your energy security. It can happen, it is happening, we're seeing good examples. So I would tell any government, even if they're facing difficulties, to do that. The second thing, which is kind of unasked, but I want to say this, at the end of the day, when fiscal policy fails and government policy fails, who bears the burden? The central bank. I was on the Maiden Lane facilities after AIG went down during the financial crisis. I was at the New York Fed, and I know firsthand, the central bank is forced to solve these problems. But now what you're seeing is central bank independence is at risk in certain countries, but if it takes on the failure of addressing climate and nature, maybe it'll be financial products, who knows what, but that will end up at this central bank and threaten the independence. And inflation and uncertainty will be socialized, and all future generations will be affected by it if we get this wrong. There's no other path. Currently, central banks always take that. And I think that's really frightening because for the past century, we've been built on central bank independence and confidence in the central bank, if nothing else. So if that is threatened, I think we really have serious issues. And then yields on sovereign bonds are going to go up much higher as a result of that uncertainty. That's a frightening prospect.
Can I just bounce back on the budgetary question? I'd love to have a coffee on central bank independence, by the way, but I'll leave this one aside. No, I think it's answering also the question that was in this corner, which is about the ring fencing point. I think when you start thinking about expenditure and the investment you need to make in resilience and mitigation and adaptation as an either-or question, you start solving those problems, right? So you look at all of your activities through those lenses, because it is about economic prosperity, it is about future-proofing, it is about like how you're going to survive in the next 50 years or 100 years. And so all of your budgetary expenditure need to be looked through that lens. So you don't have things that are looked via the mitigation lens that are ring-fenced, and then everything else that does things that are potentially contradictory in many cases, actually. And then it's also a little bit, just on the ring-fencing issue, I mean, ring-fencing state revenue is illusory. I mean, a pound of tax is a pound of tax because we're in the UK, and it's always fungible, right? So this ring-fencing is a political economic question. It's a political argument, but it's not really a budgetary argument as much as I think we would like to believe. So in that, I think it's, if you do the green budgeting on your whole budget, and this is why you need the whole of government approach, then you start bringing those questions together and you start thinking about the need for investment in a whole different way, because every expenditure can be a mitigation or an adaptation investment.
So how about to the question about credit ratings being factored in? Anyone wants to volunteer?
I feel like I'm getting looks over here. I would say that this probably is not going to be the most explicit answer, but in that, you know, ASCOR was created because sovereign bond investors didn't have another resource that helped them really understand sovereigns' climate pathway. And I think there's a lot of the rating agencies have started to think about climate and how it affects their rating methodology, but there isn't an explicit there isn't the explicit information about where where countries are headed using or in climate light, and I think that is why ASCOR exists.
Can I just a very quick follow-up on that one? So One positive outcome of discussions in Washington, D.C. was that the credit rating agencies really got picked on, that they are not incorporating the benefits of addressing climate through budget and investment, that they're not incorporating that enough. They're not incorporating the medium-term benefits for financial and economic resilience, and even some of the short-term benefits, meaning that these are responsible things to do by greening your budget. And they've had a lot of pushback, and I heard informally that at least S&P is looking to better incorporate that in its methodology. So maybe Google it, maybe that's out in the press, but I do think that credit rating agencies better appreciate that they need to get up to speed and better understand the economics of this.
And I want to now move on to the last question addressed to you on India. How do you rate it?
I would say, so I'm biased there because the London School of Economics and CTEX, my center, the center that I'm running is actually in India and partnering with a local group. And I would just say compliments to India for being very open to be working with academia, with consultants, to try and get really good international practice and understand what works and what doesn't for India. And I think from what I heard from my staff in discussions, but correct me if I'm wrong, is that India is focusing on climate work in the president's office. So to the extent that that's true, that as opposed to having this as a collection, that it's taken so seriously at the core of the political agenda that actually at the highest level it's being engineered to make sure that all of the other players, ministries are involved. And that means that it's critical for growth and critical for medium-term resilience for society. And I think that concept makes sense.
Great. So we are going to wrap up, and thank you very much to both Shell Online and our speakers on stage. Thank you.
Great panel. Thank you so much. And thank you, Chell and Anders, for coming in online. There are many other countries that have good stories along these lines as well. One of the things that we want to do is promote them. No country is perfect. I don't just mean the UK. I mean, Denmark has got great plans. They've got more to be done. But the main point is this is now becoming a theme for many countries around the world to start talking about and promoting their sovereign programs. And that'll link to sovereign bond issuance. Before lunch, we now have a short session where we have two of my very good friends from India on the stage. Ashish Kumar Shodran, who's the CEO of the Indian National Stock Exchange, is going to join us online from Turkey, where he is at the moment. I hope the team can get his picture up. And Harish Kumar Ahuja, who's the head of sustainable finance, power and carbon markets at the stock exchange, is going to come and say a few words after Ashish kicks us off. I just want to say that we work with a lot of stock exchanges around the world. We work at the London Stock Exchange. I think there are some people here from the team. We work from NASDAQ, of NYSE, with numerous stock exchanges across Latin America, thanks to our incredibly active Latin American team. The Singapore Stock Exchange and so on. The Indian Stock Exchange story right now is incredibly exciting. And I've got the privilege of being part of this project that you're going to hear about, which I think will be influential for global equities. But at that point, that's the teaser. Ashish, over to you to say a few words to kick us off.
Thank you, Sean. Members of the Climate Bonds Initiative, distinguished guests, and change makers joining physically and virtually from around the world. Good afternoon. Good afternoon. I'd like to begin by congratulating the Climate Bonds Initiative for their tireless efforts in advancing sustainable finance globally. Your work in building trust, standards, and market confidence around climate investments has been instrumental in translating commitment into capital. Earlier this year, at Climate Connect in Mumbai in September 25, we began a conversation on how markets can transform sustainability from commitment into capital. That conversation did not end in Mumbai. It continues here in London, but it will continue further everywhere, because the climate change is shared and the financial response must be global. From Mumbai's monsoon coast to London's Thames, finance flows where purpose meets performance. And that is precisely the story India represents today. India stands at a defining intersection of growth and transition. It is now the fourth largest economy, the fourth largest capital market in the world, and it remains the fastest growing major economy in the world. Since NSE began its operations in 94, the market capitalization of listed companies has grown 126 times in rupee terms, reaching $5.3 trillion today. At NSE, our commitment has always been to provide platform that enables companies to grow, investors to participate in that growth, and India's economy to thrive. Today, NSE serves over 120 million unique investors. India is a ID market, unlike Western markets, which are what we call omnibus markets, where the exchanges don't know who is trading. In India, we know exactly who is trading, including their unique identification number and their phone numbers and other things. Holding more than 237 million investor accounts, spanning 99.85% of India's PIN codes. NSE is amongst the global leaders in equities related IPOs, facilitating 268 IPOs collectively last year, raising $19.5 billion, among the highest in the world. These numbers show that India's markets are no longer just instruments of growth. They are platforms for sustainability and inclusion. Effectively, last year, in addition to this $19.5 billion in equities, we also raised $201 billion more by way of bonds, commercial papers, REITs, InvITs, municipal bonds, and many other things. India entered this decade with clear nationally determined contributions and has achieved many targets ahead of schedule. Today, the question is no longer why sustainability. It is how. How do we channel finance to what matters most? Renewable energy, green infrastructure, resilient cities, and climate technology. And how can markets become the trusted bridge between ambition and capital? India's ethos has always been rooted in sustainability, from the world is one family or Vasudhaiva Kutumbakam to the Bisnoy tradition, the Chipko movement, and ancient water harvesting systems. Living with nature is part of who we are. And today, that ethos meets modern finance and technology. Between 2015 and 2023, India required about $2.5 trillion to meet its NDC targets. And India broadly achieved those targets. To realize the developed India or Viksit Bharat target of 2047, will need $250 billion per year in climate-related investments, and to reach net zero by 2070, about $10.9 trillion in total. These are not statistics. They are opportunities for investors and innovators worldwide to participate in India's transition. India's climate leadership extends beyond markets. Under Prime Minister Mr. Narendra Modi, India co-founded the International Solar Alliance with France at COP21 to scale solar deployment amongst sun-rich countries. India also launched Mission Lifestyle for Environment, transforming sustainable living into a people-led movement, and the Coalition for Disaster Resilient Infrastructure to build climate-resilient infrastructure globally. More recently, India helped establish the Global Biofuels Alliance, advancing clear energy transitions. India today is an emerging global leader with global partnerships across the world, and our partnerships with the United Kingdom is stronger than ever. Earlier this month, Prime Minister Right Honorable Keir Starmer led a 125-member delegation to India, the largest ever UK trade mission, reinforcing the growing momentum between our nations. It also laid the ground for deeper capital market association, especially in green areas. At NSE, we see climate and sustainability not as separate agendas, but as part of market evolution, from green bonds to GSS Plus and transition bonds, from ESG indices to social impact listings. And we are building Finance 2.0, finance that measures not just profit, but purpose. We have supported a wide range of sustainability-linked issuances, green, social, and municipal bonds, and are expanding into GSS Plus and transition instruments. Through NSE IX and at GIFT City, we enable listing and trading of green, social, sustainability-linked, and transition securities, attracting cross-border climate capital. NSE Sustainability Ratings Analytics provides standardized ESG assessments that strengthen price discovery and curb greenwashing. Our nifty ESG indices, enhanced and sector leaders, translate ESG performance into investable benchmarks. Around this, we tighten guardrails through BRSR disclosures, robust surveillance, and a suite of sustainable products so climate finance can scale with integrity and speed. The next step is a credible green equity ecosystem, enabling investors to identify transition leaders and corporates to raise equity transparency for sustainable projects. In 24, green sector companies raised $3.13 billion on our main board market, 16% of total equity capital raised, and green SMEs mobilized additional $115 million. I have a firm belief that when green technologies become competitive and profitable, organized markets like NSE will help them scale manyfold. We are watching that transition in India in form of solar energy, which has become profitable, and that's why markets are actually paying money for that. Green hydrogen could be next in few years' time. This is what we mean by the green equity pathway, not new regulations, but recognition of climate tech leadership and making them profitable. Our upcoming framework offers a 3-tier classification: orange, green, and dark green, reflecting India's transition economy, creating visibility, trust, and comparability. At NSE, our mission remains clear: to make sustainable finance accessible, credible, and actionable, and to empower every investor, institutional or retail, to invest in a cleaner, greener, and more resilient India, but in profitable companies. India's development path is unique. Our net zero transition will move from mid-carbon to low carbon to near zero, fully aligned with global taxonomy, yet true to India's realities. Through the green equity pathway, we will support this evolution with transparency, trust, and global partnerships. Thank you for inviting me to speak at Climate Bonds Connect 25. I'm in Istanbul physically, but in spirit, I'm in London. So thank you. Thank you, Sean.
Thank you so much, Ashish, for your time. Harish, your turn. Please, a big clap for Harish. While Harish is getting on the stage, getting his slide up, it's 3 things to note. The scale of capital that India requires over the next 25 years, as Ashish was saying, is extraordinary, 1. 2 is 60% of all money raised in the stock exchange was green already. And B, what they're doing that's green is aligned with global taxonomy. Taxonomy team, feel proud. That is fantastic. And that's really critically important for international investors being able to invest comfortably in the Indian market, knowing that it meets international requirements. Harish, you're on.
Thank you, Sean. Thank you very much. Good afternoon, everyone. When I asked the wrong question in the session that how much you will rate us in terms of 1 to 10, I was expecting 11 out of 10. Not a subjective answer. I was very objective that India has done a great. And I think in my presentation and MD sir's speech, some glimpses were there, but I'll be talking more in detail. But I have got very clear, limited time, so I'll be very objective and very number-driven when I share the data. Like all other Indians, we are good in maths. So I think Ashish sir spoke about this. India is definitely leading the pack in terms of our capital market growth. We are the 4th largest market in the world in terms of our market cap. And the way things are shaping up, very soon we'll take over Japan also. Because the equity cult in India is growing a lot. 120 million accounts, 120 million unique investor, 238 million accounts. I think the numbers are growing leap and bounds. Every month we are reading roughly 0.5 million investors, which is a good number, I think. So capital market in India is very, very developed in terms of attention of the equity investor, but in terms of also bond investors. So I'll take 4 key messages from our MD sir's speech and from the entire Indian objectivity perspective. The 3 messages were very clear in terms of Ashish sir's speech, but 4th aspect, which was how exactly we are laying down the green equity principle, I'll talk today. So let's talk about first briefly about Ashish sir's speech. 3 clear points that India is committed to the global cause of climate change. And we are not only aspiring big, but also achieving big. Just to give the numbers, we have already achieved renewable energy capacity addition of 2030 as on yesterday. I'm not talking today or tomorrow. So our targets were to achieve 50% of capacity, installed capacity by renewable. As on today, we have got precisely 500 gigawatt capacity. 251 gigawatt is coming from renewables as on today.
We already overachieved. We had a second target of achieving 1 billion ton carbon emission reduction. We are on the path of this. Carbon emission intensity, despite being the largest populated country in the world now, we are on the path to achieve 2015 targets. So what I'm saying here, we should have got 11 out of 10. And I think this targets very clearly. We have got everything in place. In terms of policy, I think Rob very clearly suggested that it is being driven from the top. Our PMO office has one very unique desk of energy advisor for climate change. In terms of regulations, every regulation is in place. In terms of banking regulator has put in climate change mitigation strategy for financial institutions. Capital market has put the ESG framework in place. Green bond and other color bond framework in place. We have got very clear policy in terms of social bond also issuance. And I think not only regulators, but so we have got three very clear distinctions here. We have got carbon credit trading scheme is in place also. Regulation already out. But the actual trading in carbon credits will start April 2026. Why? Because we do believe that because India is growing very fast. So we should give the companies some time to prepare themselves. So our regulations are in place. Industries have been identified what kind of carbon caps they will be given. Everything has been identified, regulations are in place, but trading will happen from April 2026. So we have got carbon emission trading scheme in place. Very important thing, third very important thing is we already put climate finance taxonomy in place. We are somehow aligning the final draft to be published just before COP30. So we do anticipate that by second week of November, by 10th of November, you will see India's climate finance taxonomy also in place. So everything is in place. And I think this impact is being reflected when exchanges work. So the first and foremost clear point is policies are in place, regulations are in place. We know precisely how much money we need. So from here onwards till 2070, roughly we need $234 billion year on year. For different phases, this number changes. In the beginning, I think we need around $250 billion, then around $260 billion, and the last around $174 billion year on year. And this number is a great opportunity for the investor here because we know precisely where the money is going to go. And this slide shows exactly where the money needs to go. If you see the power and transport, it is taking the first 15 years from, let's say, 2020 to 2035, the major emphasis of India is on power and transport. 25 to 30% in power, 15 to 40% in transport. These are the big area for investment. In the first 15 years from 2000 to 35, we need more money for adoption and resilience. Agriculture is attracting a lot of capital. But post 2047, you'll see adoption need zero money because we are achieving the numbers. Power sector will again need more money once we become Viksit Bharat, because till that time we are putting the coal power plant on operations. Post 2047, coal plants will be defaced. From today till 2047, again, the mineral and mines are going to get a lot of attention because we need a lot of mineral to drive our electric vehicle strategy, to drive our carbon-led growth. But post 2047, you will see carbon-led growth will go down. So we know precisely where we need the money, and those numbers are here. We'll share this presentation, so I'll not focus more upon this. Now, exchanges. The second message which Ashish's speech was giving, the exchanges are clearly aware about commitment versus ambition versus reality on the ground. NSE, National Stock Exchange, knows which kind of instrument will attract what kind of capital. We have already put ESG compliant mutual fund in place. We have put green bond framework in place. We have got very clear muni green bond in place. We have got green infrastructure in place. A lot of money has raised. In this year, we are targeting two major areas. One is definitely electricity derivatives. So unlike other major developed countries like North Pool or UK, US, Australia, Singapore, we had no electricity future. And we wanted to work a lot of renewable capacity. We wanted to give some forward price signal. This year in July 2025, we launched the electricity futures. And the kind of forward price curve we are getting, I think it will attract more than $10 billion investment year on year. We acknowledge that there's a funding gap here. We understand that at this stage, NSE and other ecosystem is attracting a lot of capital, but in spite of that, there's a lot of huge shortfall, and this shortfall is reflected here. If you see this slide, in fact, as on date, public markets are raising around $184 billion. Gradually, the equity share is increasing. it was around 18% in 2022. Now it has gone to 24%. Now, how exactly capital market, like public market, can attract more and more green capital is the question we are asking from ourselves. $234 billion year on year versus the entire capital market raising $200 billion for all the sector. So the question is how this deficit of $120 billion would be achieved. Would it be through venture capital fund? Would it be through green bonds? Would it be through green equity framework? Would it be through derivatives? I think we are putting everything in place. Having said so, right now, I'd like to share a very important data, which Ashish sir said. Last year, we raised around $20 billion in IPO market, primary market. Out of this $20 billion, 16% money came from green equity companies which are primarily renewables, electric vehicle, climate finance, or EPC companies of solar, wind, etc., etc. Now, this 16% is going to grow. This year, so far, we already raised a lot of money, and out of that, again, 20% coming from the green equity companies. And this money, we'll have to expand. Having said so, we need to put green equity principle in place. I like to share this slide, which is a very important slide. I like to learn here from the World Federation Exchange Green Equity Principles. So far, only three countries, or I'll say three exchanges had adopted green equity principle. NASDAQ, Brazil, and Switzerland. As per my understanding, Switzerland has so far not launched it. They made the framework, but they're not launched it. Indonesia and Philippines have just launched it. So in terms of exchanges, we'll be the second global large exchange, because NASDAQ is the largest exchange. We'll be the second largest exchange in the world, which will launch the green equity principle. What is green equity principle? Similar to green bond, there are chances that money raised through equity for green causes or green activity may be misused or greenwashed. We don't want that to happen, because once it happens, people lose the trust. In India, green bond market is not that liquid. It's not because government do not like to go for it, but because of greenium and past greenwashing concern, green bond market is not taken off. We don't want the same thing happen in green equity, because green equity is growing leap and bounds in Indian stock markets. That's why we are putting upfront green equity principle, so that greenwashing concerns doesn't arise in green equity principles. We have learned from Brazil, we have learned from Indonesia, but here is the peculiar strategy of India. Unlike NASDAQ, Brazil, Indonesia, they only put two categories, light green and dark green. Companies investing or making the revenue out of green business activity are being categorized. In India, because we are in a very peculiar phase where we need more transition-related funds, we are also putting a new category called orange category, which we will call transition category. I could see in the previous panels a lot of confusion around what exactly will be green transition. There are a lot of issues around identifying the right process. So we'll put some absolute number in place, which will guide the consultant, the verifier, the reviewer to understand which company is green, dark green, and which is in orange category. And because our green taxonomy identify very clearly hard to abate sector, that these are the sector which needs more transition funding, we are learning from them. And unlike other exchanges which are not put orange category in green equity principle, we are adding green equity in green orange category also. These are certain companies which have raised the capital in last 2 years. But right now, the discussions on green equity principle is already on. I'm very happy to share that we have taken the experience of Climate Bond Initiative in our committee. Sean is a part of that committee. And I think in 45 days, we'll be launching this green equity principles. These are certain companies, 12 companies, which have raised capital in last 1 year. If you see most of the companies, the peculiar part is, see the PE multiple. Most of your investment guys. India average PE, the NSE Nifty 50, which is the largest exchange index in India, has the PE multiple of 21. If you see all the green companies having the business activity in green area are raising PE multiple more than 20, which is a good thing. So I think people are rewarding this company who are into green business activity, and they are ready to put more money. Institutional mutual funds, DI, FI, or everyone has given higher multiple for PE. Some of the company after listing has gone down. Most of the companies are going up only in terms of PE multiple also. But this should continue, because if this continue, people will have faith on the markets and they'll put more money in the green business activity. That's why I'm putting green equity principles. This will be primarily three categories: transition, light green, and dark green. Now I'll start from the right. Green dark green is very clear. They are raising a revenue of more than 75% on green activity like solar manufacturing, wind turbine, EPC, climate finance. So their 75% revenue is coming from green activity. And whatever money they are raising or whatever new capital they are investing, be it CapEx, OpEx, they are investing only into green business activity. This is called dark green. And we anticipate that such categorization will give them better valuation, better P multiple. The second category is light green. Here do anticipate that 50% revenue is coming from the present green activities and 50% going to, money raised is going to for the new business activities, especially CapEx and OpEx. Transition is very important. In case of transition, they already taken first step towards greening their portfolio. 25% revenue is coming from the green activity, but the subsequent 50% is going for CapEx or OpEx. So slightly diluted in terms of our expectations around revenue and in terms of CapEx. But putting these numbers, and these are open to discussions. If anyone has questions, they can ask us. We are still in the discussion, but Shan has given us very good platforms. We thought, why not should we launch at the global platform like London and should share what exactly we are planning to do. And we'll follow a guide path. The guide path would be first 2 years, it will be more like a voluntary, and SME will not be involved. Post 2027, it will be more like a mandatory for companies to come and raise the capital to get this certification. And SME will start the voluntary, and post 2028, everyone will be covered by this, be it new companies, be it listed companies. Thank you very much. I'm done with the presentation. Thank you very much. Thank you.
Thank you, Harish.
Thank you.
Thank you so much.
Thank you.
A whole new asset class we are engaging with, which is going to grow. The idea of green equities is simple, right? But actually, like bonds, it was simple, but it needs guidance. This is the guidance that's coming through, and from B3 in Brazil and so on. Watch this space. But now, lunch. Please do have some interesting conversations with people you don't know and see if you can make some connections and maybe even some deals. We're back here in 1 hour for the next session. Lunch at the back. Thank you so much. I'd like to invite Nicola Ranger from London School of Economics onto the stage, who's moderating this panel, and then she'll invite her speakers on board. Nicola is a superstar, as far as I'm concerned, of resilience in the world, and we're very, very lucky to have you today. Please, Nicola, join me on stage.
Thank you so much, Sean, and it's really lovely to be here with you all today. So for this session, we're going to be talking about resilience, and what we really want to do with this session is move from talking about the risks to where the opportunities are as well. And you'll all be familiar with what we see on the TV and newspapers every day now about rising risks associated with climate change. And certainly when I started working in this area and started talking to a lot of financial institutions around 10 years ago or more, I was having to make the case for why this is important, but I feel that these days we don't need to do that. I think everyone can see why this is absolutely critical, and we can see now on the balance sheet of many companies, these risks are really starting to bite, as well as on governments and financial institutions as well. And certainly the work that we do at the LSE and elsewhere is really sort of demonstrating that this is a very significant risk to credit risk, to the operations of companies, the revenues of companies. So that's the negative side. But how do we turn that around now and see this as a way to support the economy to adapt? And what role can the capital markets play in this area? And investment more generally. So that's what we really want to focus on in this session, that how do we move from the risks and understanding the risks into the opportunity side and really supporting adaptation more widely. And obviously CBI has been a real leader in this space, and I've been delighted to work with CBI over a number of years now in this area, including sort of contributing to the fantastic work on the taxonomy that was done and launched last year. So it's really great to be here with CBI. Without further ado, I want to introduce our fantastic panel for this session. So firstly, can I introduce up Craig Davies, CEO of Cadlas, instrumental in the aforementioned taxonomy, so great to have you with us. Terry Ellis from S&P Global. Amelie Amin, Managing Director from BII. Thank you. Chris Dodwell, Head of Policy and Advocacy for Impacts. and Lisa Wong, Head of Private Credit Sustainability Research for MetLife Investment Management. So if we're going to have a group of people that can really steer us in this area, these are the right people. So in this session, we particularly want to talk about the interlinkages between adaptation, nature, and social and gender as well. So we're going to we're really challenging ourselves in this session. I want to first come to Craig to give us some introductory comments about what you're seeing in this landscape and the work that you're doing. Over to you, Craig.
Well, thanks, Nicola, and hello, everyone. It's a pleasure to be able to speak to you today. So, Nicola, I think given that we're at a Climate Bonds Connect conference, I'd like to respond to your question by maybe giving a little bit of framing as to what we've seen in terms of the evolution of how climate resilience and adaptation have featured in the sustainable bonds landscape over the past decade or so. Now, adaptation or resilience as an issue has been in the background for quite a while in sustainable bond issuances. I think CBI did some research a few years ago where they found that something like 19% of all sustainable bonds named adaptation as an eligible use of proceeds. But of course, that's not the same thing as the actual amount of finance that's actually being delivered into resilience investments, and that's estimated to be much lower. It's actually hard to track, but the evidence that we do have suggests that historically that has been a much lower figure in terms of the volume of financing that's actually reaching investments in adaptation and resilience through sustainable bonds. But we have seen a kind of evolution, a incremental development, if you like, over the past few years. It's 6 years ago since, in my former job at the EBRD, EBRD launched the first kind of dedicated resilience bond in 2019, which was the first bond that was dedicated, or rather presented as being wholly devoted to adaptation and resilience investments. And we've seen over the years a few other similar kinds of bonds by MDBs and by others, which has been self-declared, non-certified bond issuances presented as resilience bond issuances populated with resilience investments. But we've seen some really important evolutions since then. One has been the emergence of a number of taxonomies that either wholly or partially consider adaptation and resilience as a sustainability theme. And of course, we all know about the EU taxonomy, which back in 2020 was finally released and which includes adaptation as one of its sustainability objectives. And there is a whole set of technical screening criteria and other considerations around adaptation into the EU taxonomy. But it's by no means just the EU taxonomy. We've seen a whole range of other national and regional taxonomies set out definitions for adaptation and resilience, many of which lean very heavily on the EU taxonomy, but not all. Some, such as the ASEAN taxonomy, are different, and they respond to the needs and the priorities of the specific regions that they've been developed for. Climate Bonds, of course, has developed and released its Climate Bonds Resilience Taxonomy, and full disclosure, we at Catalyst are really proud to be the lead technical partner with Climate Bonds on that important piece of work. That's also been a very helpful step forward in terms of really advancing the thinking around how sustainable bonds can direct and channel finance at scale towards adaptation and resilience, taking a very comprehensive approach covering a broad range of sectors, which I saw Sean had up on the screen in the opening session this morning. More recently, in fact 2 weeks ago, there's been another important step forward, and that's been the first certified resilience bond, which you may have heard about, and I saw it was also advertised in the lobby earlier. That's a bond that's been issued by the Tokyo Metropolitan Government for $300 million. It's been certified against the Climate Bonds Resilience Taxonomy. It has a heavy focus on very practical investments in terms of making urban infrastructure and assets more resilient to climate risks such as storm damage and flood damage, for example. And that's another really important step forward, because now we're beginning to see certified resilience bonds. So there's kind of a picture there of kind of progressive, incremental steps forward, if you like, in terms of progressively increasing the credibility, the robustness, and also the ways in which we can understand the impact that these instruments are having in terms of delivering adaptation finance on the ground. So there's a lot more to be done. I'm sure the other panelists will talk us through a number of issues in terms of how we can further consider and develop this area. But certainly we have seen over the last decade or so quite some very interesting and significant steps in that direction.
Thanks, Annie. Just a quick follow-up question, if I may. So we, and I know your own company has done a lot of work looking at sustainability-linked bonds for adaptation, and we certainly see this huge opportunity in that there's a market beginning to develop in this area, but then if you look at the KPIs that companies are already considering in their plans, there's loads there that could be potentially linked to sustainability-linked instruments going forward. So there's a big market opportunity. I wondered if you're seeing that as well in your work and what you're hearing from people that might be interested in these instruments.
Yeah, we've looked at this. There's two things going on there. One is that there has been a cooling off in the sort of interest and the sort of market perception of sustainability-linked bonds, which is a little bit unfortunate because there are lots of good things to be said for sustainability-linked bonds. We have in the past looked, for example, with a number of clients at how sustainability-linked bonds might be used for adaptation. Apart from the sort of cooling off effect that I've just talked about, another consideration was the identification of the right KPIs, the right key performance indicators. Because of course, a sustainability-linked bond, it all hinges upon how you adjust the pricing terms in relation to the achievement or the non-achievement or the overachievement of a sustainability-related KPI. And the difficulty is, what are the right kinds of KPIs that are measurable, that are credible, that meet all the ICMA criteria for a good KPI for an SLB. And the one type of indicator that we found that where there was the most traction were water-related indicators. And it seems to be when it's water use, either water consumption or discharge or reductions in discharge of untreated wastewater, water intensity per unit product, for example, those kinds of water-related KPIs seem to be quite credible. They can be very closely aligned with adaptation. So it seems to be the water area where there's the most traction in terms of how we might apply sustainability-linked instruments to adaptation. In other areas, we've got more to do in coming up with the kinds of indicators that can be used robustly in the same kind of way.
Fantastic, thank you. And I think that sort of brings us very nicely on to Terry. So this is certainly looking at what companies are already doing in their plans. I know it's something that S&P has looked a lot at, so I'd love to hear from you.
Yeah, and happy to be here and talk about this topic. Yeah, last year we published some research. My colleague Paul Munday looked into the kind of progress in adaptation planning for corporates, and he looked at kind of 6,000 companies to try and understand what they were doing in terms of adaptation and resilience. And the kind of highlight finding that we have is that only a fifth of companies had any sort of adaptation plan. So when we think about the kind of level of investments, I mean, many companies it's not even on their radar yet. So this could be quite an interesting reason as to why there's not as much action compared to transition. So with those 1/5 of companies, we see very big differences across sectors. So, those regulated sectors like utilities tend to do better, but even there, only 40% of companies had something you could call an adaptation plan, so there's still a huge gap there. And many sectors that you might think are quite exposed, because they have maybe nature-based supply chains like consumer goods, aren't really doing so well on the planning side. So single-digit percentages in terms of companies with the plan there. And we also looked at the kind of quality of those plans. So, what actually are they looking, what are they addressing, and how are they thinking about the risks? So we kind of then did a deep dive on a sample of those companies to look at, how are they using scenarios, what timelines are they looking at in terms of adaptation and resilience risks, how are they factoring that into their financial planning and implementation, and as Craig said, what metrics and monitoring strategies are they taking? And we found, of course you would expect this, but there's such a big variation in what companies are doing in all of those areas. And also fairly intuitive kind of conclusion that we were able to draw is that those companies headquartered in regions where regulations tend to be a bit more progressive tend to do better in terms of the elements of those plans that they are doing. But mainly we see that most companies are at that just the kind of risk assessment stage, and they're not kind of fully addressing and integrating all of the risks into their kind of normal corporate risk management frameworks. But just getting back to what Craig said, on the face of it, some of these resilience and adaptation measures are a good match for capital markets, especially for things like bonds, because the benefits of those investments tend to kind of play out over very long time frames, and people buy bonds with the expectation that they're safe and reliable over very long time frames. So there is the potential there, we think, to do more. And similar to Craig, we are seeing most of the action has been in use of proceeds. If you look at all of the issuance, we think it's kind of single-digit percentages of projects that are financing adaptation in the labelled markets. But we also are seeing a little bit in the sustainability-linked area as well, just the same. But still early days, I think.
Yeah, thank you. And certainly, so in the work that we do with Climate Arc and others, we sort of see similar things in that a lot of companies are doing the low-hanging fruit stuff, but they're not doing the more challenging stuff that requires some upfront investment yet. So thanks so much. I want to now come on to more the investment perspective, actually, with you, Chris, first, if I may. Can you talk a bit about Impact's experience and what you're sort of seeing in the market in this area and where the opportunities might be?
Yeah, so first of all, I completely agree with the focus that you've given to broader resilience rather than just talking about climate. I'm actually going to speak about some climate-related opportunities, but I do think increasingly people are viewing adaptation and physical climate risk as part of broad corporate resilience, and therefore something that is self-evident and you should be investing in any event. That was really reinforced by my experience at New York Climate Week, where we deliberately sort of framed a lot of what we were talking about around extreme weather events. And, universally, everyone was just going, well, hang on, don't talk about that as being a climate risk. That's just a business risk. It has to be addressed in business planning. And I'm really interested in what you're talking about on adequacy of adaptation planning. The other thing we've got to face is that, at the moment, this is a really poor relation compared to mitigation. For every pound spent on mitigation, we spend about 5p climate resilience. So there's a massive sort of disconnect, and actually the need is way, way higher than that. So Impacts, as people may know, we're a specialist investor. We've been around for about 25 years. We started off by looking across environmental markets, and our starting point was to develop a taxonomy in order to justify and explain the companies that we were investing our capital in. And we did the same. We've done the same around adaptation and resilience. So back in 2018, we developed a sort of a climate taxonomy and identified a universe of companies that kind of sat underneath that, and deliberately we included adaptation within it. The solution side on mitigation was already covered in the environmental taxonomy. So we identified, now there are about 1,300 companies in that taxonomy. Around 200, in fact nearer 300, are providing adaptation solutions. And actually we've got an investment fund that we use that taxonomy for, which has about $2 billion worth in it, and around 25% of the AUM goes into the companies that are in that area. So what are we talking about in terms of those areas? So I think the first thing is quite a lot of it is to do with resilience of infrastructure. So electrical grid resilience is kind of a key theme, backup power and storage. Water resilience and water generally is the lion's share of the AUM that is invested there. It's actually very helpful. It's quite a defensive play at the moment as well. So that's been growing over the last few years. But also agricultural resilience, climate resilient crops. And resilient buildings and infrastructure, in particular, sort of air conditioning, but also trying to make sure that is efficient air conditioning. And then you get into some secondary adaptation effects, thinking about things like financial flows, insurers, the experts that are providing advice on modelling and testing. And actually quite a lot around human health. That's a really interesting area where we're seeing many more things around, again, forecasting that allows you to prepare for heat waves, but also diagnostics and treatment for vector-borne diseases that are kind of increasing as a result of malaria. Maybe 2-3 years ago, when we started looking at that, there was like a handful of companies there. Now you're sort of deluged by sell-side research that's kind of going, oh, we've got some new stuff on human health. So really interesting idea. I think the idea of sort of taxonomies, and we really support the climate bonds work on taxonomies. We're much more in favour of industry-led taxonomies than legislative ones. We just think that they evolve too slowly. can be politically contentious and therefore can slow us down. But working together on these taxonomies, you'll tend to find that the same company may appear under a different header just because someone's treating it as an agricultural revenue and someone else is treating it as an adaptation solution. So actually, when you look across Impact's investment universe as a whole, we've actually got a lot of our AUM is already in adaptation when we look at it. And then just a last thought, Nicola. So lots of investment opportunities out there, but I do think that investors really need to think about what they can be doing to help address the systemic risk as well, and using our own power to kind of engage with all of our key stakeholders. So that can start with the companies, following on the comments that Terry was making about ensuring they've got adequate adaptation plans themselves. That will, the more adaptation plans, the better those adaptation plans are, that will increase revenue flows and increase investable ideas around bonds. But also talking to industry. So that's not just things like the resilience taxonomy that CBI's produced, but things like Climate Financial Risk Forum that's been looking at how can we assess these risks in the same way, and actually talking to asset owners to encourage them to consider allocation of finance to adaptation solutions. And then the last and key player that I think we're being very slow in addressing on this issue are policymakers. You know, national adaptation plans are woefully poor, almost universally. What we really need to be encouraging is the same degree of specificity that we've now got governments doing through things like, hopefully, next week's clean carbon budget development plan, but things like the Net Zero Council, Transition Finance Council, that is kind of burrowing down into sectoral transition and what that needs to look like. What are the priorities by each sector? And then what are the financing instruments that we need in order to get those scaled up?
Thanks, Joshi. I want to come back to these points on the role of government, and you mentioned in planning, taxonomies. I'd love to have a discussion about, is there a role for government in taxonomies, actually? But let's come back to that in the discussion, maybe a topic of hot debate. But first I want to come on to you, Lisa. And I was really thrilled when I first spoke to Lisa in preparing for this. So one of the things I always say when I'm talking about private versus public finance on adaptation is you will never get the private sector to fund a flood defence. And I've been saying this for years. And then I met Lisa last week, who is financing flood defences. So I was absolutely thrilled, and I'd love to hear more about what you're doing. I'd love to be proved wrong. So.
Yes, no, that was a very fortuitous start to our conversation. But just for a bit of a context as well, and sort of our role in resilience investing as well. So I'm part of MetLife Investment Management, global asset manager, very large and leading private capital, private credit specifically business. A significant component of that is infrastructure debt. In fact, we're the largest infrastructure debt manager in the world, according to external sources. So in many ways, we've been investing in resilience for a long time, not necessarily maybe calling it resilience, because actually a lot of these are very good investments in their own rights, and actually using the flood defence example is a very good one. Maybe if I introduce that project, and also just a caveat, one of the challenges of working in private credit is that actually we often have very good examples to share, but given the private nature of the lending, we can't shout out the rooftop. So this is a great one that we were able to champion. It's essentially a flood diversion project based in North America, in the surrounding areas of the Red River in North Dakota and Minnesota. It's an area that's prone to increasingly frequent, increasingly severe flooding damage. Effective population size that's sort of 260,000 people or so, but a very a large area. And essentially, we are funding the design, build, and operation of a flood diversion channel. So when flooding is at risk, and also some associated infrastructure such as bridges and aqueducts, so that when flooding risk is there, basically, essentially, the water's moved. It's as simple as that. How does it work? It's an infrastructure project. It's a public-private partnership with essentially 5 municipalities coming together to form an authority that then looks for developers to design, build, and operate this project. quite typical of infrastructure investment. It has availability-based payments, which are also, you do have to hit certain operational performance standards to sort of continue for investors to receive these availability-based payments as well. So it's really just taking the classic infrastructure investment model for when there's a non-revenue generating project, but really applying it within resilience. One of the reasons we were able to be involved is actually due to the deep relationships and the size of MetLife Investment Management. So when this project was announced, in terms of it had gone through the relevant state-related procurement channels, we were able to actively approach the consortium that was selected to bring about this project, understand the funding model and a financing package, and offer something competitive. So that's being proactive. So we're directly originating, going out, looking for solutions like these, because we have the investor demand for it from a sort of classic infrastructure investment lens, but also those investors that are looking specifically for resilience investments, of which is a subset within several of our sustainable investment strategies. And really, so thrilled to have this example to talk about. And there are many more that we're involved in. I think, Chris, actually, you listed several. I think water is a very classic side of things, from waterway management, water infrastructure management. But I think there are also other areas to think about as well. We'd already talked about grid resiliency. Resilience is inherently important in infrastructure to operate efficiently. But also like to think about the social resilience as well, and that actually there are also other infrastructure assets such as social housing, temporary housing, for example, where yes, it's important for these assets to be physically resilient, but they also promote social resilience as well. And there are very different ways of thinking about resilience, and there are very practical opportunities to deploy capital. But yeah, the challenge is often, I think, willing to collaborate, having the flexibility to accommodate these types of assets that aren't as frequently represented in the market. So the fact that we're a private credit business means that we can offer something more bespoke and custom, and that really helps sort of break down some of these barriers to identifying and ultimately actually funding these types of projects. And I'm pleased to say the flood to the diversion project, the actual channel was built this summer. It's on track, which is great for infrastructure projects, due to be fully complete in a couple of years.
Thank you, thank you. And you mentioned also when we spoke about this sort of risk versus sustainability lens in your thinking and how that helps unlock things. Could you maybe say a little bit more about that?
Yes. So I think it's actually several of the panelists have already mentioned it. I think it's the classic way of thinking about resilience that's been more frequently deployed, and that's really around sustainability integration, be it whether you're looking at a corporate looking to issue private placement or an infrastructure asset. Just how sound is your long-term planning? Are you securing your supply chain against different weather events? Sourcing issues. Are you building in the right place? Do you have a good sound planning for future operations? It's also a way to engage those that are not necessarily, like many of us, singing from the sustainability hymn sheet. It's just tangible, practical risk. It often can be quantifiable as well. But what we see is that you need to see them side by side, because you can also build some fantastic, mitigation and resilience assets. But if you're also not, as we talked about, thinking about embedding, looking at resilience as a risk into them, they may not operate as well as you would expect. Which obviously can have financial implications as well as the impact performance implications. So it's really making sure that they're not either or processes.
Thank you. And Amelie, I think that sort of brings us very neatly on to you and the work that you do at BII and making this work in a development context, emerging markets. Over to you.
Yeah, so for those that may not know us, we are a British International Investment. We're the UK's development finance institution and impact investor, and we only really invest in Africa and Asia, and within Asia really that's primarily South Asia, although now also Southeast Asia. So, I mean, both of those regions, obviously very, very large regions, but are already very vulnerable and experiencing, whether it's from, typhoons in Southeast Asia to changing monsoon patterns in India to droughts or flooding, depending where you are in Africa, and extreme heat across, across both regions. We're already seeing increased frequency of these extreme events. So, and already seeing how that is having implications with our portfolio, within our portfolio. So I would say that, I mean, for us, we've sort of been on a journey, if you like, as we think about both climate risk and also the resilience and opportunity side. I would say, like most, we've sort of, fairly well, we understand fairly well, and we're fairly advanced when we look at infrastructure, long-lived assets, where we already have a very detailed environmental, social risk assessments, and where we've brought in assessment of climate-related, physical climate-related risk, as well as transition risk, has been embedded for some time in how we look at infrastructure. I think it's probably, though, and particularly going to the point that was mentioned around when we think about corporates, I think we're really at a much earlier stage, where most of the corporates that we invest in, don't. I mean, they may be starting to recognise that they're having increasing challenges from a business continuity perspective or problems in their supply chains, but not necessarily connecting the dots with what that risk is and where it's coming from, but also let alone thinking about how that risk is only going to increase in frequency as a result of climate change. So, the sort of need for them to have understanding and translate that into adaptation plans, we see as really, really important. And probably I should have said, I mean, as BI, we used to be, at one point we were a fund of funds, so big, and I think the biggest private equity investor in Africa, so a lot of focus on equity, but we increasingly have started to do more debt over recent years. So, so for us, we really think about the value of our investments, where we're either direct equity or via intermediated via funds or banks. And so for us, we've started to really integrate how we think about the risk, but also, more importantly, moving forward, how we start to really understand the value of resilience measures. And that, at the minimum, we need to see value preservation of those assets so that the value isn't going to be eroded as a result of climate-related impacts. But actually, as we start to build in measures to enable adaptation and resilience, how can that go beyond actual value preservation, more towards value creation? And actually, you would, I think it's quite likely in a number of the events I participated in New York Climate Week. I don't think I saw you there, but I was mainly in there were a huge number of events on resilience, particularly, I mean, not surprisingly within the US because of the wildfires recently and in previous years, huge focus on this. But, recognition that as we start to sort of build in resilience, those companies that are not building in adaptation resilience are going to lose value in comparison to their competitors. So, so we need to recognise where we are, and this is a very strategic business. Part of a business strategy. It's not a sort of on the side of this is a climate risk that we should, factor in because it's what we have to do under TCFD or whatever. It's actually core to business strategy now and being competitive, frankly. So, so that's kind of where we are, and we've been working with our DFI peers, and we've also started to engage with some others in the Institutional Investors Group on climate change, to think more around how we can start to shift not just our understanding, but also the really the conversation and where we start to apply KPIs and metrics, importantly, to better understand that value. Now, for equity, that would be value of that asset. But when you think about a debt instrument, then it's really going to be the credit quality. Actually, the credit quality of the underlying borrower is also going to be impacted by the extent to which you've built resilience. So we're also starting to look at that as in some of our directed lines to banks. So I did our first adaptation directed loan to a big bank in Pakistan where for climate smart agriculture, working with them, build their in-house capacity to understand physical risk. What does that mean as they provide credit to farmers? So they start to factor that in and build in what is needed to enable their farmers to, whether that's to look at new types of crops even, but new or different seeds, different planting seasons, the time in which you plant, etc., water, when to, and obviously in Pakistan they've been heavily impacted by floods, so also recognising that and the implications there. So, but we're now building on that experience. We're now thinking about how, and not thinking, we're actually talking to banks, how we can start to, based on KPIs linked to resilience, actually reduce the interest on that credit. Because we do see that is going to, those that are addressing adaptation resilience should be more creditworthy. So that's another economic/financial type of metric that we need to understand better. And then, of course, there's operational stability. And I think, just one last point I'll say now at this point, but the other area is, and I sort of alluded to this a little bit in the US, but is critically the insurability. At the moment, even though the insurance industry obviously has, particularly the reinsurance industry, very deep knowledge of the fact that climate-related risk is materialising, but is going to increasingly become material. And yet, as of now, I think very limited translation of that into the products that the insurance industry would provide, and critically, a recognition where adaptation resilience is being built in, that should then reduce the premium. If you have, it's sort of almost seems so obvious in a way. If it's like at your house, if you have a burglar alarm and you have good locks on your door, your premium's lower. That's not yet happening with adaptation resilience. And what that means is if you as a company, you're able to, you identify your inherent physical climate risk, you put in place various measures to build resilience, well, then you end up with a residual risk, which will be lower. Assuming you've done good adaptation, you have a lower risk, that residual risk. That's the bit the insurance industry should be focusing on, not trying to insure the inherent risk, but the residual risk. So, that's where we need the right kind of understanding and then metrics to be able to get to that place. So we translate the benefits of resilience into real economic and financial related outcomes and impact.
Thanks so much, Malika. And I think, I don't know if anyone saw in Bloomberg this morning, there was an article on the US economy saying that 8 trillion of the US economy's growth last year could be attributed to investment after disasters. So actually, not in a good way, but even in the US, there is evidence that adaptation is boosting growth.
But interestingly, and actually, so as I lived in the US for quite a few years, and actually this agenda is quite advanced in the US. That's also partly, every time there was a big hurricane like Katrina, Sandy, FEMA used to inject a huge amount of public funding into the US economy that actually was often, would get SMEs, entrepreneurs who were coming up with ideas of how to respond, would be able to access that public funding. That funding is being cut now, so we'll see moving forward whether you still see that same, particularly the sort of innovation that emerges post these major disasters. It's going to be interesting to watch, really.
I think your point on valuing resilience is really important, and so we've done a lot of work looking at sovereign bonds as well, and you can see that if countries invested in adaptation, it should improve the creditworthiness of their bonds. You can see that in many developing countries. So this sort of valuing resilience is really important, and certainly working with banks ourselves, we can see a lot of banks starting to innovate in that area. It's really great to see. So I'm going to come and open up for some questions in a moment, but we'll just sort of continue the discussion. So prepare your questions, because I will come to you, and hopefully we'll get some good ones. Maybe we'll come back to this point on barriers and challenges, and the point on the role of government in this area. So what do you see as the role of government in terms of providing frameworks, plans, etc., to help catalyse more in this area? So what would be your wish list for government? Anyone want to respond on that?
I mean, I'm happy to respond to that, partly having worked in a multilateral development bank where I did work with governments helping build their capacity and institutional arrangements to do exactly this, so having that experience. But also, I think, I mean, Chris is right, a lot of these national adaptation plans we see have been really not very substantial, and certainly not from the point of view what that means for the private sector. That said, I have some of the latest vintage and a couple where we actually invest. We've seen in Zambia and Nepal, two countries, I mean, the sort of LDCs, so really vulnerable, poor countries, have actually benefited from a lot of funding through the pilot program on climate resilience, which I won't go into. But actually, and in fact, I think it was UNEP that supported Zambia's SNAP. They're getting a lot better. I mean, taking a more system-wide approach, looking at where are the climate-related risks at a system level, and then how to address those. And a lot of the science behind that is really very good, I would say, in that case. That said, it still requires, as a, we're a DFI, we will go the extra mile to look at how we can do as much investment in a country like Zambia as we can. So we will, take that information and we'll use it internally to identify, well, how can we invest to support resilience in that country. But ideally what we need is governments to actually start to translate all of the scientific and all the data they have and the understanding of the system-wide approach, and then start to integrate that into their public policy, public incentives, whether that's via public funding, expenditure, fiscal incentives, and then also policy and regulatory, so building standards or certain minimum requirements for all sectors ultimately that demonstrate resilience. So that isn't yet really happening. I don't think it's happening anywhere consistently or systematically. We probably have some good examples of in some sectors in some areas, but I mean, it's really quite urgent, because we also know that no government is going to be able to invest the amount of public, or the amount of finance and funding that is going to be needed to build resilience. So getting much smarter at using public resources, whether through policy, whether through public or fiscal expenditure, to incentivize the private sector, and not just ensure that the risks are being shared, but the rewards and benefits of the investment are also shared, is going to be critical.
Sorry.
Yeah, just to emphasise that point on the system thing, no one company, no one government can solve system-level problems on their own. It's implicit that you need to have a joined-up approach. So I think, although there was a comment about government-led taxonomies and things like this, things like that can obviously bring more clarity and consistency in terms of what we're measuring. And I think the key thing with systems is its outcomes, not necessarily outputs. So you can reinforce networks and do the hard stuff, but really what's important is that the network is able to still deliver the service that society needs. So I think, alignment there between all these different stakeholders is really critical if you want to get those benefits out.
Yeah, I mean, so what I think we talked about frameworks and plans, and I think that's absolutely right, but I think what we need to be doing more of is just getting clarity around where the real hotspots and real priorities are, and then solving for those. So really interesting to hear about Lisa's example. That's basically that kind of thinking where you're actually working out how to address flood prevention by using private capital. We're going to have to do that increasingly. In some spaces that means you've got to. So one of the things we did when we were looking at this problem was trying to engage with particular sectors that we felt were really instrumental or faced sort of massive risk. So an area we looked at was utilities. And actually, when you start to engage with the utilities, the extraordinary thing is that, I mean, it's part of human nature and risk management generally, is that you can't really envisage a worst case scenario until you've experienced it. So PG&E's actual plan is now pretty good in terms of its resilience plan, but the only way you overcome that is probably by regulation. And in California, it is mandatory for utilities to develop adaptation and resilience plans. We've now got a stage, at least in the UK, where our water companies are properly starting to think about this, and after decades of underinvestment, our water bills are all going up as a result of it, but at least that's a mechanism for trying to address the problem. So I would say that there's going to need to be some mandatory adaptation planning, but also some smart, that we need to work out how to deal with municipalities. I can't remember what the stat is, but it's a really high level of infrastructure that is owned by municipalities. But no one's even thought about the muni bonds market and how actually you could start to think about, well, which municipalities have got really good adaptation and resilient plans, and then does that create an interesting asset class to be investing in? And then I think the other two thoughts I've got are, one, supply chains. So that is the next place that we're going to take our sort of engagement, is thinking about hubs and transport logistics where lots of people are exposed to an issue, but they haven't really understood that. I think governments could help us get a grip on that and again identify hotspots. And the last one is around valuation. And I'm really interested in the work you're doing there. You can start to assess. We've got the information out there to assess risk, and Nicola, we did some work together a while back on thinking about how do you convert those risks into real financial impacts in terms of reduced revenues while you've got outages at a data center that's too hot to work anymore and stuff like that. So we can start to see what the potential exposure is. We're really poor at working out how you then give a benefit to someone for an adaptation plan. So whether that's a government job, I don't know, but I definitely think there's a question around us, governments convening conversations around private sector actors to solve for that kind of challenge, I think is a role they can play.
Can I just add a comment on that?
And then I'll open it up. Yeah.
I think it's the convening coordination is really important, because there's also historically a bit of a question like who owns the responsibility to build resilience. Is it government? Where in government? Is it the business operating in certain areas? Even in the flood prevention project, when you've got different states involved, for example, in already an advanced economy, there's still a question of who owns sorting this problem. Just to give you a bit of context, that project took almost 20 years of study before it could get to the tender stage. And that wasn't particularly slow in that sense either. Let alone if you're in the private sector, in the corporate world, and what we see in lots of corporate physical risk assessments is they actually rely a lot on government regulation. We already know, we've heard that actually they're very high level sometimes, and sometimes the gaps they identify huge gaps. But the question is, well, who's going to fill that gap? Is it government? Is it private sector? There probably just needs, is that better joined up thinking, communication, and understanding it's shared responsibility, that not one side is going to fix it, because I think historically it's been seen as a bit of a government-led issue to solve, trickling through now, but overwhelmingly you do still see more of a reliance on government to build more resilience, and to do it more practically. So yeah, it's building in capacity in the corporate side, assuming more responsibility, and making sure the parties are joined up.
Which actually brings me to one of the things I often hear is a barrier on adaptation and nature as well is it's all quite complicated. You know, it requires a lot of specialist expertise. It's not, you know, we need people that really understand this stuff. And I often say a key to adaptation is making it easy. But I know, Craig, you wanted to come in quickly.
Just briefly, I know you want to open it up, so I'll be really brief. What can governments do? Well, two more ideas to add to the pot here. One is this kind of disconnect between adaptation planning and investment planning. We see it all the time. Interesting point Chris made about government-led taxonomies versus industry-led taxonomies. One thing that we see with some national taxonomies is the motivation for a country thinking about adaptation in the context of its national taxonomy is because it sometimes wants to think about bringing adaptation into its sovereign bond framework. One example of that I can think of is Brazil at the moment, where it's, they brought adaptation, they made it prominent in their taxonomy with a view towards making it prominent in their sovereign bond framework, so to integrate adaptation more into the way that they structure their sovereign bond issuances. We find it quite striking that there are many countries that you can look at which are investment grade, which are issuing sovereign bonds, which are issuing sovereign sustainable bonds. They're very climate vulnerable. They're not integrating adaptation into their sovereign bond frameworks. It's kind of a real missed opportunity, and it speaks to a wider issue about adaptation planning being kind of divorced from mainstream investment planning and public expenditure management. Often adaptation is in many countries dealt with in an environment ministry. Even in the UK, it's DEFRA that leads on adaptation. It's often seen as being an environmental issue dealt with by an environmental line ministry, as opposed to being plugged into, say, a Ministry of Planning or Ministry of Finance function. So there's that whole issue there about how adaptation is often sidelined, even in really sort of low-hanging fruit, like structuring sustainable bond issuances. Second point to make really quickly is about sustainability disclosures. I think physical climate adaptation and resilience have always been a bit sidelined in the discussion around sustainability disclosures. That's always been the case. I think also when you look at kind of the way that ISSB has taken its very sort of pretty strict single materiality focus, it's not conducive towards drawing out that kind of information and disclosures that you really need to, to build on resilience.
Thanks so much. I wanted to give it a little chance for everyone to ask questions. So I'm going to take 3 quick questions and put them to the panel. Who's got a question? A really good, challenging one. Okay, at the front then.
Andrew Ross from Global Garden. It's to you, Amal, if I may. Insurers have been issuing catastrophe bonds for many years now, and it's rapidly developing. But these are essentially reactive to events. But insurers have $23 trillion of assets under management. Why can't they invest proactively?
Okay, question. That's first. Let's have a couple more, and we'll give them to the panel together.
Harish Ahuja from NSC. My question is very specific, Chris. Chris, you talked about municipal bond around adoption resilience. And this is very important one because right now in Indian muni bond is developing, but basically they are coming from creating the assets like solar or waste water treatment plant, riverfront development. But I think this is a brilliant idea. Do you have any specific example where mini bond has been raised for adoption and resilience? If you have some specific idea, I think we can carry home and launch it, I'd like to listen more about this. A very interesting idea. Thank you.
One more, or should we leave it there? I can't see any more hands. No? Okay. Answers.
I mean, I obviously can't speak for the insurance industry, but I do think they are now starting to, think and doing their research and, with a view to changing how they respond. Of course, you have the underwriters, and then on the investment side, they are very risk averse, extremely risk averse. So, I suppose one of the questions there is the extent to which as a sector, in the insurance sector, can learn more from what they know about risk on the underwriting to actually start to incentivize more on the resilience side as an investor. So I don't really want to speak for the insurance sector, but clearly they have some way to go and a lot of relevant expertise that should be harnessed much more effectively on both sides of their business. I also just wanted to double down on one point, but just sort of as we were saying on governments and who's paying, and a little bit based on what Craig said, we also need to recognise that in the way, I mean, it's almost similar to, you know, renewables, that the fossil fuel sector has been heavily subsidised for decades, which creates an unlevel playing field. What you see in many cases is the agriculture sector, many countries, has, you know, a lot of really inefficient subsidies going in that has a huge strain on the fiscal budget. Similar on water. You know, all of these are often disincentivizing measures in resilience, which is, you know, if you're being subsidized regardless of what you're doing with your water or your, you know, then there's limited, in fact, no incentive to start to invest in more water resource efficiency. So governments also, you know, and that is the role of treasuries and ministries of economy, need to start to recognise this is a fiscal drain that then feeds into issues like sovereign ratings as well. But again, that does require some sort of joined up thinking. And as you say, exactly as you say, Craig and Nicola as well, you know, that it's not just, this isn't a Ministry of Environment issue only. They may provide the data, but ultimately it's the Ministries of Economy who need to be, or Treasury, that are addressing those.
So we need to wrap up there, but if someone could, in their final closing 20-second takeaway message, address the question on an example of a resilience bond as well, that would be great. But 20 seconds each, key message for the audience. Lisa, if we start with you.
Yeah. I mean, I think it's just see resilience as a really compelling investment theme. In a warming world, we need to build more resilience. There will be a role for private sector solutions and government solutions. And clarifying that in your investment strategy is important.
Thank you, Lisa. Chris?
Yeah, already investable. Go out and look at what's being offered, and investors have a role have agency in actually how to kind of engage with a broader stakeholder set, as well as talk to ourselves and, you know, share our solutions. A good example of that on the muni bonds would be, you know, this came out of a conversation in New York Climate Week where we were trying to kind of just catalyse some discussions around investment opportunities. So someone made the comment that actually there are some really good plans at the municipal level. C40 and others have been doing that. And then when I went and spoke to the muni bond specialists who were in the room talking about climate, I was saying, well, have you done this? And they said, no, they're just generally issued as standard bonds, and you don't have green, you know, or tagged resilience bonds for municipalities. So I think they didn't have any examples, and that was someone who's meant to be an expert in the area. So I'm afraid we don't have examples yet, but, you know, maybe we could get the Climate Bonds Initiative to do some work in that area.
I cheekily just add in on that. I bet if you looked under the hood, there'll be several qualifying.
Yeah,
it's just
exactly. They just haven't.
I mean, does Miami issue bonds? I mean, there's no way it's issuing a bond without resilience measures because it's underwater.
Yeah. Several water authorities, uni-level. Yeah. Sorry.
Was that your closing 20 seconds?
No, I will just say in this, I think really adaptation resilience, or ANR as we said, it's the unavoidable investment opportunity.
Good, thank you. Terry?
Yeah, I totally agree with all those sentiments, and especially the under the hood. I think just the same with transition. You know, many investments will benefit adaptation. They just might not be labelled as such. So anything we can do to highlight what the key data points and things like that are will only make that more transparent for everyone.
Really quickly, I think we need to see more success stories. We need to see more good examples of well-structured commercial investments in adaptation and resilience. I think the Tokyo Metropolitan Government Bond is a good example of that. It's really rewarding to see, you know, good practice and good thinking on adaptation actually being translated into an actual real transaction. I think we need to share more experiences and lessons around transactions like that.
Fantastic. Well, thank you so much, everyone. Let's thank our panel. And thank you all for listening.
Thank you, everyone. We've got 2 quick OnSwitch sessions about to come up to start. I do want to say Surat in India issued a certified climate bond a few days ago. Resilience measures, for Chris's benefit, 8 times oversubscribed. The Tokyo bond, way oversubscribed. Vadodara in Gujarat issued a certified green bond for resilience about a year and a half ago, 11 times oversubscribed. So they're beginning to pop up. It's just that the West is a bit behind. Emma, thank you for joining us today. And Rusmir, this is a quick session, 5-minute OnSwitch sessions about property and buildings. Emma Harvey-Smith is a Managing Director of Partnerships of the Green Finance Institute. And Rusmir is Senior Operations Officer, Global Cooling Lead at IFC. Emma, you're on. Up here.
Thank you so much. Real pleasure to be here today. Got 5 minutes to run you through some stuff on new asset classes for investing into decarbonising buildings. I'm hoping this clicker is going to work. Fantastic. There we go. So as Sean said, my name is Emma Harvey-Smith. I'm the Managing Director for Partnerships at the Green Finance Institute and one of the co-chairs of the Global Property Linked Finance Initiative. So I don't think many of you need me to tell you that decarbonising the built environment is absolutely essential for meeting our global net zero goals, as well as ensuring that our built environment is resilient to a changing climate. Yet we face a staggering investment gap. We need $34 trillion of investment by 2050, and yet in 2023, only $244 billion of investment went into energy-efficient buildings. And in fact, that was a 4% drop from the previous year. So it's absolutely vital for us to decarbonise our buildings, but there is clearly a gap that traditional finance is not meeting, and traditional finance is not moving fast enough. We need a new financial asset class that can bridge the investment gap, and that's where property-linked finance comes in. Property-linked finance, or PLF, is a proven financial solution that funds energy efficiency and climate resilience improvements in buildings. It is a form of long-term affordable finance for property improvements. It has repayments that are tied to the property rather than the property owner. That is a very unique feature. It can fund up to 100% of a retrofit or resilient project's costs, both the hard and the soft costs, and it can be passed through to tenants, so it helps to address the landlord-tenant split incentive we see when retrofitting buildings. And equally importantly, it is a low-risk, attractive investment opportunity for investors. Now, this solution is applicable for decarbonising commercial buildings, residential buildings and multi-family properties, and it can be used for both retrofitting but also for energy efficient and resilient new build construction. So it's an incredibly flexible solution. And we know it is also scalable and adaptable to local systems. This solution already exists in the US, and it's delivered, or the repayments are captured through a tax mechanism. That's how it's also been developed in Australia and in Canada. But it can also be delivered and repayments captured through existing property laws and property law-based approaches, which is what the Green Finance Institute is developing in the UK and Spain. But despite success, and as you can see on the slides there, this solution is already available in a number of states in the US. It's available in Australia and Canada. We've seen $18 billion mobilised towards energy-efficient buildings in the US alone, and solutions being developed in the Philippines, the UK, and in Spain. This solution takes years to launch and to scale into a sizable investable market. And this is due to fragmented development, but also due to regulatory hurdles. And so this is why the Green Finance Institute, in collaboration with the Climate Bonds Initiative, has established the Global Property Linked Finance Initiative, an initiative that's focusing on unifying and accelerating this incredibly impactful solution globally. The Global Property Linked Finance Initiative, or GPLFI, is structured under 3 pillars. The first pillar focuses on creating a global pool of resources that can help market participants develop PLF within their own market. So at New York Climate Week, we launched our PLF principles, which outlined unifying principles for what this solution should look like worldwide. In the new year, we will be publishing the PLF pathways, step-by-step guides for how you can actually launch this solution in country, as well as a load of best practice guidance from existing markets so we can make sure these solutions are top quality. Pillar 2 focuses on building political momentum. Our ambition at COP31 is for countries, a number of countries and finance ministers and buildings ministers to commit to launching this solution in their country so they can provide an additional financing tool for property owners in their country to fund retrofitting. And then Pillar 3 is about providing in-country technical assistance. We will be establishing a series of PLF accelerators that will provide deep legal, product development, market engagement and political influencing support, alongside capital markets vehicles that can help increase both liquidity and pricing of these early markets. And it's important to say all of these steps will be tailored to the local contexts of those markets. Now, we've already launched the consultation version of the PLF principles, as I mentioned, at New York Climate Week. Please do have a look at them online and give us any feedback. They are based around 6 core principles, as you can see on the screen, which then derive into 5 key product features. As someone who's been through the development process of trying to develop a PLF solution in the UK, this would have been very helpful to have to hand. So please do have a look. And if there's any markets you think this could be useful for, please get in touch. But the Global Property-Linked Finance Initiative is not just about a series of publications. It's a platform for pragmatic action. We're actually looking at an asset class with immense relevance to the climate bond sector. We've already seen the momentum building. If you just look at the US, you can see that US PACE loans are being bundled up into green securitizations, and organizations like Nuveen Green Capital have already surpassed $1 billion of green PACE issuances. So this is not just an exciting initiative, it is a signal. It's a signal that the market is ready, that the potential for PLF to help the next wave of green property bonds and securitizations is not just promising, but it's transformational. So please join us, be part of the initiative, and share with us any of your feedback and help us in championing this. Thank you very much.
Hopefully the mic works if I walk around a little bit. Thank you again, Sean, for having me. Today is actually my birthday, so I'm very much committed and committed to being here. And the reason I'm committed is that real estate, one of the areas I work in, is the world's largest asset class. Everything humans do is in a building. We live in a building. We probably die in a building. We work in a building. I guess this used to brew a beer here, and now we're meeting up. And the idea behind it is we do have solutions that can help you. So Sean told me to energize you, so I'm going to do it by scaring you, which is to show a picture like this. And this photo was taken in the US, in Kentucky, I believe. And it's an example that we continue to build real estate that cannot withstand climate shocks. And if you can imagine, this photo is taken in the US, what this picture would look like in the Philippines, in Vietnam, that are facing typhoons, rising sea level, and other areas. Another scary picture, you may remember this. This was actually a talking point that was used in the Clinton-Trump debates. It's interesting that obviously we're referencing the United States today, and this was one of the talking points. But for you as investors, the question is, do you know what your vulnerability is? Do you have a way to actually measure it and disclose it? Do you have any idea what money you have to put aside in case of damages or defaults? How would you disclose that? It was to insurers. There was a big discussion right before. So climate change is the big villain. It's the big scary part in our scary movie, but hopefully at the end of it, when the villain gets defeated, we do have lots of tools for you. And one of the answers from IFC is the Building Resilience Index. So through the BRI, we can help you identify hazards, we can help you manage them through best practices, and then disclose them through a third-party verification. And while other tools may be able to do this for a fee, we actually do it for free. So IFC straddles the development and the investment sides of things, and we launched the BRI as a public good using our donor finance, including the UK. We will help you identify risk. We use hazard maps across 4 vectors: wind, water, fire, and geoseismic areas as well. This is a hard slide to see, but it will show you how we mitigate, help you mitigate the risk. Basically, you will get a compendium of best practices that relate to each of the hazards that are being identified for that particular location. So if you don't have to worry about fire, you don't have to go through it, but if you are in the places in the world where you have to identify this, we have a way to help you go beyond the local building code and incorporate that into your building. And finally, we help you disclose that risk. And this is a standardized approach that is harmonized with other disaster risk preparedness mechanisms. So again, it can feed into resilience bonds and others. It was a big, topic of conversation earlier. And you as investors or second-party opinions or others who are consultants here, you will get the information on an asset-by-asset basis, and you will get this info on a portfolio basis. And that portfolio approach also will let you know your exposure, remember, to the 4 vectors. So if you are investing in the Philippines and a typhoon is coming, you would know the vulnerability of your portfolio, you would know the likelihood of defaults in the investments that you have made specific to the typhoon that's approaching, and you can make preparedness down the line. So identify, measure, and disclose. We're very excited that we have done a number of partnerships around the world for companies that are already using BRI, and you can see they're going from housing to commercial, from developed markets to emerging markets. What we are really excited is our partnerships with insurers. So our first partner is QBE Insurance in Asia, and we're working with them exactly to incorporate BRI's methodology into their risk assessment practices. And we invite all of you to come talk to me in just a little bit, and we'll share the information with the contact info for the team to start doing it in your practices as well. And we have a lot of other info that's available. So do take out your phones and scan the QR code. We just published this about 2 weeks ago, our Sustainable Buildings Finance Reference Guide. And again, this is a compendium of all of the resources that we've put together, from green buildings down to blue finance, circularity, looking at resilience, with a step-by-step approach that an investor or a corporate that's looking to do this can follow, and illustrated by best practices and case studies of companies that we have seen around the world. So we're here. The world does not have to be scary, and we have a very specific place for you to start kind of peeling back the layers of both green and resilient buildings. Thank you.
Thank you. Please catch them at coffee. It's a coffee break now, and then we'll go into the last 2 sessions. And can I ask the photographer to come up, because I want photos of our 2 fantastic partners. And we're going to put this background. Thank you for joining us again for this short, sharp, dream team panel. You'll see why in a minute. Our Climate Bonds dream team. This is about new frontiers. Well, I'll let Bridget Bull, who's our moderator, to explain in more detail. Bridget, who is, well, the 2nd longest surviving Climate Bond staff member after me. In other words, we've been working together for a long time. Please join me on the stage. Director of Technical Advisory or Development, some flash title anyway. Please. All yours, Bridget.
Thanks, Ron. Very good, thanks, and welcome to the Graveyard Shift, everyone. It's very nice to have some of you still in the room. And for this Graveyard Shift, we have something really quite special, some sneak peek into the work that we've been doing behind the scenes at Climate Bonds. And Sean said the dream team. I like to think of us as like the Climate Bonds intelligentsia. So, you can think of us as that. That's also fine. And yeah, we'll give you a sneak peek on some of the work we've been doing, but particularly trying to figure out some of the really hard stuff, the really big stuff. So we know this is going to be, we've been talking about transition, et cetera, but the transition is not about unicorns and rainbows. It's also about dirty stuff, about complex stuff, about really hard and difficult to get your head around stuff. And so we really, really have to talk about that. And at Climate Bonds, we've never been too afraid of getting our hands dirty and dealing with some of this really tricky stuff. Because in these difficult sectors, we have really huge opportunities, and today is very much about opportunities. And so these are really pivotal. And so today we're going to have a beauty parade of the difficult, the gnarly, the warty, the ugly, the dirty, with my beautiful panelists. Ana Diaz and Reyes Tirado, if you want to come up. Ana is our energy lead, and Reyes is our agriculture lead. And we're going to take you through some of the opportunities in agriculture, in oil and gas, and also in mining, which will be me. And yeah, we'll deal with some of these tricky things that we're going to do. So I'm going to hand over to Ana first. I've given her 5 minutes. Okay. Oh, no, sorry, Reyes first. Sorry, Ana. I've given her 5 minutes to take us through some of the things we need to know and get our head around when dealing with agriculture. This has always been my nemesis, agriculture sector, because it's really difficult to understand, really difficult to deal with. So luckily we've got Reyes here to guide us through. So Reyes, I'll hand over to you.
Thank you so much, Bridget. Thank you so much, Bridget. So, we are at a very critical moment. While we see capital flows going into renewable energy, into electrical vehicles, there is a massive blind spot. This is agri-food businesses. Besides representing 1/3 of global greenhouse gas emissions. Why? Because when we talk to investors, they only see red flags. Too complex, no pipeline, not enough scale, too context dependent, no clear guidance. The result? Usually in green investments portfolio, agri-food gets neglected. And this is despite being 1/3 of emissions, I repeat. Some estimates say more than 40% of emissions come from the agri-food system. And when we get away the noise, two main pain points remain. One is what is green investment in agriculture? For example, there's no EU taxonomy, so investors are in the dark. Second, how do you track progress? It is really hard to monitor agriculture because when you're monitoring agriculture and climate, there are 3 greenhouse gases you need to follow. CO2, we all know about, but there's also methane, CH4, nitrous oxide, N2O. Here's the kicker. Methane and nitrous oxide are many times more potent than CO2 in global warming potential. Methane is basically natural gas. Nitrous oxide is commonly known as laughing gas. But there's nothing funny about the climate impact. The good news, the technical solutions exist, and they're already being deployed. Monitoring platforms like Cool Farm Tool or Satelligence are already being used by investors to tracking where progress is happening. But to eliminate investors' uncertainty, we need unified market-accepted standards. And this is why in our team, we have been developing agri-food criteria for green investments. And they are covering the whole food value chain, from the farm to the fork, and they offer precise green qualifications for what investments can be, including methane abatement under the Global Methane Hub program. Finally, I want to leave you with where is the action and where your commitment can make a difference. I'm going to talk about 4 main proven opportunities. First one, Brazil cattle transformation. Cattle is basically a very big methane leak, and there are 2 complementary strategies that are very much needed. One is optimizing, for example, making degraded lands, degraded pasture restored, and making sure that every kilo of meat or every kilo of dairy emits as little as possible. But we also need diversification. Diversification away from cattle and into other high productivity crop systems, like, for example, cotton, soy, or corn, that is already proving in Brazil that the land value can multiply by 4. So they're not theoretical, they're already opportunities that are taking place and they're growing in scale. Second one, is rice in Asia. Rice paddies are also a very important methane factory. Again, there are already new practices and digital tools that can help reduce emissions while increasing profitability. There's platforms like rice.farm that are scalable advisory service in Asia that are showing that yields can increase for farmers 6% while reducing methane emissions and increasing the profit of the farmer. So that's the second opportunity that is being deployed at the moment. Third is biochar. Do you know what biochar is? Probably not. It's just overburnt wood or other biomass that converts into carbon that lasts centuries in the soil. This is already being invested a lot in, starting to, from Google, for example, Microsoft, and it's turning into a technology, carbon sequestration technology, that is gaining a lot of traction. This, for example, biochar is already included on a bond that was issued last week, $500 million bond by a bank in Sweden called Landshypotek, and they have a green bond framework based on the agri-food criteria that is including these measures, for example, on biochar. So there's signs in the market that something is moving. The fourth example I want to leave you with is regenerative agriculture. And for example, Mad Capital has just closed a fund oversubscribed with $78 million just on transforming land towards regenerative organic agriculture in the US mostly. So, examples show that the capital is moving, they're waking up, but the shift demands your commitment. And there are examples. Climate asset management is converting thousands of hectares in Brazil and Australia to convert to sustainable agriculture. Mirova has a $350 million fund investing in natural-based carbon solutions investments. But this movement, but it's stopping at the last mile. The question is not whether you will be part of this transformation, because you will. The question is whether you will today commit to including these opportunities from the agri-food criteria in climate bonds into your next financing mandate. This way, we can already bring some light into this very massive blind spot. Thank you.
Thank you. Thank you, Reyes. Very interesting. Now I'm going to the most ugly sector. Your words. So please follow me during the next 5 minutes. I will introduce you today to one of the most decisive opportunities. Yes, it's the most important opportunity to fight against climate change, which is methane abatement in the oil and gas industry. We heard this morning in the conversation between Sean and Doris, Doris was mentioning about the carbon intensity of a barrel. What is this? This is exactly that. Most of the carbon embedded in a barrel when you operate and produce the barrel is because of methane leakage or escape to the atmosphere during the process. So that's exactly it. We're talking about the methane in the oil and gas operation. I am the Energy Transition Lead and Climate Bonds, and I was responsible to develop for the last year the methane abatement, financial methane abatement guidance for the oil and gas industry that you can find in the QR of your badge. So behind there is all the report that we are referring today to. So what is the context? Climate bonds overarching context for the sector is aligned with the International Energy Agency net zero pathway for 2050, so the net zero pathway, when oil and gas are phased down. Why I say that? Because the International Energy Agency net zero scenario show a step decline in oil and gas demand, more than 75% for oil and 55% of gas by 2050. This means no new deals of oil and gas fields development are needed beyond those who are commitment in 21, okay? This is what we are heading. But the reality is that even in the most ambitious scenarios, we will still have to deal with oil and gas production in the next decade. And when you have gas production, there is methane leakage to the atmosphere. So we need to deal with that. Let me be clear. There is no way we can reach 1.5 pathway without reducing methane. We don't reach 1.5 pathway without reducing methane. This is how important it is methane leakage into the atmosphere, because already Regis mentioned it. Methane is 80 times have more global potential than CO2. So when you escape 1 molecule of methane, it's like putting 80 molecules of CO2. This is how important it is. The good news is stay in the atmosphere for 10 years. So it's the best thing that we can do in the next decade in order to have a chance to reach 1.5. That is where the methane guidance that we were developing with combined with other international organizations under the umbrella to the Global Methane Hub came in place. It provides clear performance baseline to facilitate the delivery of real large-scale methane reduction projects. Net emissions. We provide net emission for methane in the oil and gas through the guidance. Indeed, the oil and gas sector is one of the world's largest sources of methane emission. First is agriculture, and the second is the energy sector. I'm going to show you. It's already here, so you can see here. So, indeed, it's one of the largest emitters of methane. But it's also true that the oil and gas sector is where the most immediate and cost-effective reduction can be made. Why? Because this is because compared to the other sectors, as you can see the other picture in the previous picture, the emissions are concentrated and located. You can see rice field, they are the whole field, or cows. But here they are concentrated and located, meaning it's easy, cheaper to capture. So that is why reducing methane from oil and gas is one of the biggest and fastest ways to cut global warming. Keep that in mind, please. Today, the sector emits around 80 million tons of methane each year. Multiply by 80. Can you make the calculation of how many CO2 that means? So, and the level haven't gone down much over the last decade. In fact, new satellite data show emissions are often higher than what officially reported. What a surprise. There is some report saying that we're even underestimating the emission in 70%. This is a lot. So the good news, much of this methane emission can be easily avoidable. They come from leaks in the pipeline. You can see here, this is a satellite because you don't see that with your eyes. Venting in the oil field. So usually in the oil wells, they need to deal also with gas. So they put it right to the atmosphere. This is venting, right methane into the atmosphere. And then flaring, when you have the refining of gas or oil, there is this flame that you can see, that is the flaring. All these practices can be eliminated using technologies that already exist. 18% of the cases, the technology is mature. And doing so even save money. Why I say that? Because methane is the product. Methane is gas. So don't throw it to the atmosphere. Commercialize, sell it. What can be done? In the guidance, you can find an extensive taxonomy of no-regret activity to reduce methane emission. These are the guidance, and I say you can find it in your badge. For instance, and this is the most technical part that I'm going to talk with, it's 10 seconds, bear with me. There is advanced leakage detection and repair, so detection with satellites, with sensors, so you see where they are, you see the leakage, and then you go there and repair it. Easy, cheap, and very efficient. We also have a vapor recovery unit and closed system can be used to reduce venting, and flare gas recovery and improve efficiency can be used to reduce routine flaring. Keep in mind that as of October 25, 36 countries and over 100 organizations, including oil companies and development institutions, have officially endorsed the World Bank Zero Routine Flaring by 2030 initiative. So this is already in place. The technical part is gone. Investing in these three measurements is a credible and practical way to reduce methane emission in oil and gas operation. So I present you with the three solutions. What are the challenges? the main challenge, and this is something that you know better than I do, the first major challenge is credibility and the need for strong guidelines, understanding what is credible and substantial in the oil and gas sector, what is technically difficult and reputational risky. Okay? So we need clarity, consistency, and transparency. And that is exactly what the guidance responds directly to these needs. It's define what qualifies as methane abatement with precision, set up robust baseline methodologies, and introduce transparent performance metrics. The goal is simple, to give the financial community confidence that their investments are driving measurable impact, not just good intention, net emission reduction. That is the delivery. By establishing these guidelines, we are not only protecting capital, we are accelerating the transition to a low-emission future with integrity. Please use it. Come back to me. Use it. The last challenge is incentives. Despite this clear technical feasibility and economic advantage, as I told you, the industry has consistently underinvest in methane abatement. So the last solution is you. Please, next time when you engage with the oil and gas industry, ask them directly, what are you doing for methane abatement? Or even if you sit down with the policymakers, what are you doing? What are your regulations for methane abatement? For investors, the key takeaway is that pressure to act on methane is only going to intensify. Companies that move early on abatement will be better positioned, while those that don't will face growing regulation and financial risk. That's scary. This is the methane moment, and it's CH4. You will hear that. No CO2 anymore, CH4. This is the methane moment. Methane is no longer a side issue. It is central to the energy transition. By aligning technology, standard, and financial, that's what we do in the guidance, we can turn commitment into action and action into impact. Let us use today, and thank you for staying, the discussion to build momentum, forge partnership, and accelerate solution, because every ton and methane that we cut today buys us time, and time is the most precious asset we have in the climate fight. Thank you so much.
Thank you, Anna. Thank you, Reyes. So we've dealt a little bit with agriculture, which is a really complex and to do with methane, oil and gas, really tough sector, obviously very dirty, and this real imperative of methane. And I'm talking a little bit about critical minerals. For minerals, it's a little bit different, right? Because we have, when you think about mining, there's kind of two, I mean, there's a gazillion types of mining, but there's two ways we can think of it. There's mining that it supports the energy transition, and there's the other stuff. So right now we're talking about all the minerals that are supporting the energy transition, right? And these we call critical minerals. They are critical because it is impossible to achieve the transition without them. It is impossible. The transition is extremely minerals intensive, right? So this is all the things that we need to build, all the things we need to invest in will require minerals. All the electric vehicles, the wind turbines, the solar, the grid networks, etc., all require lithium, copper, nickel, rare earths, cobalt, etc. So these are some of the critical minerals that you will see come up. The IEA estimates that demand for lithium in the STEPS scenario, so earlier Kingsmill was talking about the different scenarios. STEPS is it's not the net zero energy scenario, right? So this is a low ambition scenario or lesser ambition scenario. Demand for lithium will go up 9 times by 2040, right? So whatever we're doing now, we need 9 times that. For nickel, it's going to more than double. For copper, which is a very well-established industry, we're going to need at least 50% more. And this is in a fairly low ambition scenario, right? And this is by 2040, right? Not 2050, 2040. So we need it, and we need it very soon. So these are the enablers, and enablers mean also opportunity, and mean money. So this is where we're going to see investment, and they're really critical. But, in case you weren't aware, mining has not been the darling of the sustainable finance industry, right? It's really tough to understand, and it's really tough to put finance there, it's reputationally risky, just like a lot of the things that we've been talking about. And it's technically complex. For a few reasons, not at all homogeneous. Every mine, not just every mineral is different, but every mine site is extremely different. Every ore body is very different. We're not just talking about climate. In fact, emissions are actually fairly low order of priority when it comes to the critical minerals sector. We're really thinking about a huge number of environmental issues and challenges. And there's a lot of social issues. So these are the kind of three things that we need to tackle if we really want to say this sustainable finance is enabling, but it is also not wrecking the environment, wrecking social communities, et cetera, at the same time. So, you know, we have to try and solve these two things at the same time. So these are some of the things. We are not there yet. We know we can't ignore it, but these are some of the things that are happening to help us figure out these three challenges in this sort of knowing that the transition is completely impossible without minerals. So the first is recycling. This is the easy win, right? We need to maximize recycling as much as possible. If you look at this chart, on average, there's a huge greenhouse gas saving. So on average for, say this is just for lithium, nickel and cobalt, they're about 80% less greenhouse gas intensive, but that also means they're much less water, there's much less pollution, et cetera, et cetera. So the recycling is a really big win, and we need to look at all opportunities to scale up recycling. You can see here, however, that without recycling, we need a lot of lithium. Even with ambitious recycling, we're still going to need a lot of new lithium. So new mines are unavoidable. We can't solve this by recycling alone, even though it is a really, really important part of the conversation. So the other two things that are happening in the world to try and guide investment around for new mines and for new investment is that we have existing labels. We have existing work. We're not starting from a, from a stop. We're having a rolling start. There have been many institutions, IRMA, the various ICMM, and the various different coalitions that have long started work on trying to guide what does sustainable look like on environmental issues, social issues, etc. So there's things that are already happening, and they cover a really big range of issues, which is really useful. And they're very specific, right, to certain minerals. So that is really key because it's not homogeneous. But the labels, they're quite complex, hard to get your head around. And so the third thing that's happening, and please don't yawn, is taxonomies. So the third thing that's happening is we're seeing minerals being incorporated in taxonomy work, which is really important because of this homogeneity thing. It's not just each mineral that's non-homogeneous, but each regulatory context covers a very different range of issues. So you might have a very strong context in Brazil, right, which means that the gaps between the regulation and what they're requiring and what best practices are might be quite small. And in another jurisdiction, it could be really big. And what the taxonomy work tries to do is recognize where those gaps are and what is really important in that national context. So we're seeing that developing, and we've been involved with climate bonds in Brazil, in Australia, in the EU, and around the world in trying to bring together criteria on minerals. So these are some of the things that are happening. There's still a lot more to be done. But the encouraging thing is we're also starting to see some deals. I was chatting to someone at lunch who said they'd had 2 deals to do with minerals in the many years previous, and in this year alone they've had 6. So this is a momentum that is happening, so we really need to pay attention as well. So those are our beautiful beauty parades of the difficult, the ugly and the warty. But now we would like to pass over to you to see if there are any questions from the floor. We've got one here. I think we'll do one round because I don't think we have a lot of time for.
2 questions.
Hi there. Hello. Hi. Tessa Walsh from,
Tessa Walsh from IFR, London Stock Exchange Group. Have you seen or heard of any labelled issues that address, for example, methane or some of the other topics and themes that you pulled out on this very interesting panel? Thanks a lot.
Thanks. Okay, labelled issues for methane. Who's the other one? Was there another one, Sean? Oh, you said it.
I'm going to ask a question, for goodness sake.
Can't someone else help me out here?
We covered it all.
Thank you, Mickey. And one over here as well. And one here.
Of the 36, I think you said, 36 countries that have agreed to the methane commitment, are any of them the big countries that produce oil that we're concerned about?
Go, stand up.
Oh, hi, Michael from ITMO. As you probably know, and by the way, fantastic panel. I love solutions. And I love to talk about methane because it is the elephant in the room. Anyway, my point is this, that it's highly dependent on the NDCs. And if you don't mention methane in your NDCs, it's very unlikely that any investors would look at it. And you should know that at COP30, there are pilot projects that are being implemented under Article 6 for agriculture. I'm not so sure about oil and gas yet, but be on the lookout for these pilot projects because these are the ones that you need to promote next time at your next panel. And I love the way you pronounce a methane abatement. Abatement, that's the way it should be. It comes from the French word to kill, so let's just kill methane. Thank you.
Yeah. I shared in my presentation that India is taking these critical minerals as part of their green taxonomy. I have an interesting question. In fact, I'll also grapple with when I go for green equity principles. Like cobalt, nickel, lithium, it seems a critical mineral for green transition for sure. But what about copper or aluminium or silver? Because we would not like to encourage the greenwashing under the guise of that even copper is helping the EV transition or silver is helping the light craft, aircraft, you know. How exactly you are sorting this out in avoiding greenwashing in critical mineral space? Thank you.
Excellent questions, thank you. So we've got labelled issues, countries. Did you want to start any labelled issuance that either of you have seen around the thing?
I can answer, Maggie. Yeah, among these 36 countries, there are big polluters and big oil countries, so yes. And about the NDC, I will also add, indirectly, all of the, it's directly, because all the NDC apply to CO2 equivalent. This a small E that they have, and that includes all the greenhouse gases. But some of them are starting to put in the table the specific target for methane. But they were all included. Usually they include greenhouse gases, and this is including all of them. But now they're starting to put that. But I think it's a great measure. It needs to be pushed to have a specific target for methane. Yes, agree.
And we haven't seen any labelled deals for oil and gas abatement just yet.
There are some examples. I mean, we are pushing to have some use of process, so using the guidance that we produce at the end of the day is a taxonomy of activities that provide net emission reduction. So we are pushing in that direction. There are already many oil and gas, as Doris said this morning, that are reducing their intensity, and this is only due to reduce the methane. So this is already happening. We need to push forward, mostly for the NOCs. That is a big market because those are difficult, so they need also sovereigns, and it links with the previous talk about sovereigns, how to link sovereigns with methane abatement in the national companies. This is an issue. Yeah.
Reyes, any labelled issuances around methane?
So not beyond the typical ones on green. I think what we see more on the use of proceeds that include climate mitigation. Maybe some more specific talk about methane is there in the last couple of years that we have been looking more in details. And especially two things that I didn't mention that appear a lot on the frameworks are around food waste, which is another very big methane emitter. So there's a lot also to be done there that, as Anna was saying with the methane in the gas, is also a win-win solution because basically you're throwing a lot of food that then is emitting a lot of methane, so just don't waste it or use it for something else, for energy, for example. So food waste is something that not labeled per se, but it appears a lot on the user proceeds. And the second one is alternative proteins, and still quite small, but appearing a lot on the green bond frameworks, for example, from Nestlé or Danone, where they're including that, big corporates that use a lot of products from cows, let's say, with milk or meat, and they're including diversifying away in alternative proteins as one of the solutions. It's still quite small, but very much present, especially on the more supply chain-oriented retail companies and so on the deals that they're putting out.
Yeah. And then on the last one around, what about, there's the obvious enabling minerals, and then there's the kind of, what about the middle of the road ones? I mean, I think you mentioned copper. I think copper, even though, if I don't have a chart, but even though if you look at the charts, a relatively small percentage, say compared to lithium, of copper is going to what they call kind of energy-related demand. I think it's pretty well established, particularly with the grids narrative, that copper is essential. So I think that one is fairly easy. I mean, in terms of the kind of taxonomy work, most of them are taking a sort of priority approach. So they're like the really big ones that we are in critical need of first, and then, going down the path, as it were. So we might see some of those other ones. But I think it'll be really interesting because countries, the taxonomy work, which is why it's quite important, they will only deal with a particular mineral if they obviously have it, right? And so if silver is really important to a particular jurisdiction and there is a strong enabling narrative, then that'll probably be up to them to kind of put that in there. But for other countries where they've got a lot of lithium, that's going to be the main kind of area where they're looking at. So, and that's what we've seen so far. But it'll be interesting to see, what happens next. So, yeah. And I think a lot of the labels, the kind of the standards that already exist, don't necessarily make this distinction, right, between enabling minerals and regular mining. So most of them are really trying to see, okay, how do we make mining more sustainable? But what the work we're doing is really repositioning a lot of that as a critical enablers, which is the kind of really big climate angle.
Can I add something on the label? So on the label thing, it just occurred to me that usually, I think this is starting to be seen, and there are pledges for corporates saying, okay, we're going to disclose methane or nitrous oxide, the laughing gas, because usually I would say a lot of this is hidden by the CO2 equivalents, but when they start to show the really big weight of methane into their footprint, into the disclosure, then they start to label what they're going to do about it. So it's something that we should really push, and that some companies are starting to say, or other financial institutions are starting to target them and disclose them separately. The more we have that transparency, the more we will see separated labeling of this and increasing the strength and the power they can have. So it's really important.
Thank you. Within capital.
Thank you very much. Ujala Kadir, please come to the stage. We now have another 5-minute on-switch from Ujala. Ujala is the head of market development at the Development Guarantee Group, famous for being the long-time senior manager at Climate Bonds Initiative, but now with a different role. Over to you.
Thanks, Sean. I was going to mention, formerly part of the CBI family, I'm Ujala. Some of you may already know me. But I wanted to talk to you about a problem that I have, a very serious problem, and I'd like to invite you all to help me solve it. So as Sean mentioned, I work with the Development Guarantee Group, which manages the Green Guarantee Company, which is the world's first solely focused guarantor on climate finance and EMDEs. We have $1 billion worth of guarantee capacity to deploy, and we have a large pipeline, projects that want support, investors who are interested, and guarantees that are ready to deploy. But most of the projects that we're seeing are not investment ready. So while there are transactions taking place in the market, it's happening way too slow, and we've got to get them going faster and at scale. And because we don't have time, as you all know. So when projects come to us, they often have really important pieces missing. pieces that are critical for us and for the investors. Sometimes those problems are really upstream. They're early stage, projects lack basic investment fundamentals, no proper feasibility studies, no market validation. Even though the priorities are quite clear in the NDCs and in the NAPs, but these projects aren't being turned into viable investment projects or opportunities. Sometimes the problems are midstream, where projects are taking shape, but they're not yet aligned to what we as a guarantor need. Like, we need to understand the climate credentials. It needs to be CBI certified. And guarantors and the investors require this. The business models might be strong, but there's no environmental and social management systems. Sometimes the problem is actually downstream, where everything looks pretty much ready to go, but investors still kind of hold back because of a perceived risk. And that's where guarantees can come in and be really useful by sharing that risk and providing comfort so investors can take that first step and capital can actually move. So across the project lifecycle, a lot of people are working on their own piece. It's actually, I was shocked by this. I had to do a lot of research to find this number because I don't think there's a number really out there. But there's an estimated $30 billion a year that have been spent in the last decade on capacity building, technical assistance, and getting projects ready. Yet, here I am sharing my problem with you, and I'm sure many of you share the same problem. So yeah, this is clearly something that we're all facing. And I think that the main problem is that many of these efforts are moving in parallel, but not in sequence, not continuously, and often not at the right time. We keep fixing the inputs, but the deals still don't flow. And that leaves me and many others in this problem. So as I mentioned, I think fragmentation is really at the heart of this. And I think we need to start thinking of this as a relay race and not some individual sprints. We need to be passing these projects through their project lifecycle with support at the right time and get them to financial close. And I just want to share that there are examples of when pieces do come together. So we're working right now on an innovative deal. It's focused on distributed solar in Africa. And we've brought in different TA providers, existing initiatives. We've brought in the banks, we've brought in some investors, and they're all crowding around this one transaction to make it happen. And it's taken time, but it's progress. And it shows what's possible when the system moves in sync and focuses on one shared goal, which is getting to financial close. So we need a common outcome that everyone can run towards, getting transactions to financial close, deal by deal, until a market starts to take shape. Because markets take shape through execution, not through real deals that demonstrate credibility and build confidence. Each transaction we close, even if it's a small one, teaches us something. It shows what works in our standards and where they don't work. I've had to make lots of calls to the CBI team now that I'm in a different place to explain where we're seeing challenges. It shows where investors trust the information and where the risks are real and where they're perceived. Through each deal, we learn more, and for every next deal that we do, we can do it faster and cheaper and easier. And that's how we build confidence, and that's how we mature markets. So, wrapping up, don't kick me off the stage, Sean. Let's stop treating our roles as separate lanes, please. None of us can do this alone. Not the standard setters, not the TA providers, not the investors, not the policymakers, not the guarantors. We cannot do this together. I'm sorry, we cannot do it without being together. And I think we can do things in less in isolation. So my last thing that I'll say is if you're funding TA, please anchor it to a transaction. If you're setting standards, please make sure they're being used. And if you're investing, lean into the ones that stretch the market a little bit further and teach us a bit more about how we can all move forward. Thank you.
Thank you. Next session now. I'd like to get my three speakers up on the stage. I'll introduce them in a minute. They know who they are. Please join me. But I want to ask you to do something first. This next session is what's coming next. What do you see next year? Maybe the future about it. you've been sitting through some sessions today. I'm hoping you've got some reflections and some ideas. It might be about the extraordinary opportunities to apply AI to what we're doing. That's you, Krista, I'm talking about you. It might be what a banker is going to be able to do in terms of deals. Rob, that's you, at Natixis, etc. But what I'd like to do is to get you to talk to each other for 5 minutes. Talk to the person next to you, introduce yourself, and say, what are your ask them what their thoughts are on what's going to come in the coming year. What's interesting, what's exciting, what's positive. Hey, what's bad, that's fine too. And then I'm going to ask a few of you to report back, and our panel is then going to speak. 5 minutes, please. You must talk, otherwise I will be around standing over you. And Sarah, walk around and push people together if they're not talking. Okay? Walk around, push people together if they're not talking. Like move people. You're talking about what's coming next year. Find someone to talk to. You've got 5 minutes. Hurry, hurry. Where are my speakers? Where are my 3 speakers? Oh, at the front. Okay.
At the front of the mic. Best and ever. Yes. Everyone is talking. Yeah. And everyone's talking. Yes! Yeah.
All good? Why don't you come up on the stage and we'll keep talking on the stage. Let's sit 1, 2, 3, 4. It's time. It's time to bring you back in. Now what I'd like, microphones are going to be running towards you, 30 seconds at a time for a few key people. Reflections or thoughts on the future. Put your hand up, please, before I start picking people. Rob, that's great. Here. stand up quickly, 30 seconds.
All right. So we were talking about green equity or the various different colours of equity and how more and more exchanges could potentially be moving in that direction, and looking forward to more disclosures related to percentage of revenue, percentage of capex. So how do we move the assessments we've been doing and use of proceeds up to the entity level to get more disclosures into the financial direction of companies, maybe through the equity markets? Thank you.
Rob. And then you've got a micro. This man next, then you.
Thanks, Sean. Not trying to be lazy, but this really does build off the last panel, because we're definitely going to see more and more movement upstream to the green enabling side. So where it doesn't just need to be critical minerals, though. We are seeing the other enablers of the transition. So I think as we get better clarity on this, better ways of recording impact around avoided emissions as well, we're going to see a lot more movement in that space.
And he's a Natixis deal maker if you want to speak to him afterwards. Please, 30 seconds.
Reyes referred to the difficulty of agri-investment as too complex, no guidelines, not scalable, no revenue. Quite wrong. Biodiversity net gain is a credit, carbon is a credit, woodland is a credit, peatland is a credit, hedgerows are a credit, soil is a credit, salt marsh is a credit, marine systems are a credit. Scoop the whole lot together under an AI algorithm and launch the first nature-based solutions green bond in the UK worldwide.
Very good.
Hi, we had a very fruitful and optimistic panel discussion. Everybody was excited about new products coming online in the next few months, or 6 months or 12 months, including at COP30. There's the Article 6 products coming online. And there's a lot of countries that are also getting on board, such as Japan, and who are very ambitious, or setting very ambitious targets. So there's the new carbon market coming online. And so there's a lot of things coming. So watch this space over the next 6 to 12 months. Thank you.
Hello. I talked to my new friend Harish, is Mr. 11 out of 10 for India. And two great points I want to share. One, I challenged him with all this good news, why net zero at 2070, which is so long away. So he assured me that the plan is to under-promise and over-deliver, so there will be more good news coming out of it, so thank you. And then the second point was very gas-specific, when I challenged people from the gas industry about now taking out 20-25 year contracts when, you know, Germany says net zero 2045, what are you doing with all this gas? And then I often get the response, we can always sell it to India. And yeah, I have it right from the horse's mouth. That's not an option because they will limit delivery contracts to maximum of 10 years of supply in line with their plan. So great news.
Yay. Fantastic. I need a few more at the back here have been very silent. Hands up, please. Give me your reflection. There you go. The back. A famous baker from JP Morgan. And here as well.
Thanks for the shout out. So Helen and I discussed circular economy. The fact that stimulating all these new value chains is going to give us a new problem if we're not careful. So we talked about the need to set up these kind of second order businesses, recycling, battery materials, EVs, all the rest of it. Actually working on a sustainable steel, circular economy theme right now. So hopefully we'll have a bond in the market very soon.
Yes.
Thank you.
Fantastic.
Hi everyone, Garrett Zinnerman from Green Digital Finance Alliance. Tessa and I, we spoke briefly about some work that we explore around digital bonds, digital impact bonds or digital green bonds, where basically the instrument is a tokenized bond or a smart contract-based bond, and where thereby also the MRV or impact verified data can be directly integrated, so both making it less cumbersome on the reporting side, but also allowing more flexibility on the incentive setting. And yeah, that's something where we are pulling together an initiative around, and hopefully be able to share more soon. Thank you.
Fantastic. Any last ones? In the middle there.
Kevin Richards, Bermuda Global Holdings. We talked about blue finance, and we've got a
Bayesian from Barbados and Bermudian from Bermuda. And we talked about the need for support, financial support, like the new Blue Bond Accelerator Program for small island nations. And then also the ability to really look at these islands and not just the size of their landmass, but the ocean space that they're stewards of. You look at Bermuda as the 21 square mile island, we've got 400 square kilometers of ocean that we steward. So there's a big opportunity. I know the Green Bond Initiative is looking at this space, and we're also looking at tokenized bonds as well. So I think there's a really interesting intersection of technology and climate on the blue economy that we're looking to lead in Bermuda. So.
Fantastic. There will be blue in our new Climate Bonds Updated Taxonomy, 1. And 2, is anyone from the Blue Bonds Accelerator still in the room? There is a Blue Bonds Accelerator we're connecting you with. Thank you. And now
we should just go home.
My flash panel. No, you're going to comment on all of this. You're going to make sense of this. You're going to say, is Rob totally mad and at sixes? Or is Paul onto something? Or whatever.
I want to know what Paul's on to. I need to get on that deal.
So Anjali Pandit, who is the Global Head of Sustainable Capital Markets, HSBC, and an old friend from previous incarnations, but doing deals everywhere. And hopefully got an eye on the future. Also, Esther Law from Amundi, who's one of our lead sponsors here, is the Senior Portfolio Manager for Emerging Markets, Sovereigns, and Responsible Investment Lead, and an old friend. And Naoaki Chisaki, who's from Mizuho, who's the EMEA, Europe and Middle East, advisor to the Group Sustainability Officer, and Mizuho is one of our closest partner in Japan, and we're very pleased to have you here. So the question is, looking forward, what to expect in the next 12 months. You've heard a little bit about what the audience is thinking, and you're, of course, in the middle of this market going forward. So I'd just like to start off with an open question to you, and I might start off, Anjali, and work our way down.
Okay. I unfortunately only caught the couple of sessions before this one, but you know, I think from my perspective, if we do get to this point where we get out something from ICMA, I think she mentioned that ICMA is working on transition. Some of you in the room are here with us on the XCOM, going through many, many iterations of it. And we've obviously seen what's come out from the loan side. I mean, we're getting directly asked by a regulator, you know, as a financial institution, where is your transition public guidance on what you're doing?
Yes.
Right? And so
pressure from regulators.
I really think 2026 can be the year that we finally have legitimacy and credibility around the transition label.
In Europe.
I mean, I think...
Because Japan's just doing it, of course.
No, yes, Japan is doing it, but I think I'm talking on a global scale, right? And it's something that I think Japan has taken the lead and is kind of, you know, there were moments I think last year felt a bit lonely and was hoping that the rest of the world would pick up. So your point on Europe, I take it, that Europe finally feels comfortable to get engaged in this market. And because I do think ultimately a lot of the global market, you know, is more hesitant than perhaps Japan has been and is waiting for more kind of international guidance. Yep. I think if we get this out from ICMA, I think the kinds of questions we're getting in from clients on the LMA principles that have come out, I think in 2026 we could unlock disclosure and transparency on a completely new set of activities in the energy transition that has been kind of hidden from the market because we weren't using this label. Yeah.
The LMA principles, the Loan Market Association principles for bilateral loans, and Sabine Laurent on our team has been involved in
I think it was about 5 days ago, right? They came out with the transition guidelines.
Okay. Aoki from Mizuho.
Yes, so I might reflect too much of a Japanese lens, but looking at the future, probably two aspects. Number one is, of course, transition, since Japan is a very strong advocate of transition for a quite long time. Honestly speaking, when I was talking about transition a couple of years ago on this kind of arena, I was sort of, you know, kept with a very skeptic view about whether there is a transition in this sort of, you know, world or not. But now I'm very happy that many people are now much more familiar with the idea of transition. But that being said, in terms of transition, one thing that I would like to sort of, you know, extend as a very important message is that the purpose of considering transition is to actually support the transition. And in order to support the transition, we need to bring quite significant amount of money, both from the public sector as well as the private sector. And this is not a one-size-fits-all kind of an approach. So, for example, transition in Europe is much more sophisticated compared to transition in Asia, especially East Asian countries. How we would be able to support transition there is could not be taken in the same kind of a space that we are talking here in Europe. So how we would be able to create definition, we need to have quite a lot of flexibility in order to actually support the idea of transition. That is actually what I would like to extend here. And Japan's initiative associated with the so-called GX promotion scheme is a very good example. So we are trying to adopt as much as possible flexibility reflecting the roadmap of the pathway each country is thinking to how to transition into a much more greenier space. So that kind of an idea could be expanded to other countries. That's one of the messages I would like to extend. Another thing is the idea of adaptation in addition to mitigation. This could come as a very significant topic in the coming, say, months, years. And one good example is that the Tokyo Metropolitan Government have issued a resilience bond very recently. And looking back, say, 30 years ago, 40 years ago, when I was a child, Japan's, say, Tokyo's temperature was, in the hottest day, was somewhere around 30 degrees or something like that. Now, it is, usually 38 degrees, 9 degrees to some extent. This is unusual. And a lot of flooding, a lot of, say, climate events are ongoing in Japan. How to sort of, adjust to this kind of an environment? It's not only about mitigation. We also need to think about, say, adaptation, adapting to this kind of an environment. So to that extent, I think the initiative coming out from the Tokyo Metropolitan government to come up with this resilience bond is one of a very good example aiming for the future.
Thank you. Great points. Esther.
Yeah, well, thank you.
An investor voice.
Yeah, I will be giving slightly different perspective, but before that, just thank you for having me, and thank you for all the work CBI is doing in setting the scene and leading the market. I think verification is a very important aspect for continuing to develop sustainable bonds in a credible way, right? In a solid way. So when Jean gave me the question, I think I have 5 reflections. So first of all, I'm a fixed income person. To think about what to look for in 2026, I would just begin with now the Fed has started cutting, right? So, and also, the tariffs is still there, but we get the sense that I think we are trying to live with it. So in that context, and also without too much, let's say, inflation noise, that is to be decided. But right now, I think it is a good market for fixed income to begin with. Because we all know if we have a good bond market, naturally sustainable bonds will also be part of it. So I think this is a good, positive outlook for 2026. And coming from an emerging market coverage background, I also think that emerging market countries, the credit quality is actually improving. That can be seen as, that can be shown by the much higher amounts of upgrades in both outlooks and also credit rating upgrades than downgrade in 2024 and also to a less extent, but still positive in 2025. Now moving back, from my seat, I'm still seeing very, very healthy pipelines, and that's sustainable bond talking. We see, I think my colleagues here have already discussed in also previous panel the demand, for energy transition projects and various clean energy projects. So yes, there is a demand for the bond in both like sovereign and corporate. I think corporate may be easier for some of the specific projects, but I'm very delighted to see the sovereigns are also putting in their share. Like coming through to my next point, the product. We have a lot of product innovation, but we are still sticking to a definition because we have good definition or improving definitions, and this is very important for us as a European investor because we, obviously we have the EU taxonomy to apply to, i.e., we have to fulfill the reporting criteria, and if anything doesn't tick the box, we'll just have to divest. Going to that product side of things, I'm very encouraged to see quite a few sovereign issuing sustainable bonds, be it social bonds, green bonds, or SDG bonds. I personally was involved in a few workshops in discussing the framework. So very beautiful, this industry effort to come together. And this is on to talking about collaboration, blended finance. So at Amundi, we partnered with a few MDBs. I think the most signature one is the IFC Green Bond, launched in 2018. So that was, I think the biggest of its kind at that point. And again, thanks to CBI, we have a lot of help in defining, in basically having the universe ready to transition. So 5 years down the line now, actually more than 5 years, 7 years, we have completely greened the portfolio. So that's very encouraging to know. And throughout the whole period since 2018, we basically have brought to EM GSS bonds 18 billion. So over 64 countries. So this is, very, very encouraging, and it's a beautiful partnership between different stakeholders. My final point, I know I'm taking a lot of time, is the standard. Talking about higher standards, better definitions, and also impact report. I'm so encouraged and very excited to see a lot of, apart from CBI, we have different initiatives, coming together to create also. I think we've touched on it, the technical assistance. So there are a few good technical assistants there. For example, the Inter-American Development Bank, they have a green bond transactions transparency platform, very, very good setup. We also have, I think, one of the previous speaker, the ASCO project. That's the PRI. We started with the PRI-led, and then now is with the TPI Center. So that's assessing sovereign-related climate risks. All these are coming together with different expertise to have a good framework in order for investors and asset owners to move forward in this sustainable space in a credible manner. So I think I'll stop here, Sean.
No, that's
I've spoken enough.
Thank you. You covered a lot of territory. And by the way, for the audience, the Green Bond Transparency Platform, which is developed for Latin American issuers and so on, is something we help with the Inter-American Development, and we just agreed with them to take it global. So we'll be promoting the idea in all markets going forward, with climate bonds working with IADB and other development banks going forward. So just as a tool to promote the proper availability and access to
reporting.
there's a few things that have come up here. I mean, one of them is sovereigns. And, in terms of engagement with governments, sovereigns are a really important door into the ministries of finance from my perspective. So growing sovereign issuance is quite important. But there have been some challenges. One is lack of things to allocate funds to. I think so. I'm just curious, Anthony, how do you see that market? You've been involved in a lot of sovereign issuance.
Yeah. So I think climate adaptation is one that we're seeing. We're having a lot of conversations with sovereigns about expanding their frameworks to include more on climate adaptation. I think that's one we struggle a little bit because a lot of corporates or financial institutions can't really find sizable enough assets, assets that are maybe returning in some format, assets that they feel confident about the data and the metrics around. And so we often find that we kind of then go to the sovereign agencies or the SSAs or the cities, and then they realize actually within their own funding, they kind of house a lot of those projects, and they hadn't kind of put two and two together to put these into the framework. So I definitely think that's a key theme for sovereigns. I think the sustainable linked bond, a lot of investors come to us and say that's really a bright spot, SLBs for sovereigns. They really think in the SLB market where we've sort of, I think, reframed the SLB market to be much more focused on issuers where it's really kind of necessary for, and therefore the market size is smaller than what we were seeing before. A lot of investors come to us and say, could you encourage more sovereigns? We are in dialogue with several sovereigns in the emerging markets who are looking at whether or not they could use their KPIs, expand their framework to sustainable linked bond. I think the other thing that has really opened up is the conversation around nuclear energy within sovereign frameworks, right? And that's obviously, very much linked to the idea of nuclear energy within a more kind of understood technology for the global investor base and being seen as green with certain, obviously, criteria in place. I think this is a huge opportunity because a couple of years ago, when we were kind of working with sovereigns, many sovereigns were nervous to include nuclear in the use of proceeds because they were worried there'd be a liquidity risk, because obviously investors wouldn't be able to buy. But kind of movements that have happened within the EU taxonomy, within other kind of global statements, quite frankly, even also kind of the energy security push and kind of facing some of the reality, nuclear and the understanding of nuclear, especially like SMR and smaller, has really picked up. And you're seeing quite a few sovereign. We've already seen Indonesia put it into their framework and successfully, issue it. We know France is going to start doing it from next year. And then I think finally, I'm on the Just Transition Lab work as well, and we're thinking about how to bring more just transition concepts into GSSS labels. But this is kind of one of the reasons, because we all have limited time, one of the reasons I decided to join that task force is because it's actually something that increasingly we're hearing, especially from SSAs, that they sort of feel like they're missing that bit. They've got their social assets, they've got their green assets, and the story is not coming together as much as they'd like to, and then they're kind of looking at it differently internally, thinking about how they manage their data internally, and whether or not there needs to be shifts in that. So I do think potentially more on the just transition could come into frameworks in the next year.
Well, that fits into investments in social if the arguments and the thing are joined together properly. It's certainly one of the things we're concerned about going forward, that we understand that resilience isn't just physical resilience, like the Tokyo bond, it's also social resilience, which requires us to address just transition, because if you don't, you're going to get some ugly outcomes as all of it, and nature resilience and health sector resilience and so on, a lot of aspects. But and so I think Naoki, for Japan, we've had some initial conversations with Nippon Life, Daiichi Life, who are interested in this idea, but it's still very new territory, isn't it? Tokyo, physical, we get that now. The social resilience, let alone some of the other things like agriculture that Ray's talked about in the previous session. Do you see appetite amongst the markets, and I'm acutely aware you work across Europe as well, amongst your client base?
Yes. In general, I think the interest level toward adaptation is getting higher and higher now. And the point I felt this was New York City Climate Week a couple of weeks ago. So I felt a lot of enthusiasm toward adaptation, much more compared to, say, mitigation to some extent. And going back to your first question, probably, say, sovereign issuing, say, resilience bond or adaptation bond is making a lot of sense, since especially associated with adaptation, it's much more about, say, rebuilding or reinforcing infrastructure or whatever, which is much more of, say, government's hands rather than, say, private sector's hands. And in addition to that, I think the point just mentioned, nuclear energy security is also quite a lot of interesting area for, say, sovereign-related bonds or, to some extent, adaptation bonds in order to prevent something seriously bad to occur to nuclear-related facilities. So this is also the area which might be a little bit challenging for the private sector to address. So from that sense, I'm starting to feel a lot of interest associated with such kind of issuance.
Absolutely, and I want to be clear that in the climate bonds taxonomy, nuclear is counted for the purposes of green bond issuance. That's how we track it. Our argument essentially is you might have difficulties with nuclear, waste disposal, but it's low carbon, one, and two is if there's a real accident, we might lose 50,000 people at a time. If we don't take fossil fuels, we're losing the planet, we're losing humans. So there's a relative issue, and then the arguments about do no significant harm have been well and truly thrashed out in things like the European Union Joint Research Centre report that we commissioned at the European platform about that. So it qualifies under the Clumpos taxonomy, is just to be very clear. But, of course, it's not going to be a silver bullet. It can only be, according to the IEA, about 8% of global electricity generation by 2050. So it's a bit of a side issue in terms of the sort of things we need to tackle. But there are other sectors too. Mining, critical minerals, are you seeing interest in issuance into this market from that sector, Anjali? And then I have to then quickly switch to Esther to say, how would she react to that? You might have heard before.
No, I think some of the guidance around green enabling has been very, very helpful, right, Rob, for this sector. It was a sector that I think felt kind of they were on the periphery. They were kind of like the skeleton in the closet of the end EV. And I think, putting out that green enabling guidance actually gave them a space to explain what they're doing and why and how and put it under a labeled format. Do I see a bunch of mining companies like rushing to create frameworks? I would see more questions. I think we still, have an element in the hard to abate sectors, which is again why I kind of come back with all this language around transition and stuff being key to start sending signals to encourage that disclosure. I think there's still a little bit of a hangover, it's probably the wrong word, but a kind of continued sentiment for a lot of hard to abate sectors around where do they want to disclose, how much do they want to disclose, right? Especially when they're being asked very clearly, okay, I'm interested in those assets, but explain to me your entire transition strategy. What's your pathway to net zero? What are your interim targets? And if they're not that confident to be able to be sure about those targets, and we've seen with sustainable linked bonds a lot in those sectors realizing they would have stepped up, missed their targets, some even now potentially missing their targets. Does the market understand all the nuance around it? Are they going to be penalized reputationally? Is there going to be a misunderstanding of what they're trying to achieve or the things they're grappling with in the countries in which they are mining or the contracts that they've been able to secure? It's a question mark, right? And so we're constantly in that balance with issuers in the hard to abate sectors. How do we get you more comfortable to share and to engage with investors? At the same time, how do we not put you at risk and have you overcommit? Because there is a governance question too, right? About having kind of commitments out in the market that you're not really sure how you're going to deliver on, but you're trying to sort of answer to investors' requirement for ambition before you've put certain things in place.
Okay, so Bridget, we've still got a bit of work to do on the widening criteria.
Well, I don't know, what does Esther think? Does Esther want the
exactly.
ambition?
Now we turn to the voice of power, the investor.
Difficult, especially as a European institution. I think with the mining, coal, just generally oil and gas. I think we are still pretty strict, if you like, on the on the proportion. And I can share on a blended finance I'm working on. Basically our partners just say, can you exclude that? So it's still pretty, I think still pretty hardcore. Perhaps partially it's reputational risk and also the traceability, especially when looking at sovereigns, it's a bit less clear how to go. So it's sometimes maybe easier to just say not to have it. So yeah.
What's interesting, and listen, I love the European investor base, okay? You guys are really important for our market, for ourselves, but I will have to say, and I know that is a challenge for you and a lot of your peers in Europe, because you still have quite an interest, especially from European asset owners, to say, well, I want my fund to be green. I'm not so much focused on what all in my fund can help green a sector, an economy, a region, but I need my fund to uphold to certain green principles and my money to be a place where I'm comfortable. I think what's been really exciting is the growth in funds in Asia. And so if you look at the fund flows, because overall globally, equity and debt, fund flows have been, kind of going down in ESG. But if you break down where it is, it's almost all in US ESG equity funds, which we can understand, the reasons and the sort of political environment there that is kind of, pushing in that direction. But what you find in US is your fixed income sustainable funds have not really decreased in size. Yeah. You find in Europe that they're still growing. And in Asia, finally, because we kept kind of saying, oh, Asian investors are going to start carrying, they're going to start carrying. Well, finally, in the last year and a half, you see actually, increase in equity and debt fixed income funds in Asia. And that actually is going to be, I think, pivotal for issuers who are now outside looking for funds where they can tell, from those sectors where they can tell those stories, because you've got a group of investors who don't have the same constraints, because the Asian investor base is much more long-term thinking around transition in their context, right? And so, we could see, to your point on power, the European investor base has really even when I'm sitting with an Indonesian issuer, they're like, okay, but what is Amundi going to ask me in the meeting, right? They're often thinking about what they're going to do on a global level based on what the European investor base is going to ask them. But that's shifting. Now they're asking us about some of the names in Hong Kong, some of the names in Singapore, the Australian investors, right? Now they're asking, especially for their Indian assets, about whether or not Indian investors are starting to get focused because India is booming in terms of sustainable disclosure and expectations from SEBI, et cetera. So that also could change a bit sort of the power conversation on who is influencing what kind of disclosure you can bring to the market.
But that is relating to the regulation I'm subjecting to.
100%. 100%.
Because of the reporting criteria, and also in Europe we have the do no significant harm.
Yeah.
Which I don't think there's any.
Which is
applies to anywhere else.
And in India you're looking at adding transition into the taxonomy. That's the current draft. In Hong Kong they have a consultation out on their taxonomy around the same question. So different investors in different areas are going to start to look to their regulation, which is going to potentially call for a different strategy.
Just one thing associated with supporting transition. This aspect is very important. Who is suitable to support the transition in region A, B, or C? So once it comes to Europe, I think sophisticated, say, investor base, institutional investor base is much more suitable to support the transition of the region. However, once it comes to Asia, which honestly speaking is less sophisticated from various reasons, I'm not quite sure whether institutional investors is the best group of money to support that transition. Banks could be one area, or other, say, group of investors rooted in Asia might be, just reflecting your comment, might be rather suitable. I think going back to my original comment, supporting the transition is much more sort of important rather than categorizing which group of investor to support what kind of a transition or whatever.
And in Asia, both Prudential Asia and Nippon Life have published transition investment frameworks, which we've been involved in reviewing and so on with them, which are very clear about the guidance. And of course, critical minerals are part of that story in Japan in particular. So interesting point. I mean, there was a kind of reweighting to Asia underway in the investment side without sacrificing. We heard on the first session today, the first panel, that US investors are still here and still there. They might not be talking about it. They might be quiet. CalPERS tell me they're removed from the website any reference to climate change as well as any reference to DEI, CalPERS, the California Pension Fund. But they've been very clear to me, say no change whatsoever in investment methodology. Still investing. But the growth, as you say, in Asia has been extraordinary, including in China and then in India, as you say, and we've heard a lot about it. So there is a pivot underway. There's probably going to be a currency pivot because we see lots of outflows from US into Europe and into Asia happening at the moment, large scale. I don't know if you're seeing that in the Amundi asset base, but certainly I'm hearing that report. And that's going to have some impacts on things like exchange rates and all sorts of things that play out all of this, which is probably going to further exacerbate the problems that the US is experiencing as a result of the policy gyrations, but will be very good for Asia going forward. I think that means you might have to move back to Tokyo because it's more important to be there than be in London. Is that right?
But it will depend on what we would like to support. So, of course, once it comes to transition in Asia, that could be one case. However, at the same time, there are a lot of, say, much more sophisticated deals in Asia that could attract European investors. So I should act as a conduit to connect those to Asia. So it will depend on the situation, say, proceed, and all sorts of kind of things, I guess.
And it is important Tokyo issued their bond in the London market.
Yes, obviously. That shall be very important.
Other thoughts about the coming year? We're moving into the end of the session. Where you see this market going and positive, I say this because in some markets people have been depressed about all this.
No. There's nothing to be depressed. There's other things to be depressed about. I think on the sustainability story, even in the US, when we talk to US investors, I think they've gotten over the initial shock of, kind of having to change a bit of their marketing strategy, and actually kind of that relief. Climate Week in New York, I think, was a relief. Like, oh wait, it's all still happening. We all still get it. We're all still going forward. We just don't have, we can change what we call it maybe. I think one more thing to bring up. So blended finance obviously has been a buzzword for long enough. I think we're really reaching a point now where we have more and more concrete system-wide approaches to think about it that can be more accessible to more financial institutions. And I say that because it's kind of happening in parallel to a lot of the large MDBs thinking about distribution and thinking about how they manage assets on their balance sheet and moving also more towards a guarantee or providing those credit habits. And that's huge, right? Because then suddenly what we're finding all these funds are starting to call us, say, okay, we're going to launch this fund. We've already secured, $200-300 million, and suddenly these, global asset managers who wouldn't go anywhere near these types of investments and these kind of risky assets, they have access to it because they've partnered with some MDB who's going to do some de-risking component, and that's how they've kind of. And that's actually the MDBs, delivering on what was one of their goals, which was to help move private capital, like the IFC, for example, to help move private capital. What we're finding is, in the last few years, where they would have more directly lent themselves, they're now kind of coming to us and saying, oh, can we do this with your support, or with kind of as a club deal? Can we actually? They're partnering with asset managers and saying, okay, we're actually going to play a slight backseat in this fund. And we're not going to require the issuer to meet every one of the sort of MDB criteria, but this is the direction, this is sort of the technical support we're going to give you. And really what it is we're going to give you some underlying credit risk and risk management. Yep. And that, I think, and even for us as banks, we're all thinking a bit more about origination to distribute as we get investors coming in and saying to us, can we partner with you on transition assets in parts of the world that we can't access directly? And we are looking at hurdles that are 10%, 11%, 12% is what kind of things we're hearing from investors, which never really, when we would show them the kind of assets, they wouldn't be interested. So this could actually really bring this kind of blended finance, private, public capital, to a head next year or the next coming years, because you're really starting to see innovation in these products. You're starting to see real funds that have real criteria that they're looking for, and issuers are getting much more comfortable to say, oh, maybe I do project finance on my sustainable assets through ECA, through a private placement where it's an IFC guarantee, through et cetera, whereas before they were kind of putting it more on balance sheet, if you will. And that brings disclosure, transparency, understanding of those technologies to more parts of the market.
I suppose that takes me to Mizuho's case, because Mizuho has put things on its balance sheet a lot of the time. Yeah. Although you have these very interesting relationships, I'm acutely aware, with non-banking lenders, where you're providing wholesale capital for the Orexes of the world and so on around. Well, I'm curious in your reaction to what Anjali's saying about how things are changing and whether you're seeing that in your global footprint with such a large global bank versus domestically in Japan, where systems are well in place. That relationship with other lenders and the managing of risk and getting more deals on the table for all of us.
Yes, so Mizuho is a blend of commercial bank and investment bank, I should say. So historically, we were much more skewed to commercial banking. So we were originally thinking about placing everything on our balance sheet. But say, I think it was 30 years ago, so when the Japanese regulation have relaxed, we have just much more skewed into investment banking space and considered about originate to distribute kind of a model, much more significantly. And once it comes to supporting, say, sustainability-related matter or transition or whatever, I think it shall be the blend of both. We, as Mizuho, as a commercial bank, is very much willing to keep certain amount of asset on our balance sheet. But at the same time, going back to my transition discussion I have mentioned earlier, it will depend on the, say, nature of the deal, nature of the, say, transaction itself. Which group of money is suitable to support that kind of a particular, say, initiative? If that's much more suitable for institutional investors, we are very happy to distribute it to institutional investors. It's much more suitable for, say, local banks to support that. We are much more, say, happy to distribute to the local banks. And if it's much more suitable to keep it on our balance sheet, we will do so. So it will be the mixture of that kind of a space, I guess. And this is not only about Mizuho, but about same to all the other Japanese financial institutions, I believe.
Any thoughts on that? And also I want to ask you, Amundi's increasing exposure to emerging market. Is that actually a myth or is it true? You're in the middle of that, trying to make it work.
I'm trying to understand. Okay. I will first give the reflection to what's been discussed. Blended finance, 100% agree. I mean, this year, I must have done about 6 requests on different form and shape. You know, from the IFC green bond fund model, you have a bit of guarantee, and then you build a portfolio above that. The idea is to buy the eligible green bonds. I think it's very important. We do focus to motivate issuers to do it correctly. So we have a framework. We have the seriousness that this is making an impact. The different types and forms are quite interesting. We have the regional shape. We have even, let's say the sukuk shaped. And sometimes we have maybe, can we have some like private loans, for example. So that model is still working quite well. In terms of emerging markets, like I said, that's why I thought I should mention this. For me, very important is, you mentioned about the dip on the green, generally sustainable bond issuance in the past year. And that's not just because of the demand for sustainable bond, right? It was also affected by the Fed cycle. Yeah. Post-COVID, we have a bit of an inflation. So these were all impacting fixed income demand, right? So when the whole fixed income issuance fell, of course, I think it's normal to assume and to imply that the sustainable bond issuance will also fall. And then therefore I started, my initial comment. Going into next year, we are already seeing US Treasury yield coming lower, Fed started easing. So I think this is actually a very good time to be rethinking about that. And I'm pretty sure the GSS issuance can only really go up from here. And also China, a reflection on Asia. Indeed, I think China, Indonesia, India, a lot of the countries are joining the group. And what is interesting for China, as I'm actually reviewing some of the ASCO data, not many countries have reflected on the midway on the net zero pathway commitment. So a lot of them have a really far on 2050, 2070, 2060, but very few percentage has actually got a mid one. I think China is one of them. Well done them. So that again, I think echo to the Asia theme. That could be interesting opportunities there. And regarding exposure to EM, again, this is kind of relating to one of my first points. EM credit quality, I think, is improving relative to DM. If you are asking me whether the fiscal is significantly improving, I think it's a very difficult thing to say. But relative to DM, for sure, I think definitely some green spots, bright spots in the emerging market countries, and then I think this is something to bear in mind. And you have seen some really high quality, SLB framework, sustainable social bond framework, again with the help of some of the MDBs, and perhaps Sean, you are also involved in some of the technical assistance. And I think this comes to a very good concluding point is, with the sustainable finance industry here, I think the beauty is we all work together. Whatever ups and downs, tariffs, COVID, we commit to making it better. We commit to expanding the universe again in a genuine and responsible way. And I can only see this to continue to grow by working together. We debate, we challenge ourselves to just make sure the quality is there. We are not greenwashing, not social washing.
It's the partnership we need. Absolutely right. Thank you. I've got to ask you now, to the audience, what would be your last phrase about the coming year? Your advice to the audience about what the next 12 months is going to look like? Just in one phrase.
Can you give us a second?
You've got a few seconds to think about it.
I would say teamwork is dream work.
Nice. What would your advice to the audience about the future be?
I shall say flexibility. So too much rigidity would not bring scaled, say, finance to necessary, say, mitigation and adaptation, I guess.
Yeah, I remember one time I was doing a fireside chat with Bernard Picard. He flew on a plane. And so this was 5 years ago, and I said to him, there's a lot of kind of heated debate that nuclear shouldn't be included in sort of the green level conversation. And he just said, stop right there, Never have a fixed idea about anything. It is only when we're open-minded and we innovate and we constantly challenge and evolve our thinking will we find the range of solutions we're going to require to solve the climate crisis. And I think something is shifting this year. And I really hope that next year we go to a place where that open-mindedness, the willingness to learn and be educated and have more data rather than to be obsessive over what is the right data and what's the wrong data. I hope that's what we get to in the market.
Hey, good words. We have a membership network called the Climate Bonds Network. If any of your organisations are not involved in it, I'm so sorry, I feel sorry for you. Please do come and talk to us afterwards, because it's a cool network and regular conversations. And we've got a couple of staff of the team who work on it. Ian Howard, stand up, for example. Oh, he's here somewhere, hiding in the back. Okay, come and find me and I will drag you there. That's the advertisement part. The end part is, you've heard a lot today. I'm going to say, I want to go back to the very first word I put up on the screen. We have to make this about opportunity if we achieve the change. Like, that's obvious, but it's still surprisingly not obvious in many communities. If we're going to make it work for these three actors on the stage, there will need to be opportunities. But I want to stress, it's the opportunity to create a future that we want to live in. That's the way we need to think about this. We still have that choice going forward. We can make, there are mistakes to be made, but there are the elements of a fantastic meal, a fantastic soup. We have capital. We have a lot of capital, I think, around the world. Isn't necessarily the right place. We haven't structured the deal, we haven't done the risk issues. But you know what? The capital's there. We've heard in all markets, it wants to move. It's interested to move. It's concerned about sustainability. It needs deals that meets its short-term as well as long-term needs. We need to structure that link between short-term returns and long-term returns, which are social, societal, environmental, and financial. Hey, we're bankers and financiers in this room, aren't we? That should be easy. Well, at least that's our job. Our job. The real challenge going forward is how to design the solutions when we know the money wants to move. How to give them the solutions that will meet their fiduciary requirements and also creating a sustainable world. And that means also bringing in government, because as Anjali said, it's PPP, public and private partnership, that we have to make work here. And private is capital, banks, corporates, working in the public sector. So in a sense, it should be easy. Alas, it's a bit more complicated than happens every day, but it's a great opportunity. And I'm going to say one other thing. Because we're all working in this space together, it gives us something which is very special. Camaraderie. We're all working together. Look at these banks in the room that compete but actually talk. Rob from Antixis knows Anjali from HSB, knows Paul from JP Morgan, because we collaborate on sustainability, because we all know there's a bigger story. It's right that we compete, but that collaboration is meaning, is purpose, is frankly joy. So I want you to find the joy in the coming year in collaboration, working together, and bringing in the others we need in the room, like the public sector. And let's see if we can turbocharge this market. I think we can, I think we will. I think it needs to grow. Hey, I don't care it's a market or not, I just want capital flow in the right direction. But the market is a very useful indicator for it. There's a lot to be done. Good luck. Thank you for your work in this area. And thank you for being here today.